Hello friends, today we are going to start with new reading income taxes. So in this reading we will learn how to record income tax expenses in your financial statement. Okay, now let us assume that there is a company ABC Limited, and now ABC Limited has to follow Companies Act. And in Companies Act, it is written that companies have to prepare financial accounts in accordance with IFRS. Okay. Now my point is, I have to prepare my accounts in accordance with IFRS. And now whatever the profits I'm going to arrive with the help of IFRS, I have to pay tax on that particular profits. Now while preparing the accounts in accordance with IFRS, you are going to follow the principle of prudence. Now, what is the meaning of prudence? If there are some future losses, keeping in mind the conservative approach, you are going to book that losses at time zero, because of which current year profits are going to reduce. And if current year profits are going to reduce, then it will reduce your tax liability as well. Now, let us assume, as in accordance with IFRS, my profits were 500. Tax rate is 10%, that is 50. And based upon this profits, I pay the tax to the government authorities. Now my point is, will government authorities accept this figure of 50? Now this figure of 50 is based upon a principle of prudence. Will that accept this figure? The answer is no. Now, Income Tax Department wants to compute the profit as per Income Tax Act. They want to charge the taxes as per Income Tax Act. That means they are least bothered with whatever is written in IFRS. They are going to collect the taxation as per Income Tax Act in your country. Now, my point is, now there will start difference of opinion between the two rules. IFRS is based upon prudence, but do you think that Income Tax Act will also be based upon prudence? If income tax is based upon prudence, then your profits are going to reduce, and this reduced profit will eventually reduce the earnings of the government. So income tax is not based upon the prudence principle. Now in this chapter, you will learn that how to record the income tax expenses. But point to be noted, we are learning accounts. So in accounts, value as per IFRS is going to be transferred. Okay. But what you're going to pay to the government, actual cash outflow, that actual cash outflow will be based upon Income Tax Act. Okay. So this was the broad overview of this reading. Now, based upon my experience, students find this reading a bit difficult. Okay. So what approach I'm going to follow? First, we are not going to refer Schweizer for this particular reading. Okay. So my hand notes would be more than sufficient for this particular reading. So first disclaimer. Second, I try my level best to solve all the practice problem to have the better understanding of all the concepts. Okay. So now I'm starting with first differences, that is based upon depreciation. So there could be differences on n number of items. So now let us assume that the first difference is how to charge depreciation. Example 1. Now let us assume that Mr. A purchased a car for rupees 6 lakh, having a life of 3 years with nil salvage value. So Mr. A purchased a car for rupees 6 lakh, having a life of 3 years with nil salvage value. He charged depreciation as per IFRS using SLM method. Okay, now let us assume that, so first I'm talking about accounts, year 1, year 2, year 3. So my assumption is my profits, my EBITDA for all the 3 years is 10 lakh. 10 lakh, 10 lakh, 10 lakh. Now I'm going to charge depreciation over that vehicle. So depreciation is going to be 6 lakh you have purchased, salvage value 0 with a life of 3. So my depreciation and amortization is 2 lakh for each year. EBIT, earning before interest tax, or EBT. Since assuming that I'm not having any sort of debt, so EBIT is equal to EBT. 8 lakh, 8 lakh, 8 lakh. And tax rate in our country is 10%. 0.8, 0.8, 0.8. So I'm left with EAT as 7.2 lakh, 7.2 lakh, 7.2 lakh. So for each of the year, my profit is 7.2 lakh. Now my point is the tax which we have computed 0.8. This taxation is as per the, so this taxation is as per the accounts. It is known as income tax expenses. So you have to learn the definition. It is known as income tax expenses. And this is the tax amount as per accounts. So eventually this particular figure is going to be transferred to your profit and loss account. Okay. Profits before tax. Profit before tax as per accounts is known as accounting income, also known as pre-tax income. So ideally, you should pay a tax of 80,000 each year to the government. Okay. Now, government denied to accept these profits. Now you are going to prepare, you have to find out the tax liability using taxation laws. Now there is no dispute with respect to EBITDA. So as per accounts, as per taxation, EBITDA is 10 lakh. There is no dispute. The only dispute is with respect to depreciation. Now as per accounts, depreciation is 2 lakh for each year. Now let us assume that as per taxation laws, depreciation is 3 lakh, 2 lakh, 1 lakh. 3 lakh, 2 lakh, 1 lakh. Now my first point. Collectively over the period, what is the depreciation amount as per accounts? 6 lakh. Okay. What is the depreciation amount as per taxation? 6 lakh. So collectively over the period under both accounts and taxation, the expense is 6 lakh. The only difference is with respect to timing. As per accounts, 2 lakh is an expense for each year. As per taxation, expense is 3, 2, 1. Collectively the answer is 6. There is only a timing differences. Now this timing differences is known as temporary timing differences. And over temporary permanent differences, important word DTA, that is deferred tax asset or deferred tax liability, deferred tax asset or deferred tax liability is created. Okay. So what do you mean by temporary difference? If collectively the amount under accounts and income tax is going to be same, the only difference is with respect to the timing. Such differences are known as temporary timing differences, and over temporary permanent differences, DTA or DTL is created. Okay. Now, what are my figures? My figures are for the profits 7 lakh, 8 lakh, 9 lakh. So how much tax I should pay? 10%, that is 0.7, 0.8, 0.9. I'm left with 6.3, 7.2 and 8.1. Now my question is, as per taxation rules, you should pay them 0.7, 0.8, 0.9. So this is the liability, this is the amount that you are going to actually pay to the department. So this is the amount you are actually going to pay to income tax department. It is known as, this amount is known as taxes payable, and the profits before tax as per the taxation laws, this figure is known as, this is your taxable income. Okay, so before I proceed further, you have to learn the meaning of 4 terms. Number 1, the term is accounting income or pre-tax income. So accounting income or pre-tax income, this is the profit before tax as per accounts. Then the taxation which you have to pay as per accounts, this is known as income tax expenses. So 2 important words. Pre-tax income, profit before tax as per accounts. Profits before tax as per accounts is known as pre-tax income or accounting income. Then taxation expense as per accounts is known as income tax expenses. Same under taxation, profits before tax as per taxation is known as taxable income, and tax expense as per taxation laws is known as taxes payable. So these 4 terminologies should be very clear before we proceed further. Now let's go through once through the notes as well. Accounting income, profits before tax as per accounts, also known as pre-tax income. Taxable income, profit before tax as per the taxation rules. Taxes payable, tax to be paid to the government as per taxation laws. Income tax expenses, tax expenses as per accounts or financial reporting standards. So these 4 terminologies should be clear. Now my point is, we are learning accounts. So eventually, mark my one word, this is the value which is eventually going to be transferred to your profit and loss account. So to profit and loss account, the value is going to be transferred 0.8, 0.8, 0.8. But on the contrary, what is the amount that you have paid? You have paid the amount 0.7, 0.8, 0.9. Now my question is how to record this in your financial statement. So again, let's sum up. Amount to be transferred to accounts, that is 0.8, 0.8, 0.8. Amount actually paid to department 0.7, 0.8, 0.9. 0.7, 0.8, 0.9. Now my question is very simple. We have to learn the accounting of this. Now, liability is of 0.8. You have paid only 0.7. You have paid less. Liability is created or asset is created. Again, you, as per accounts, you should pay 0.8 to the government, but you have paid only 0.7. You have paid less. If you are paying less, liability or asset is created. Now, if you are paying less today, eventually you have to pay this amount in the future. Now my point is, it will create an obligation in the future. DTA, DTL. Now, what is created? DTL is created, and that DTL is of 0.1. Again, you have to pay 0.8 for year 2. You have paid 0.8 to the government. DTA, DTL, nothing. So no DTA, no nothing, no DTL is created. But my point is, last year there was a DTL of 0.1. This will carry forward to the second year as well. So now DTL figure as on second year. So DTL figure as on second year is going to be 0.1. Now third, you have to pay 0.8. You should pay 0.8. You actually paid 0.9. You paid more. Now when you are paying more, so there is an asset of 0.1. But already of liability of 0.1 is already there. Now my point is, eventually this liability will reduce to. So this time you have paid 0.1 more to the government. Already you are having a liability of 0.1. Now this liability will reduce to 0. That means what DTA, DTL I'm going to report? I'm going to report a DTL of 0.1 at the end of year 1, 0.1 at the end of year 2, and 0 at the end of year 3. Now, again I repeat. So I understand that accounts are prepared in accordance with IFRS, and income tax is going to be collected as per income tax laws. So now they do have different different treatment for the expenses. Now my point is, first let's take an example of depreciation. Now we are taking an assumption as an example where I'm going to charge depreciation of 2 lakh, 2 lakh, 2 lakh as per accounts, 3 lakh, 2 lakh, 1 lakh as per taxation laws. Now you have to learn how you are going to show this in your profit and loss account. So important. This is the amount that is going to be transferred to profit and loss account. This is the cash that will be reduced from your balance sheet. And one more item will be there. That one more item is, now you are going to create a liability. That liability is 0.1, 0.1 and 0. So now let's conclude. Finally, what happened to my financial statements? In P&L, you are going to show tax expense as 0.8, 0.8, 0.8. In your balance sheet, cash will reduce by 0.7, 0.8, 0.9, and you have to show a DTL of 0.1, 0.1 and 0. So this is going to be an accounting treatment. In the P&L, always the amount as per IFRS is going to be transferred. Whatever the amount is as per taxation laws. That is the amount that you have to actually paid. So this is the amount cash paid to the department, and if you're paying more or less, based upon that, DTL or DTA is going to be created. Now, how to present this in your profit and loss account? So I know the answer, that answer is 0.8, 0.8, 0.8, but now the question arises how to present it. So presentation of income tax expenses. One, two, three. First, you have to write taxes payable. So what do we mean by taxes payable? As per taxation laws, amount as per taxation laws, plus change in DTL minus change in DTA. This is going to be your income tax expenses. So I already know the answer. The answer should be 0.8, 0.8, 0.8. Taxes payable were 0.7, 0.8, 0.9. So in this we have already created DTL. So DTA 0, 0, 0. Now at time 0 there was 0 DTL. By the end of year 1 you are having a DTL of 0.1. So a change of positive 0.1. So 0.1, 0.1. DTL of 0.1 at the end of year 1, DTL of 0.1 at the end of year 2. What is the change? Change is 0. And now in third year, DTL has reduced by 0.1. So negative 0.1. Now if you add up both the values, your answer is 0.8, 0.8, 0.8. So this was the first way, alternative one, how to compute the value of DTL and DTA. Now I'm going to find out the same answer using alternative 2. So alternative 1 is known as P&L approach. Alternative 2 is known as balance sheet approach. Now you purchase one machinery, and as per accounts depreciation was 2 lakh, 2 lakh, 2 lakh. Now point is, if the depreciation is 2 lakh, 2 lakh, 2 lakh, in totality the value is 6 lakh. Now what is the remaining book value? Remaining book value of asset. So you purchase the machinery for 6. You have already charged a depreciation of 2 lakh. Now what is the remaining book value? So remaining book value is 4 lakh. Then minus 2, 2 lakh. Then minus 2, 0. So the book value of asset as per accounts is, it is also known as carrying value. Carrying value of asset as per accounts is 420. Okay. Now what is the carrying value as per taxation? So as per taxation you have charged a depreciation of 3, 2, 1. So now what is going to be the remaining book value of asset? 3 lakh already been charged to profit and loss. You are left with 3 lakh, left with 1 lakh and 0. So started with 6, 6 minus 3, 3, 3 minus 2, 1, 1 minus 1, 0. Started with 6, 6 minus 2, 4, 4 minus 2, 2, 2 minus 2, 0. Now carrying value of asset as per accounts as per taxation. So 4 to 1, sorry, 4 to 0. 310. Now first compute the difference. First compute the difference. So difference is 1 lakh, 0. Multiply this difference by tax rate. That is 10%, 10%, 10%. Answer is 0.1, 0.1, 0.10. Now you have to decide whether it is a DTA or DTL. Now my point, important. Now important. So let's have a focus only on year 1. So as per accounts, carrying value is more, 4 lakh. As per taxation, the value is 3. As per accounts, value is 4. So my focus is only over accounts. So value as per accounts is more. Carrying value is more. That means expense in the first year. Expense as per accounts in the first year is going to be carrying value is more. That means expense in year 1. Expense in year 1 is going to be less. And if expense as per accounts is less, profits as per accounts are more. If profits as per accounts are more, you should pay more taxes to the government. You have paid less. DTA, DTL. Again I repeat. Carrying value of asset as per accounts is more than carrying value of asset as per taxation. Okay, so it is also known as tax base, asset base. Asset base value and tax base value. Okay. Now carrying value of asset is more. 4 is greater than 3. That signifies that expenses is more, expenses is less in accounts. Now in accounts the expense is of 2 lakh depreciation, and in tax the depreciation expense was 3 lakh. So if carrying value is more, that signifies that expense in accounts is less. Now if expense in accounts is less, that means profit is more. If profit is more, you should pay more taxes to government. But actually you paid less. Now my point is very simple, DTA or DTL. So in this particular case, what is going to be created? That is DTL. Again I repeat. Carrying value of asset is more as per accounts. If carrying value of asset is more, that means expense is less. Assets are either assets or expense are either expense or they're an asset, and eventually asset is an expense one day. Now my point is value of asset is more. If value of asset is more, that means expense is less. Now if expense is less, that means your profits are more. You should pay more taxes to the government. You have paid less. DTA, DTL. Ideally you should pay 0.8 to the government. You have paid 0.7. DTA, DTL. So DTL should be created. That means now if I just conclude, to find out DTA, DTL, there are going to be two approaches. Number one is profit and loss account, is a P&L approach. Number two is balance sheet approach. So first let's discuss how to solve using balance sheet. You have to find out carrying value of asset as per accounts, as per taxation, take up their difference, multiply by tax rate. Now whatever the value is, that is either DTA or DTL. So let's conclude from the point of view of asset. If asset value is more as per accounts, then asset value as per taxation, it is always going to be DTL. Okay, else it is a DTA. So this is alternative 2. If you want to follow using profit and loss account, then you have to find out income tax expenses, income tax payable or taxes payable, so income tax expenses was 0.8, 0.8, 0.8, taxes payable was 0.7, 0.8, 0.9. Okay, now you have to decide whether it's a DTA, DTL. So income tax expenses, this is the amount you should pay. Income taxes payable is the amount you actually paid to government. Actually paid. Now, you should pay 0.8, you have paid 0.7, you have paid less, DTA, DTL. So DTL of 0.1, 0.1 and 0. How? 0.1 for year 2. You have to pay 0.8, you have paid 0.8. So now nothing, no DTA, no DTA. But already last year there's a liability of 1. That 1 will carry forward. In the last year, you have paid more. So DTA of 0.1. So first you have to knock off that liability which is standing. So now by the end of year 3, what is the DTA DTL? That turn into 0. So there are 2 approaches. Using any approach, you can find out the answer. And then how to present this into your profit and loss account? You're going to start with taxes payable plus change in DTL minus change in DTA. This will eventually be your income tax expenses. Okay, so we covered one example, and in the example number 1, the difference is on account of depreciation. Now I'm moving to my second example, and example 2 is also difference on account of depreciation. So suppose that Mr. A purchases a car and the car value is 1,20,000 with a life of 4 years, and in accounts we are going to depreciate using SLM method. Okay, this car generates a EBITDA of 50,000 each for 4 years, and under as per taxation, asset is going to be depreciated over 3 years using SLM method. Okay, so again I repeat, Mr. A purchases a car for 1,20,000. The car life is 4 years and we are going to depreciate using SLM method, salvage value 0. Asset is generating an EBITDA of 50,000 each for next 4 years. But what is the difference? Under taxation, asset is going to be depreciated using SLM method but over 3 years. So now you have to find out DTA, DTL. So first let's prepare the financial statements using IFRS. Year 1, 2, 3, 4. Okay, now class, before I solve this, I request you to please pause the video, try to complete yourself and then proceed with the part. Okay, so you have to pause, try to complete yourself and then you're going to continue with the video. So what you have to find out? you have to find out DTA, DTL for each of 4 years. What is the amount to be transferred to your profit and loss account? What is the amount that you have to pay to the tax authority? That means you have to find out income tax expenses, taxes payable, and DTA, DTL for each of 4 years. So similar to example number 1. Okay, now EBITDA is 50,000 each for next 4 years. And now in accounts, I'm going to charge depreciation using SLM, and I'm going to depreciate over 4 years. So 1,20,000 divided by 4. So depreciation for each year is going to be 30K. EBIT or EBT 20K, 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 20K. Okay, and assume the tax rate to be 40%. Okay. Tax rate is 40%. EAT 8K, 12K, 8K, 12K, 8K, 12K, 8K, 12K. Now, this is the amount that is eventually transferred to your profit and loss account. This amount is known as income tax expenses. Now, as per taxation laws, $50K, 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 $50K. But now you're going to depreciate the asset in 3 years. So each year depreciation is going to be 40K, 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 and 0. 10K, 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 10, 50K. Now my first point, is it a temporary difference? Cumulative under accounts, the total depreciation is 1,20,000, under taxation is 1,20,000. Is it a temporary difference? Yes. And over temporary difference, what we are going to create? We are going to create DTA, DTL. Now tax at the rate 40%. 4K, 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 and 20K. EAT, this is 6K, 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 and 30K. Now this is the amount that you have to pay to the authorities. Cash paid. It is known as taxes payable. And now you have to find out whether it's a DT or DTL. Very simple. You have to pay tax of 8K, but you paid only 4K. So you pay 4K less. DTA, DTL. You have paid less. Now year 1, year 2, year 3, year 4. You have paid 4,000 less. DTL. DTL of 4K. Now what happened in second year? You have to pay 8. You should pay 8. But actually you have paid again 4K. You have paid 4,000 less. So now liability increases from 4 to 8K. In third year again you have paid 4,000 less. Liability increases to 12K. And finally in the fourth year you have paid 12,000 more. So 12,000 more will first knock off the liability of 12K. So eventually the liability which was of 8K at the which is of 12K at the end of third year, it has been reduced to 0 by the end of year 4. So now what is your DTL amount? 4K, 8K, 12K, 0. What is your income tax expenses? 8K, 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 8K. This will eventually be transferred to your profit and loss account. and by this amount your cash will reduce 4k, 4k, 4k and 20k. This amount is known as taxes payable. Now I'm going to find out the same answer using alternative 2, which is the balance sheet approach. Now my point is alternative 2, balance sheet approach. So year 1, 2, 3 and 4. Okay, so first let's find out depreciation as per accounts. 30k, 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 30k. Now you have to find out the carrying value of car as per accounts. You purchase for 1,20,000, 30,000 depreciation is charged. So what is the remaining value? 90k, 60k, 30k and 0. So this is the carrying value as per accounts. Now depreciation as per taxation, 40k, 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 0. Now carrying value as per taxation. It is also known as tax base. In totality, you have purchased the car for 1,20,000. 40,000 has been depreciated. So what is the value by the end of year? That is 80k, 40k, 0, 0. Now you have to first, using balance sheet approach, year 1, 2, 3, 4. So carrying value as per accounts, carrying value as per taxation. So carrying value as per accounts is 90k, 60k, 30k, 0. As per taxation, 80k, 40k, 0, 0. You have to compute difference first. 10k, 20k, 30k, 0. Multiply by tax rate. 40%, 40%, 40%, 40%. Now this is going to be DTA or DTL. Okay, so answer is 4k, 8k, 12k and 0. So now you have to find out whether it's a DTA or DTL. So carrying value as per accounts is more. So value as per accounts is more. If value as per accounts is more, expenses, my focus is over expense. Expenses in accounts will be, now expenses, carrying value of asset as per accounts is more. That means expenses in accounts will be less. Profits as per accounts are going to be more. And if profits are more, you should pay more taxes to the government. Taxes as per accounts should be more. You have paid less to government. DTA or DTL. So in this particular case, we are going to create DTL. So my answer is 4k, 8k, 12k and 0. So using either of the approaches, balance sheet and P&L approach, your answer should be 4k, 8k, 12k, 0, and this is going to be DTL. Now important point. Cumulatively in the P&L, under both the scenarios, 1,20,000 is transferring. Only difference is of the timing. Now my point is these differences are known as temporary difference. And over temporary difference, what we are going to create? We are going to create DTA or DTL. Important. Then there are two approaches, one P&L, one balance sheet. Now question arises, sir, which approach we should follow? Now it's up to you whether you want to follow P&L or balance sheet. That is up to you. But mark my one word. That important word is that if in question it is given that If in question, note important, if in question it is given that tax rate income tax rate reduces or increases to X amount, to X percentage, always to compute DTA or DTL, you are going to use balance sheet approach only. Why? Because in income statement approach, P&L approach, you have to make some adjustments. So it's difficult for me to make you understand that adjustment. So simply, if in question it is given that the income tax rate increases or reduces to X amount, always you have to compute DTA, DTL using the balance sheet approach. Okay, so number one. Now I want to know that I already know that in my P&L, this value is eventually going to be transferred. But what is going to be the presentation? So presentation is important. So presentation in your P&L. So when you are going to present in your P&L account, so profit and loss account presentation. One, two, three, four. You have to start with taxes payable. In this case, we have only having DTL. So plus change in DTL minus change in DTA. And this is going to be your income tax expenses. Okay. Now taxes payable. Taxes payable means what is the figure as per taxation. So taxes payable are 4K, 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 20K. 4K, 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 20K. So change in DTA 0, 0, 0, 0. Now change in DTL. At the starting of year, you are having 0 DTL. It has been increased to 4K. So what is increase? 4. Next year 4. Next year 4. And what is the increase for the last year? That is negative 12,000. 4K, 4K, 4K. And then negative 12,000. So if I put here 4K, 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 negative 12,000. Now your answer is 8, 8, 8 and 8K. Now my question is, this is the answer, this is the value which will be transferred to your profit and loss account. Now my question is very simple. This tax rates will keep on changing. Now where these tax rates are decided? So first your finance minister has to present a budget. In that budget, the statutory tax rates in the country are going to be proposed. So last year the tax rate in our country was somewhere close to 34% over corporates, and eventually it has been reduced to 25%. And this year again our finance minister keep that rate constant to 25. Okay, so now the taxes to be paid by company, where they are discussed. So first finance minister will propose a budget. That budget will pass in Lok Sabha and Rajya Sabha, and eventually it will become an act in your country. Now my point is very simple. That means in a simple way, these tax rates will keep on changing. Earlier, means around 2 years back, the tax rate in your country was 34% over corporates. Now that rate has been reduced to 25%. Okay, and the probability that may change in the next year as well. So now think that DTA DTL amount is nothing but dependent upon tax rates. So if the tax rate will change, eventually DTA and DTL value will change. Now my question is, what will happen if tax rate increases? So double star. So if tax rate increases in this particular case, for example, tax rate increases in second year. Now what will happen to your DTA, DTL? Yeah, what will happen to your expenses? Now if tax rate increases, in this case it was 40%, let us assume that it has increased to 50%. So my first question, what will be impact over taxes payable? If tax rate increases, taxes payable will increase. Okay. DTL value. Now how we have computed DTL? You have computed differences and multiply by tax rate. Now tax rate has increased from 40 to 50. What will happen to DTL? So DTL values will increase. Okay. Same wise, how we compute DTA? Difference multiplied by tax rate. DTA value will also increase. So if tax rate increases, taxes payable increase, DTL will increase, DTA will increase. Now my question is, what would be impact over income tax expenses? Now let us assume that there is a company where there is no DTA. What will be the impact over income tax expenses? Taxes payable increase, change in DTL increase. What will be impact over income tax expenses? Your income tax expenses will increase. Okay, will increase because how income tax expenses is made? Taxes payable plus change in DTL. If both these figures are increasing, eventually income tax expenses will increase. Now let us assume that there is a company where there is only DTA. So either it is going to be DTA or DTL. So assume that there is a company where there is a DTA. Now taxes will increase, taxes payable will increase, DTA will increase, but change in DTA is subtracted. So what will be the impact over income tax expenses? Your income tax expense will reduce. So again I repeat, what will be the impact of changes in tax rate? Let us assume that tax rates are increasing and company is having only DTL. So how we find out income tax expenses? That is taxes payable plus change in DTL, and this is going to be your income tax expenses. Taxes payable will increase, DTL will increase. As a result, income tax expenses will increase. Now assuming that company is having DTA, taxes payable minus change in DTA. DTA will increase. Now let us assume earlier DTA was 8, now it has become 14K. It has increased by 6, so this 6 has to be subtracted. So now as a result of increase in tax rate, DTA will increase, change in DTA is subtracted. As a result, income tax expenses will reduce. So important from the point of view of theory, but most important point is whenever in the equation it is given that the tax rate changes, always you have to compute DTA and DTL using the balance sheet approach. You have to find out the differences, and that difference you are going to multiply by revised tax rate. Okay, so friends, with this we have covered the difference on account of depreciation, and now I want to conclude some more points. So last conclusion, again testable, theory point testable, conclusion. If carrying value of asset as per accounts is more than tax base. So now if carrying value of asset as per accounts is more, that means expenses will be less, profits would be higher, you should pay more taxes to the government, you have paid less. DTA, DTL, in this particular scenario DTL created. Same wise, now we are talking about asset. This I have to prove with the help of example. if carrying value of liabilities as per accounts is more. So if this I have to prove, if value of liability is more, this means your expenses are more. Expenses as per accounts are more. Profits would be less. You should pay less taxes to the government. You have paid more. If you have paid more, then DTA is going to be created, and vice versa. So these 2 points are double star. So again I repeat. Now in the previous example, carrying value as per accounts. Carrying value as per accounts is more, DTL will be created. If carrying value of asset as per tax is higher, DTA is created. Same wise, if the value of liability is more, it means expenses are more, profits are less, you should pay less taxes to the government, you have paid more. So in that case, DTA is created. Now, class, since for this chapter we are not referring any sort of reference book, so it's very important that you have to thoroughly revise both these examples before proceeding to the next part. In the next part, I will be giving one example with respect to glasses and second with respect to liability. So difficulty level is going to increase. Okay, so it's very important that before proceeding to the next part, you should have a thorough understanding of what we discussed in this part. Okay, thank you. Now friends, I'm moving to third example. It is on warranty expenses. So example 3. Consider warranty, guarantees and associate expenses. Pre-tax income as per accounts includes an accrual for warranty expense, but warranty cost is not deductible for taxable income until the firm has paid an actual expenditure. Okay, now what is the meaning of this example? So now let us assume that there is a company, Maruti Suzuki, and today let us assume that Maruti made a sales of 100 rupee, and whenever they are selling the car they give a warranty, and let's assume that the warranty is of 3 years, and none of the claim for this particular years for this particular sales has been yet. So no claims, company has received no warranty claims as of now. Now my point is, you are selling the car today, okay, and you are giving a warranty of 3 years. That means still the customer has 2 years of time to claim warranty. Now my point is, based upon matching concept, though there is no claim as on date, based upon matching concept, you are making the sales today. So you have to make a provision as on date today. So today, no doubt that you have not received any sort of claims. But if sales has happened in this period, then provisioning has to be there. So now what Maruti is doing, so they have not received any claim, but based upon their past experience, they made a provision of, let us assume, 10 rupee. So they have reduced their profits by 10, and as per accounts, profits are 90, and company is ready to pay tax on this 90. Now whenever you are going to show this 90 profit to income tax department, they say that since you have not paid this expense in cash, since you have not incurred this, we are going to charge tax on this 100. So this is the conflict. Okay, now again we read. Pre-tax income as per accounts includes a accrual for warranty expense. That means you have created a provision, but warranty cost is not deductible until the firm has made an actual expenditure. Until unless you have not incurred that, income tax is not going to consider that particular expenditure. Okay, proceeding further. Now company has a sales of 5,000 for 2 years. The firm estimates that warranty expense will be 2% of the sales, and actual expenditure of $200 was in second year. So this amount you have incurred in second year. Tax rate is 40%, and you have to compute income tax expenses, taxes payable and deferred tax for year 1 and year 2. So it's an important one. Now, solution. First, let's prepare the financial statements or the income statement as per accounts. Year 1, year 2, your sales is 5,000. Assuming there are no other expenses, you made a provision for warranty. So provision for warranty 100. 4,900 is EBT. Tax rate is 40%. $4,900.4 1960, and now you are having 2940 1960 2940. So now let's understand how accounting works in case of as per the accounts, how the accounting is going on. Now, first year you made a provision of 100 rupee. So in your income statement, there is a warranty expense 100. So if you have paid this expense in cash, so ideally cash should reduce. So one way, this is an expense, and now cash should reduce. But company has not incurred this in cash. So now if you have not incurred that, now you have to create a liability. What is the meaning of liability? In future, I'm going to pay this particular expense. So now at year 1, this is the amount in your P&L, and you created one liability by the name warranty expense payable, and that amount is 100 rupee. Now second year again you made a provision for 100, and at second year actually you have spent 200. So now cash year 1, year 2, year 1, year 2. Now first you made a provision of 100. So the moment you made a provision of 100, now total liability has increased to 200, and eventually by the end of year 2 you paid this liability. So now what will happen? Now at the end of year 2 you paid off this liability. So liability paid off, liability will become 0, and eventually from your pocket there is an outflow of 200. So now how accounting works? In year 1, warranty expense to warranty payable. So though these entries are not important, but just to make you familiar with the concept. So 100 has been transferred, you created a liability of 100. At year 2, warranty expense to warranty payable, you created a liability of 100 again. Now cumulatively your liability is of 200, and in year 2 you paid this liability warranty payable to cash 200. So what happened eventually? Eventually in totality there is a liability of 200, and by the end of year 200 you paid this liability with the help of cash. Liability reduces and correspondingly asset reduces. So this is what happened in case of accounts. Now what income tax is saying? So now income statement as per tax. Year 1, year 2, sales 5,000. But now in reality you have incurred this expense in year 2. Now department says whenever you're going to incur that, at that time we are going to consider this for taxation purpose. So actually I have paid the amount on second year. Now 4,800, 5,000 and 4,800. Before we proceed, warranty expense as per accounts 200. Warranty expense as per taxation 200. Only difference is with respect to timing. Cumulative amount is same. These amounts are known as temporary differences. And over temporary differences we create DTA, DTL. Now 40%. This should be 2000, 3000, and now 4800 multiplied by 0.4, 1920, and final profits are 2880. Now important, this is the amount you should pay. This is the amount you have actually paid. Now please tell me DTA or DTL. You should pay 1960. You have paid more, 40 rupees more. Now if you have paid 40 rupees more, then it is going to create a DTA of 40 rupees. Same wise, in second year, you should pay 1960. You have paid less. Now you have paid less 1920. So how much you have paid less? 40 rupees. This 40 rupees first will knock off a liability. Knocking off the liability of 40. Now how much you are left with? Now you are left with DTA, DTL of 0. So now, I think I made a mistake, sorry. Now you have to pay 1690. You should pay more. You have paid less. So it will create a liability. First, you have to knock off the asset. In your book, there is an asset of 40. That means already you have paid 40 more to the government. Now you are paying 40 less. So that asset will knock off. Post that knock off, how much DTA, DTL is left? So we are left with 0. So my answer is DTA by the end of year 1, 40. DTA by the end of year 2, 0. You paid less. Now you paid less 40 rupees. But already you have paid 40 more in the previous year. So that will knock off. How much you are left with? Extra. That is 0. Now my point is, how accounting works in case of income tax in this particular case. So now in year 1, you have not made any sort of provision. You have not incurred any sort of cash expense. So have you created any sort of liability? You have not transferred anything to your profit and loss account. So now in case of income tax, we have not created any sort of liability at the end of year 1. Warranty payable 0. And in the second year, 200 rupees has been transferred to your profit and loss account, and you paid this amount using cash. Now my second point is, what is the liability that you created in taxation? So in taxation, you have not created any sort of liability. Your expense incurred in year 2 and you have paid that amount in year 2. So you have not created any sort of liability. Now I want to find out the same answer 40 using balance sheet approach. So before I jump to the balance sheet approach, let's understand. In case of accounts, first you create a provision of 100, then again 100. In totality, provision of 200 by the end of year 2, and finally you have paid this in cash. So first liability is 100 and then liability is 0. But in taxation, while calculating the profit as per taxation, you have not created any sort of provision. When you have not created any sort of provision, when you have not transferred anything to your profit and loss account, no liability is created at time 1. And in time 2, there is an expense of 200 which you have paid in cash. So again liability value is 0. Now you have to find out the answer using balance sheet approach. So now carrying value of liability as per accounts. So my liability at the end of year 1 was 100 and then 0. Carrying value of liability as per tax. So in taxation, you have not created any liability. You have not transferred anything to your profit and loss account. 0, 0. First, you have to compute difference. 100, 0. Multiply by tax rate, that is 40%. Now 40, 0. Now either it is a DTA or DTL. So important. Carrying value of liability in accounts is more. If liability is more, that means expenses as per accounts is higher. Expenses as per accounts is higher. If expenses are higher, profits are less. Profits are less, so you should pay less taxes to the government. You have paid more. Again I repeat. Carrying value of liability is more. If carrying value of liability as per accounts is more, that means expenses are more, profit are less. Profit are less, you should pay less taxes to the government. You have paid more. If you have paid more, DTA or DTL. So answer is DTA. Now, what was the accounting using in income tax? So in income tax, we have not transferred anything to our profit and loss account at time 1. So liability 0, cash 0. In time 2, you incurred an expense of 200 which has been paid with the help of cash. So your liability remains 0, 0. Whereas in case of accounts, we first created a liability of 100, increased that to 200, and eventually at the end of year 2, that has been paid off. So liability as per accounts, 100, 0. Liability as per taxation, 0, 0. Compute the difference, 100, 0. Multiply by tax rate, 40, 40. Now answer is 40, 0. That 40, 0 is nothing but DTA. So now I'm concluding. These are the concluding statements with a double star. If carrying value of assets as per accounts is more, this signifies that expenses as per accounts is less, profits as per accounts is more. You should pay, profit is more, you should pay more taxes, paid less. So answer is DTA, DTL. DTL is created. Important. Same wise, if carrying value of liability as per accounts is more, more liability means more expenses. Expense as per accounts is more. If expenses as per accounts is more, then profits as per accounts is less. You should pay less taxes to government, paid more. You should pay less, you have paid more. Now in this case, DTA is going to be created. Now my fourth example. Now my fourth example is with respect to losses. Now, before I jump to this example, my point is, let us assume I am having a partnership firm with one of my students where my share in profit is 70% and student name is Akash, his profit is 30%. So there's a partnership firm. My share is 70 and Akash share is 30%. So this year our firm earned a profit of 100 and now you want to divide this profits. So 100 belongs to both Vikas and Akash. Now what is the profits that belongs to Vikas? 70% of 100, that is 70, and 30 belongs to Akash. Now my point is, in the same manner, In the same manner, if our business has incurred a loss of 100, then 70 belongs to Vikas, 30 belongs to Akash. Or in simple words, losses are there, that means business needs 100 rupees. Out of that 100 rupees, 70 should contribute by Vikas and 30 should contribute by Akash. Is it correct? The answer is yes. If you are earning a profit, Akash has a right to take 30 rupees from the business. And if 100 rupees is a loss, then Akash should contribute 30 rupees to the business. Now my point is, let us assume that this is a company ABC and I am talking profit and loss account as per accounts. Year 1, year 2. And now my point is, in year 1, you incurred a loss of 100 rupee. And in year 2, you made a profit of 200. And this company is nothing but a profit sharing ratio. This company is nothing but a partnership firm with government. Now my point is, when at year 1, you made a loss of 100, 30% of your profits belongs to government, 70% belongs to the company. Now my point is, when you incurred a loss of 100, this government is going to pay you. This government is going to pay you 30. In practical life, does government comes to your home and pay this 30 rupees? Answer is no. But how it works in the practical life now? We have to discuss this. So in practical life, government is not going to give you 30 rupees and the business is nothing but a sort of partnership firm where we are having 70 and 30% belongs to government, assuming that the tax rate is 30%. Now my point is, government questions you that what is the purpose of this business? The purpose of this business is to make profits. I understand that today you have incurred a loss, but eventually the purpose of this business is to make profits and in the future it is going to make the profits. Now let us assume that in the future you made a profit of 200. Out of that 200, 140 belongs to Vikas, 60 belongs to government. Now government says, instead of paying 60 rupees in year 2 and demanding 30 at year 1, pay me net 30 rupees at the end of year 2. Now this is the way how government works. Pay me 30 rupees at the end of year 2. How 30? Incurred a loss of 100 at year 1, made a profit of 200 at the end of year 2. So combined profits is 100. 70% belongs to company, 30% belongs to government. Now government is saying, pay me, instead of demanding 30 here and 60, I have instead of demanding 30 at year 1 and pay me 60 at year 2, pay me net 30. Pay me net 30 at the end of year 2. So this is known as set off. So first set off the losses and pay the taxes to the government. After setting off the losses, I'm left with 100. This 100 belongs to two persons, equity and government. 70 rupees equity and 30 rupees government. Now in practical life, I'm going to pay 30 rupees to the government at the end of year 2. This is how income tax works. Okay. So now let's prepare first in accordance with income tax. Now as per income tax. Year 1, 2. You made a loss of 100 and then a profit of 200. Assume that tax rate is 10%. My point is, will government contribute 10 here? Will government contribute 10 here? This 10 belongs to the government. Does government contribute 10 here? No. Government is going to contribute how much? 0. So this entire losses belongs to equity. And now in year 2, your combined profits are 100. This combined profits, how much you are going to pay to the government? You are going to pay 10 to the government. You are left with 190. This is how the income tax department works. Now, what should be the figure as per accounts? The accounting is very simple. If I have incurred a loss of 100, that 100, 10% belongs to government. That means 10 rupees belongs to government, 90 belongs to equity. Normal bifurcation. Tomorrow, if there is a profit of 10%, 20 belongs to government and 180 belongs to equity. Now my first point. Collectively, as per accounts, what is the taxation expenses? Collectively, 10. And what is the value as per taxation? 10. How much profits you are earning collectively? 90. Is it a temporary difference? Yes. And over temporary difference, what we are going to create? We are going to create DTA, DTL. Now, important. The important point is, now you have to read like this. You have a right, or you should receive 10 rupee from government. You should receive 10 rupee from government. You received nothing. Now my point is DTA, DTL. You should receive 10 rupee from government. You received nothing. So it's going to create a DTA of 10 rupee at the end of year 1. Now, you should pay, it is a positive value, you should pay 20 rupee to the government. You actually paid 10. You paid 10 rupees short. Already there is an asset. That asset will turn to 0. Now already you have a right to receive 10 rupee from the government. You should pay 20 to the government. You have paid 10. And 10 you have set off the DTA. Now how much DTA is left? So DTA is left equal to 0. Now important. That means if in the books of company DTA is appearing, or my next point is, if a company is a one loss making, if company is loss making entities, then in those company cases you will find DTA. Now, if I talk about a bank like Yes Bank, which incurred substantial losses in FY 20. So there's some corporate governance issue because of which bank incurred substantial losses in FY 20. So in the balance sheet of Yes Bank, you will find DTA or DTL. So high probability, since the company is making losses, you will find DTA. And this DTA will reverse. That means this DTA will become 0 only if in the future there are sufficient profits. Now, for example, in the previous example, there's a loss of 100. You created a DTA of 10, and this DTA will become 0 only if in the future there's a profit greater than equal to 100. Okay, that means reversal of DTA is dependent upon future profits. Now let's go through the balance sheet of Yes Bank first. So now this is the balance sheet of Yes Bank, and Yes Bank has a DTA of, as on 31st March 16, these figures are in million. So if I turn into crore, so Yes Bank is having a DTA of 477 crore, which has substantially been increased to 8,281 crore. Now my point is, the meaning of DTA is, in future you have to pay lower taxes. In future you have to pay lower taxes, but that lower taxes will only be possible if there is sufficient profits. That means profit is any value greater than 100. Now my point is, what if in the future the management estimates that profit will be any value less than 100? Now here is the point where IFRS and US GAAP differentiates. So now, if you want this DTA to become 0, in the future your profits should be any value greater than equal to 0, greater than equal to 100. Now, if you think that now the demand for your product has declined and you will be unable to generate a profit of greater than equal to 100 in the future, now as per IFRS. So before giving me any answer, keep in mind prudence principle. Now if you think that in the future you will earn pre-tax profit EBT of 30 rupees only in future. Now IFRS says that keeping in mind the principle of prudence, today we are going to create DTA of 30% only. That means today we are going to create a DTA of 30% of 10, that is equal to 3 only, which is very logical. Okay, so we will create a DTA of 3 only. Now what US GAAP says, today we will create a DTA of 10. That means today we are going to create full DTA, and eventually when company is unable to generate that, when tomorrow that much profit company is unable to generate that, then we will reduce DTA by 70%. Now tomorrow you are unable to generate that figure of 100, you will generate only profit of 30, so we will reduce DTA by 70%, and this concept is valuation allowance. So now how IFRS and US GAAP differs? So important, where you will find DTA, those companies who are incurring losses, in that balance sheet you will find DTA. For DTA to reverse, there should be a sufficient profits in the future. Now you think that in the future I'm going to earn only 30%. Only 30% of DTA is allowed as per IFRS. But US GAAP says we will book DTA of full amount. And in the future when you are unable to generate a profit of 100, whatever is shortfall, we are going to reduce DTA by that amount. And that amount is nothing but valuation allowance. So it is very much similar to impairment charges. So you will reduce your asset and club the amount into your income tax expenses, similar to impairment of fixed charges. When there's an impairment of fixed charges or impairment of inventory, you will reduce the inventory value and club this expense into your COGS. Same wise under US GAAP, we will reduce our DTA and club the expense into our income tax expenses based upon prudence principle. So this is the one point of difference between IFRS and US GAAP. Now my point is, so let's go through the theory first. So difference between IFRS and US GAAP. DTA. Recognize if payable that sufficient taxable profits will be available to recover the tax. That means in the future you are going to earn more than any value greater than 100. Now if you think that you are going to earn only 30 rupees, 30%, DTA will be created only to the tune of that 30% only. Now US GAAP, recognized in full and then reduce if more likely than not that some or all of the tax asset will not be realized. That means in the future when you eventually have earned 30 rupees and now you're turning into bankruptcy, that 70 rupees will be reversed, and this concept is known as valuation allowance. So point to be noted. Valuation allowance is a concept that exists under US GAAP. It is nothing but similar to impairment. So this is one point of difference between US GAAP and IFRS. Now my point is, important point, what is the meaning of DTL? If DTL is appearing, what is the meaning of this? So now, if there is a DTL, so when DTL will be there? Now my point is, in a country there is a problem of pollution. Okay, so now Indian government will likely to promote. So Indian government will likely to promote manufacturers of electric vehicle. And now to promote the manufacturers of electric vehicle, what government does? Government says that whatever the expenditure you are going to incur for this plant, that will be allowed as depreciation. That will be allowed as depreciation at the end of year 1. Now, what will happen because of this? Important. Now, suppose you are manufacturing a plant. That plant in totality has a life of 20 years. In totality, you are going to incur 1000 crore. 1000 crore divided by 20. You are going to charge 50 rupees, 50 crore as depreciation every year. Now, government is saying, whosoever manufacturer will install electric vehicle plant in a country, he will be allowed depreciation of entire plant and machinery in year 1. That means in year 1 itself, while computing your tax liability, what income tax department will do? He will compute your EBITDA. Suppose your EBITDA is 1000 crore. Your EBITDA is 1020 crore minus depreciation, that is 1000 crore. And now you have to pay taxes only on this 20 rupees. Otherwise, in case of normal manufacturer, he has to pay, his profit is 1020, depreciation of 50, he have to pay taxes on 970. Now to promote the manufacturer of electric vehicle, what government is doing, they are allowing the depreciation on the entire vehicle, on the entire plant in year 1 itself. It will have a benefit of, now a company like Tesla, a company like Tata Motors will pay lower taxes to the government. So in order to promote, they are allowing the depreciation. Now my point is, ideally, I should charge depreciation over 20 years. I should charge 50 for 20 years. But government is allowing the depreciation in year 1 itself, because of which DTA or DTL will create. Now important. You have to pay more taxes to the government. You are paying less. DTL will create. And this DTL will keep on reducing year on year, and it will turn to 0. That means in those books, in the companies where we are getting DTL, that DTL signify that government is giving them some sort of benefits. Okay. And that DTL will reverse eventually if company stops expansion. Okay. Now, when this DTL will become 0, so by the end of 20 years, assuming that you have not installed any new other plant, this DTL will become 0. But what will happen if a company like Tesla, if a company like Tata Motors are keep on expanding, every other day they are starting up with a new plant. One in Karnataka, one in Delhi, then in Gurgaon. They keep on installing the new plants. Now my point is, DTL value will reduce, or DTL value will keep on increasing. Now DTL value will keep on increasing. It will reverse only if you stop expansion. But a company like Tesla, company like Tata Motors are continuously expanding in the country. If they are continuously expanding, this DTL will keep on increasing. Now my point is very simple. if DTL are keep on increasing, you will, as an analyst, you will consider this as a liability or you will consider it as a equity. Now, important. When DTA will reverse when in the future there are profits. Okay. When liability will reverse when you stop expansion. When you stop expanding, that is the time at which DTL will reverse. And if a company is not expanding much, then we are going to consider DTL as the liability. That means eventually you have to pay more taxes to the government. But a company like Tesla, Tata Motors, which are continuously expanding, DTL will reduce, DTL will increase. And if DTL will increase, now you're going to consider it as liability or equity, where the meaning of this equity is that in the future, for a foreseeable future, let's say for 10 years, 20 years, you're not going to pay this amount to the government. We are going to consider it as liability or equity. Liability means you have to pay. Equity means need not to pay. So do you think that it will turn into zero? Answer is no. Now the classic example is Reliance Industries. So in case of Reliance, again, Reliance is a company which is into telecom business, and to promote the telecom, government has some favorable taxation policy. So let us assume that anyone who invests in telecom, he would be allowed depreciation in year 1 itself, because of which DTL is there in the books of Reliance. But for this DTL to reverse, now Reliance should stop expanding. Then only this DTL will reverse. Now what happened? A company like Reliance, first they made huge investment into 3G, 4G, 5G. And now let's assume 6G, 7G, 8G. Now are they allowing this DTL to reverse? Answer is no. Now as an analyst, I'm going to consider this DTL as equity only. Now let's have a look over the balance sheet of Reliance as well. Reliance Industries. So in the balance sheet of Reliance, you will find DTL, and we as an analyst, as an investor, we want that higher the DTL, more happier we are. Okay, so we want that there should be a DTL. Now DTL. Okay. Now look very carefully. So 5 years ago, there was a liability of 20,000, then 26,000, 29,000, 50,000 and 54,000. So in case of Reliance, this DTL is continuously increasing. So while performing the valuations, we are going to consider this not as liability but as equity. So important point. Now the important point is, if DTL is expected to increase in the future on account of continuous expansion by the company, we are going to treat DTL as an analyst. As an analyst, we are going to consider as an analyst, we are going to consider DTL as equity. Important, double star. Next point, again double star. If DTL is expected to reverse in future, this will possible only if you stop expanding. So if DTL is expected to reverse in future, we will consider it as DTL as liability. Next double star point. Under IFRS, DTA created today will reverse. That means will turn 0. Will reverse only if there are sufficient profits in the future. Under IFRS, DTA is created only to that extent. Under IFRS, DTA is created only to that extent which management thinks they will recover in future. Suppose today company incurred a loss of 100 rupee and management anticipates that in the future we will earn only 30 rupees as profits. Then DTA of 30% only is created. So this is under IFRS. Under US GAAP, DTA is created 100% and in the future when company does not have sufficient profits, then DTA balances reduced and amount is transferred to income tax expenses. This concept is known as valuation allowance. Similar to impairment of inventory and fixed assets. Okay, so now friends, whatever these notes are, all these points are double star. Okay, now I'm proceeding to my next example. So this is the last one. Okay, so we have covered almost entire chapter. Okay, now friends, I'm moving to next concept, that is permanent difference versus temporary difference. Now, all the questions that we have solved, in totality, the amount to be transferred to profit and loss account as per accounts and taxation, the cumulative amount was same over the period. Okay, the only difference was only of with respect to timing. Such differences are known as temporarily, and over temporary differences, DTA and DTL is created. Okay, now what do you mean by permanent differences? So permanent differences are those differences between accounts and taxation that are not expected to reverse in the future. So these are the differences that are not expected to reverse in the future. Now, for example, now there have been some defaults on the part of the company. So there is a company ABC, and there is some income tax default, or the company has defaulted on account of some import-export rules, because of which company has to pay a penalty of 10 lakh rupees. Or for example, company has copied some of the features of their competitor. They have breached some copyright norms, because of which they have to pay a penalty of 1 crore. Okay, so some penalties are involved. Now my point is, will such types of, these are business expense, no doubt. Eventually you are going to transfer this expense to your profit and loss account. But while computing your profits, will income tax department allows you to transfer these expenses to your profit and loss account? Answer is no. So no doubt, from the point of view of the business, these are expenses. So eventually, to compute your net profit, you're going to transfer these to your profit and loss account. But while computing your profits for the taxation purpose, income tax department will disallow these expenses. That means it will not allow to transfer these to your profit and loss account. Now my point is, okay, today you're not allowing, then at some future date, are you going to transfer this? The answer is no. So these differences are known as permanent. And point to be noted, over permanent differences, DTA, DTL is not created. Now let us assume that there's a company, Samsung, and Samsung copies some of the features of iPhone, because of which they have to pay a penalty of 20 crore. Are you going to transfer this to your profit and loss? Answer is yes. But this expense is tax deductible? No. Forever no. Now, over permanent differences, DTA and DTL are not created. So let's go through the example. For example, income or expenses that are not allowed by tax legislation. For example, paying up the penalties. So these are not allowed as per the income tax. Same wise, now let us assume that so country was suffering from COVID, and there is an urgency of to have COVID medicine. Okay, so now to promote that, the pharma companies should manufacture as soon as possible the medicine. Now let us assume that income tax department gives some sort of benefits. For example, if you incurred an expense of 10 lakh rupees, we will give you a credit of 12 lakh. Now my point is, this additional 2 lakh credit income tax department is giving. Now as per IFRS, what is your expenditure? 10 lakh. Eventually over the period you are going to transfer this 10 lakh to your profit and loss account. But my point is, income tax department is giving you a credit of 2 lakh additional. Will that 2 lakh will eventually be transferred to accounts as per the IFRS? Answer is no. So now these are permanent differences. So second example of permanent difference is tax credit for some expenditure that directly reduces taxes. So both points you have to remember. Some expenses are not allowed by the income tax department, and some tax credit that directly reduce the taxes. For example, again, if you do research, now in totality your expenditure is, let us assume, 20 lakh rupees. Government says we will give you a deduction of 150%. 150% means in totality you have incurred 20, we will allow the deduction of 30 lakh. Now this additional 10 lakh credit is permanent differences, and over permanent differences DTA, DTL not created. So point to be noted. Expenses that are not allowed by the income tax department. 1. Tax credit for some expenditure that directly reduces the taxes. So these 2 points you have to remember. Now my next level is, now whenever in question it is given that tax rate increases or reduces, you have to find out revised DTA, DTL. Okay, always you are going to follow example, tax rate increase or reduce. Always you have to find out the amount of DTA or DTL using balance sheet approach. Now, for example, you purchase a machinery for 24,000, where as per accounts, the depreciation for year 1 is 8,000, year 2 8,000, year 3 8,000. But depreciation as per tax authority is 16,000, 5,666 and 2,334. So just now let us assume this is the case, and in year 1 tax rate is 40%, year 2 tax rate is 35%. So you have to find out the amount of DTA, DTL at the end of year 1 and at the end of year 2. So now we are not going to follow P&L approach. We are going to follow the balance sheet approach. Now carrying value of asset as per accounts, year 1, 2, 3. Now in totality 24,000. You have charged 8,000 as depreciation for year 1. So what is the carrying value at the end of year 1? 16K, 8K and 0. Tax base. Purchasing machinery for 24, 16,000 depreciation charge. So you're left with 8K minus 2,334 and eventually 0. First compute difference. Difference is 8,000 and then 566 and 0. Multiply by tax rate. Tax rate is 40% and 35%. Now either it is going to be DTA or DTL. $3,200 1983. Okay, now DTA, DTL. Now value as per accounts is more. That means expenses as per accounts is less. Expenses less, profit more. Profit more, you should pay more taxes to the government, you have paid less. Now if you have paid less, then it is going to be DTL. So what is going to be my revised DTL? So DTL at the end of year 1 is 3,200 and at the end of year 2 is 1983. Now the point to be noted, whenever in question it is given that tax rate increases or reduces, you have to compute the DTL value only the balance sheet approach. Okay, then next. Okay, now every company will have to prepare a reconciliation statement. Now, in our country, effective tax rate in FY20 was suppose 34%. Okay, this is the tax rate applicable over the companies. But now my point is, do you think like company like TCS will pay tax rate equal to 34%? Now how TCS earns money? Okay, so TCS is a company where majority of the revenue comes from export of services. So company export IT services, they deliver IT services to US companies, and now majority of the revenue is in the form of export services. So if company is providing export services, eventually dollar will be coming to the country. Now my point is, to promote this, government will charge higher taxes or lower taxes. Government eventually will charge lower taxes. Now company, you have to prepare a reconciliation statement where you have to provide the applicable tax rate in the country is 34%. How come you are paying 18 or 19% taxes? So you have to reconcile statutory tax rate versus effective tax rate. So now I have downloaded the annual report of TCS. Now let's go through page number 231. So number 1, total tax expenses recognized in the current year. So total tax expense is nothing but summation of current tax and deferred tax. What is the meaning of current tax? This is income tax payable, and deferred tax was change in DTA or DTL, whatever the value that we're computing. Now if I add up, this value will eventually transfer to my profit and loss account. Okay, so this value. Now the statutory income tax rate in the country is 34.94% over corporates, and company pre-tax profit is 42,248 crore. So if I multiply these two figures, ideally a company like TCS should pay income tax of 14,764 crore to the government. Okay, but how much actually it has paid? It has paid only 9,800 crore. Now question arises, when your liability should be 14, how come you are paying 98? Now the company is explaining the reasons. Now the main reason is tax holidays. That because of that tax holiday, company is able to save tax of 4,900 crore. And now it has given the following explanation with respect to the tax holidays. Now my point is important. Why this reconciliation statement is important from analyst point of view. Now tomorrow, eventually in level 2, you have to learn valuations. While computing valuations, you have to forecast the profits, you have to forecast the tax, you have to forecast the profits, you have to forecast the cash flows. Now the cash flows would be the one after paying taxes to the government. And in case of, no doubt, in my country the tax rate is 34.94%. But company like TCS will pay this much of rate? Answer is no. So while computing the cash flow of TCS, more important, the rate would be 98, would be close to 18 to 20% rather than 34%. Okay, so now tomorrow you have to learn valuations. You have to find out the cash flows. So while computing that cash flow, what tax rate we are going to use, that which company is actually paying, not the statutory tax rates. Same wise, if I talk about a company like Tata Tea. Now Tata Tea earns majority of the revenue from their tea business. Again, tea is an agriculture business. So again, income tax department have some advantages to the agriculture business. So again, the rate of 34.94% may not be applicable. So these are the statutory rates. Now depending upon your business, you have to find out historically what tax rate company is paying, and that tax rate we are going to assume in our projections. Okay, so important point, you have to provide the reconciliation statement. So this reconciliation statements help us understanding how come you're paying less taxes against a statutory tax rate of 34.94. Now, in India, the statutory tax rate, now it has been reduced to 25%. So in FY20, the rate was 34.94%. But how much TCS has paid? TCS income tax expense is 9,801 over a pre-tax profit of 42,248. So how much tax TCS has paid? How much percent? That is close to 23%, whereas the tax rate in the country is 34.94. Now that is because of some tax holidays which are available to the company. Okay, so this reconciliation is required. Now next, now in long-lived assets we learn that there's a concept of, under IFRS, there's a concept of upward revaluation. So whenever you are doing a upward revaluation of asset, it is allowed, but that should not be routed through P&L. You are going to create a liability. That liability is revaluation reserve. So now, for example, you purchase one machinery, you have one land for 100. Now you want to show that at 110. So revaluation reserve 10 rupee, and that land plant is equal to 10. In this way, balance sheet tallies. Now, whatever the DTA or DTL is arising on account of this additional 10, that would be directly adjusted to revaluation reserve. So again, there's one numerical in your C book, but that is a very comprehensive and not testable. Okay, so simple, you have to remember one theory point, that on account of this additional 10, whatever the DTA or DTL is going to be there, is going to be created, that will be adjusted directly in revaluation reserve. Theoretical point, and from the point of view of US GAAP, this point is valid. Answer is no, this point is not applicable. So quickly jumping to difference between IFRS US GAAP. So you have to remember two differences. Now, whenever there is an upward revaluation of fixed assets, so if there is an upward revaluation of fixed asset, it is directly recognized in equity, under revaluation reserve. Corresponding point under US GAAP not applicable. One more point, DTA recognition. Under IFRS, DTA would be recognized only to that extent that you think you're going to earn in the future. But under US GAAP, you're going to recognize DTA in full. Tomorrow, if you have not earned that much, then yes, you have to reduce the DTA amount by impairment charges. That impairment is nothing but valuation allowance. An important point, one more important point that we skipped that time. One more important point is reversal of valuation allowance is permitted. Reversal of valuation allowance, that means impairment charges, is permitted under US GAAP. This is the only exception where the reversal is permitted. Throughout US GAAP, no reversal is permitted. This is the only case where reversal is permitted. Now my point is, when reversals would be permitted. So now, whenever you start incurring a loss, okay, now government says that you are incurring a loss, now you have to earn profit to set off the losses. Okay, I will allow you a time of 8 years. So in our country, by law, maximum you can carry forward your losses, that is for 8 years. Now my point is, let us assume that you incurred a loss of 100 rupees. Now maximum how many years you are going to carry forward it? For 8 years. 1, 2, 3, 4, 5, 6, 7, 8. And still, let us assume that collectively during this 8 years, you have only earned 90 rupees. So how much DTA is reversed during this 8 years? Only 90%. And now at the end of 8th year, 10% of DTA should be reversed, okay, because you are unable to earn that. Now my point is, if government extends this period of 8 years in the future, now what will happen? So if government extends this period of 8 years in the future, it will lead to reversal of valuation allowance. So does reversal of valuation allowance is permitted under US GAAP? This is the only exception where reversal is permitted. Okay, so with this, friends, we have covered this chapter. Now in totality, I'm having 26 problems. So these problems, I won't suggest that solve yourself. So now both of us would be solving this problem together. Okay, so now before I jump to these problems, a quick revision. Now I understand that the method to compute profits as per income tax is different from IFRS. Okay, but the amount of taxation that is going to be transferred to your profit and loss account, that is in accordance with IFRS only. But government will collect the amount. We must pay that amount to the government, which is as per the income tax authority. Now whatever the difference is, for example, you have to pay more, you have paid less, then DTL will be created. Similarly, if you have paid more than what is required, then DTA is going to be created. Now important point, DTA, DTL would always be computed over the permanent differences, where the meaning of permanent DTA, DTL would always be created over temporary difference. What is the meaning of temporary difference? That means collectively the amount which is transferred to the P&L is same. The only difference is of timing difference. Over permanent differences, DTA, DTL are not created. Then there are two approaches, balance sheet, P&L. You are allowed to follow whichever method you want. But if it is specifically given that the tax rate are increasing or reducing, then you have to use balance sheet approach only. Another important point, if carrying value of asset is more than tax base, it will lead to carrying value is more as per accounts. That means expenses will be lower, profit high, taxes to be paid higher, you have paid less, DTL. Same wise, if carrying value of liability is higher as per accounts, liability is higher, that means expenses are higher, profits are lower, you should pay lower taxes, you have paid higher, it will lead to DTA, and vice versa. Okay, then under what is the difference between then the concept was of DTA. DTA would be only there when you are incurring the losses. Now if you are incurring the losses, DTA is there, then you should earn the future profits to get this DTA to reverse. Now my point is, under IFRS, you are only required to book DTA only to that extent that you anticipate you are going to earn in the future. But US GAAP says recognized in full. If unable to recover, then you're going to reduce by valuation allowance. The moment you're going to reduce your assets, your DTA by valuation allowance, this expense will be clubbed into your income tax expenses. Similar to impairment, valuation allowance is nothing but impairment charges. And reversal of impairment charges allowed? Yes, in the future if circumstances changes, you started earning profits or the extension of a period is there, then yes, it is permitted to reverse the DTA, to reverse the valuation allowance as well. The next important point is, you have to provide me reconciliation statement. Reconciliation helps in why company is able to pay high or low taxes. So in case of companies which are involved in export of goods, always you are going to find the tax rate to be pretty lower than the statutory applicable tax rates. Okay, so these are the points. Okay, now when DTL will continuously increasing. So if DTL is continuously increasing, that means you're continuously expanding. You're not allowing this DTL to reverse. This DTL will reverse if you stop expansion, but you're continuously expanding, DTL is continuously increasing. If it is continuously increasing, we are going to treat it as equity. If it is reducing, we are going to treat it as that liability. That means one day we have to pay. And if we are not confident with respect to timings and the reversal of this DTA, This is neither asset, this is neither liability nor equity. Okay. So this was the broad revision. Now I'm jumping to the question parts. Okay. So quickly we have to answer together. Now, question number 1. Using straight line method of depreciation for reporting purpose and DDP method for taxation purpose will most likely result in. So question number 1. For accounts, you're using SLM. For taxation, you're using DDP method. So now if as per SLM, depreciation expense lower, expenses lower means profits higher. Profits higher means you should pay higher taxes to the government, but you have paid less. DTA, DTL. So DTL is created. Now look at the option. Will most likely result in valuation allowance incorrect, deferred tax asset incorrect, DTL. It is nothing but a temporary difference. Answer is yes. Answer is C. It is nothing but a temporary difference. Now in early 2018, company must pay tax authority £37,000 on its income it earned in 2017. So this is the amount that as income tax authority has computed, which you should pay to the tax authority. So it is the amount computed as per the tax authority. Now this amount is nothing but taxes payable. Must pay the tax authority. So whatever the tax authority is demanding, that will be as per Income Tax Act. Okay. Income tax expenses reported on income statement equals taxes payable plus change in DTL minus change in DTA plus change in DTL minus change in DTA. Answer is C. Analysts should treat DTL that are expected to reverse. DTL that is reducing. Analysts should treat DTL that is reducing, that are expected to reverse, that are reducing. It will be known as liability. Deferred tax liability should be treated as equity when they are not expected to reverse. They are continuously increasing on account of continuous expansion. When both the timing and the amount of tax payments are uncertain. If this is uncertain, then I'm not going to treat like either liability or equity. When accounting standards require recognition of an expense, that means as per accounts you are allowed to transfer the expense, that is not permitted under tax laws. So this is permanent difference. Over permanent difference, no DTA detail is created. Answer is C. Then this is the second point of permanent difference. Certain expenditure that results in tax credit that directly reduces taxes. Now what is the meaning of this? For example, you incur some sort of research expenditure where you incur 10 lakh rupees, but government is giving you a deduction of 150%. So they're talking about additional 50%. When certain expenditure results in tax credit that directly reduces taxes, the company will most likely record a. So this is an example of permanent difference. Tax credit for some expenditure that reduces taxes. So it is an example of permanent differences. Over permanent differences, no DTA, DTL is created. Okay. 9. When accounting standards required an asset to be expensed immediately. Okay. That means as per accounts. Question number 9. As per accounts, let us assume the value is 100 rupees. So as per accounts, expenses 100. but tax laws require the item to be capitalized and amortized. So let us assume as per taxation, the expense is 50 rupees. Okay. Now the company will most likely record a, okay. So as per accounts, expenses are more. If as per accounts, expenses are more, profit less, you should pay less taxes to the government. You have paid more, you should pay less, you have paid more. Now if you paid more taxes than required, then DTA is created. Answer is A. Then 10th, a company incurs a capital expenditure that may be amortized over 5 years for accounting and 4 years for taxation purpose. The company will most likely record. So let us assume that we purchase a machinery for 10 rupee and accounts you're going to amortize in 5 years. So as per accounts, depreciation is 2 and as per taxation, depreciation is 2.5. So as per accounts, expenses are lower. As per accounts, profits would be higher. You should pay more taxes to the government. You have paid less. If you have paid less, then answer is DTL. Answer is B. 11th, company receive advance payment from a customer that are immediately taxable but will not be recognized for accounting purpose until the company fulfill its obligation, will most likely be recorded as. Now 11th. Now for example, today I receive an advance from TWSS. So I receive an advance of 1 crore from TWSS for preparing CFA Level 1 video. Now as per accounts, until unless these videos are not ready, you have not fulfilled your obligation, you are not allowed to book this sales. So what I'm going to book is as advances. But now income tax department says, because you have received 1 crore rupee, I want tax on this particular 1 crore. So now let us assume that 31st March 2021, during this period I received 10 crore. During this period I received 1 crore from TWSS for preparing CFA Level 1 videos. Okay, but this video is not completed here. They are still under preparation. So my obligation is not over. So I'm not allowed to book sales here. Okay, I'm not allowed because my obligation is not over. Okay, but now what department is saying, I want tax on this 1 crore. Okay, now as per accounts, what is the tax? 0. But tax authority is charging, for example, 40 lakh rupees, 40% tax rate. You should pay 0. But you have paid 40 lakh rupees. Now my point is DTA or DTL. You should pay 0. You have paid more. If you have paid more, then DTA is created. Now in the future, when I'm going to book sales here in FY22, I'm going to book a sales of 1 crore. Then at that time, I would not be paying any taxes to the government. So DTA, that means in the future, your tax liability is going to reduce. So question number 11, the company will most likely record a DTA. Next, so for question number 12 to 14, now this is similar to, this is your EBT, and company is operating 2 countries, so one foreign, one US. So these are your EBTs, year 1, 2, 3, and then they have provided you with income tax expense. So this is the amount that eventually transferred to your P&L account. Okay. Now what question says? So now they divided into 2 parts, income tax, current and deferred. Okay, so I'm least bothered with the bifurcation. Okay, now question number 12. In year 3, company recorded a provision for income taxes closest to. Now what is the meaning of this line? First understand this. So the meaning of this line is amount of expense transferred to profit and loss account. That means, in simple words, amount of expense transferred to profit and loss account as per IFRS. That is, in simple words, question is demanding what is your income tax expenses. Now, if I simplify this table, so let's talk about year 3. In year 3, my EBIT is 204,861. Provision for taxes is equal to 54,144, and remaining, so this is EBT, and remaining is EAT. So 204,861 minus 54,144. This is 150,717. Now try to answer question number 12. In year 3, income statement recorded a provision for income tax closest to, that means what is the amount transferred to your P&L account. So the amount that is transferred to P&L account is 54,144. Now the company's effective tax rate was highest in, so this we have covered for year 3. Same wise compute for year 2. Now year 2 your profit was 189,167. Over this you have paid a tax of 56,860. So this is 132,307. Now you have to compute effective tax. So effective tax rate is equal to income tax expenses divided by EBT. So how much effective tax you are paying? So in year 3 you are effectively paying how much tax? This much on a profit of this. You are paying an effective tax of 26.429%. In year 2 you have paid a tax of 30%, and in year 3 you have paid a tax of, in year 1 you have paid a tax of, your total income is 154,733. Over this you have paid a tax of 44,179. So in percentage terms this value is 28.55. So in which year the effective tax rate is highest? That is in case of year 2. Now compared to company's effective tax rate on US income, effective tax rate on foreign income was. Now question number 14. Year 3, year 2, year 1. So first consider your EBT from US. So now my EBT from US is 88,157, then 75,658 and 59,973. Then from foreign markets EBT is 116704, 113509 and 94760. Now total taxes on US income. So total taxes on US income. So federal this, and this amount. So you have to add up. Okay. So taxes is equal to 30,632 minus 4752. Value is 25,880. Then for year 2, 22031 plus 5138. Answer is 27169. And for year 1, 18959 plus 2336, that is 21295. You have to compute EAT. Need not to compute EAT, just compute effective tax rate. So effective tax rate, that is B divided by A. 25880 divided by 88157, 29.35%. Then 27169 divided by 75658, 35.91%. Then 59973, 21295 divided by 59973, 35.50%. Now taxes on foreign income. That is 28140 plus 124, 28264. Then 27961 plus 1730, that is 29691. And last one is 22263 plus 621, this is 22884. Effective tax rate, (24.14%). 26.15%, 24.218%. Now you have to make a comment. Question number 4. So it was B. Okay. Compared to company's effective tax rate on US income, effective tax rate on foreign income was. Now this is the effective tax rate on foreign income. So effective tax rate on foreign income is, in comparison to this, so income tax on foreign income is less in comparison to US income. So answer is A. Now in year 1 it was 24, 35, 26, 35, 24, 29. So it is lower in each of the presented years. Answer is A. Okay, now proceeding further. 15th, company prepared its accordance with US GAAP. In year 3, company discloses a valuation allowance of this and deferred tax asset of this. Year 2, valuation allowance of ITNA, DTA of ITNA. The change in valuation allowance most likely indicate that 15, year 2, year 3. So your DTA, that is gross DTA, was 17325. In year 3 it was 19201. Valuation allowance 1325 and 1101. So this is net DTA. 17325 minus 1325, that is 16,000. 18,100. Now the changes in the valuation allowance indicate that. Okay. Now your valuation allowance is reducing. Okay. Now valuation allowance is reducing means reversal of valuation allowance. So you are reversing your impairment charges. Reversal of valuation allowance. Now what does this reversal signify? Important. 15th. Deferred tax liability was reduced in year 3. This is incorrect. There is no DTL in the question. Expectation of future earning power has increased. Expectation of future earning power has decreased. Now in your case, valuation allowance is reducing, or valuation allowance reducing means there is a reversal of impairment charges. Reversal of impairment charges signifies that in the future your earnings are going to increase. Answer is B. If valuation allowance is increasing, that signifies that yes, your earning power has reduced. But reversal of valuation allowance signifies that expectation of future earnings has increased. So answer is B. 16th. Company recorded a DTA of itna and offset by itna of valuation allowance. Now today there is a DTA. There is a DTA of 12301. You reduce this by valuation allowance of 12301. So eventually you have shown a DTA of 0. Now what does this 0 signify? So you are reducing your DTA. That means you are not expecting that there would be a future taxable income. So answer is A, B, C. So you are not expecting to earn any taxable income in the future. So answer is C. Next, 17th to 19th. Now in 17th to 19th, my focus is over net DTA, these figures, then gross DTA, these values, valuation allowance, and last one is deferred tax liability. So negative sign means this is a positive deferred tax liability, and net deferred tax liability. So my focus is over only the highlighted part. So question number 17 to 19. Let's recreate the table. Year 2, year 3. Now gross deferred tax, valuation allowance, this is net DTA, then DTL, and then net DTL. Okay, so year 2, 16,917, valuation allowance of 13,060, that means net DTA of 15557, DTL of 39,040, net DTL of 23,483. Same wise 18851, 1245 negative, this is 17606, 32,639, 15033. So I've recreated the table. Okay, just to simplify. Now a reduction in the statutory tax rate will most likely benefit the companies. Okay, now there is a reduction in the tax rate. So if tax rate reduces, your taxes payable will reduce. Okay, Now, eventually your DTL will reduce, and as a result, income tax expenses will reduce. So important. If tax rate reduces, taxes payable reduce, net you are having DTL will reduce. As a result, income tax expenses will reduce. So positive impact over P&L, and DTL will reduce, positive impact over balance sheet. Now answer question number 17. A reduction in the tax rate will most likely benefit it is going to benefit both the income statement and balance sheet. Okay. 18. If the valuation allowance had been the same in year 3 as it was in year 2, the company would report. Now, in year 2, valuation allowance is 1360. Now, had it been this valuation allowance is in year 3 as well. Okay. Now, what is happening in year 3? So now, currently in year 3, there is a reversal of valuation allowance. So reversal of how much? Reversal of 1115. So this is currently in case of year 3. Now my point is, if this reversal is not there, so what happened in case of reversal? In case of reversal, you increase your DTA and reduce your tax expenses. So this is in case of reversal. Now, if this reversal is not there, your DTA will reduce by 15 and your tax expense will increase by 15. Now you have to answer A, B, C. So if the valuation allowance had been same in year 3, that means in year 3 there is no reversal. If in year 3 there is no reversal, your tax expense will increase by 115 and your DTA will reduce by 115. So my answer is C. Now 19th, compared to the provision for income tax in year 3, cash payments were okay. Now 19th, so what is the cash payment? That is taxes payable is the cash payment plus change in DTL. This is going to be your income tax expenses. Okay, now this is the amount which will transfer to your P&L, and this is the amount which you have to pay in cash. Now let us assume this amount is X. Now change in DTL. So your DTL is reducing. DTL is reducing by 8450. So if DTL is reducing, I'm going to add negative 8450, and the amount to be transferred to P&L is X minus 8450. Now you have to answer. Compared to the provisions. So this is the provision. Compared to the provision, tax payments, cash payment of tax, higher, lower. So compared to provision, cash payment, compared to provision, cash payment is higher by 8450. So my answer is B. Answer is B. 20. The following information is available for a company that prepares its financial statement according to US GAAP. Okay, so 20. (2014) 2015. So there's a DTA of 8 lakh and valuation allowance of 4. So net DTA of 4 lakh and net DTA of 5 lakh. Then deferred tax liability 7 lakh and 6 lakh. So net DTL of 3 lakh, 1 lakh. So DTL is reducing from 3 to 1. Okay. Now the question is the overall effect on 2015 net income from the above changes in the company's deferred tax account is closest to. Okay. So now amount transferred to P&L account, that is your income tax expenses, is equal to taxes payable plus change in DTL minus change in DTA. Okay, so DT is not there. Let us assume this value is X, and now DTL is reducing. So I'm going to subtract 2 lakh rupees. That means my income tax expense is X minus 2 lakh. So your expenses will reduce by 2 lakh. So this is the impact of this DTL on the income tax expenses. So it is reducing your tax expenses reduced by 2 lakh rupees, because of which your net income will increase by 2 lakh. So on account of this particular table, what impact it is going to have? Your income tax expenses will reduce by 2 lakh. As a result, your net income will increase by 2 lakh. So question is the overall effect on 2015 net income. So answer is profits will increase by 2 lakh. Answer is A. One of the notable difference between IFRS US GAAP is, now we have done two differences, one with respect to DTA, second with respect to revaluation. Now revaluation will be directly adjusted into the equity component in case of IFRS. In case of US GAAP, this point is not applicable. Then 22nd, which of the following will result in decrease in valuation allowance? Decrease means reversal. So when there is an extension in the tax loss carry forward period, answer is C. So decrease in the valuation allowance means reversal. Okay, now government is allowing instead of 8 you can carry forward for 10 years. So there is going to be reversal of valuation allowance. 23rd, a company has a net building with a net carrying value of 1 lakh, tax base of 1 lakh 20, tax rate was 20 and now it is reduced to 17. Okay, now you have to find out DTA, DTL, XYZ. Okay, so this is a case where the tax rate is changed, and in case where the tax rate are changing, we are going to use balance sheet approach. Now first, carrying value as per accounts is 1 lakh rupee, as per tax base is 1,20,000, difference is 20k, multiplied by tax rate. Tax rate is 17%. So answer is 3,400. Now you have to decide it is DTA or DTL. So carrying value as per accounts is less. That means expenses would be more, and if expenses are more as per accounts, profits would be less. Profit less, taxes less, you have paid more. So if you have paid more, it has created a DTA. Answer is B. So whenever there's in question it is given that the tax rate has been changed, you have to use balance sheet approach. Answer is B. Next, the company's 2013 income tax expenses is closest to. So you have to start with taxes payable. So taxes payable is 1000. Question number 24. Taxes payable 1000, and now it is net liability. So net liability of 200 increased to 250. Okay, so you have to read like this. Net deferred tax liability in 2012 was 200. It has been increased to 250. Okay, so change in DTL. So add 50. My final answer is 1050. This is going to be your income tax expense. Answer is C. If a company has a deferred tax asset in accounts and the tax authority reduced the tax rate, which of the following is most accurate regarding this? So tax rate is reduced. So tax rate is reduced. Deferred tax asset will decrease in value. So how we find out deferred tax asset value? So using the balance sheet approach, find out difference. The difference is multiplied by tax rate. Now if tax rate is reduced, DTA value will reduce. Answer is C. Now 26th. Company purchased an equipment for 2013 for 25,000, and following are the year-end values. So they have directly provided here with the carrying value for accounts and tax-based values. Now which of the following best describe the effect of change in the tax rate on the company's 2014 financial statement? Okay, so in 2013 tax rate was 30 and this rate has been reduced to 25. What is the effect of this change on the company's financial statement in 2014? So 26th. Now 2013, 2014. So assume that tax rate remains 30%. So value as per accounts, two 2500, and then 20,000. Tax base, $20,000 and 16,000. So first you have to find out difference. Then tax rate, and assume that tax rate is both 30%. $1,200. 675 DTA or DTL. So carrying value as per accounts is more, that means expenses less, profit more, taxes should be paid more, you have paid less. So this is DTL. Now if tax rate is same, then in 2014 DTL should be of 1200. But now because the tax rate has been reduced to 25%, because of which DTL reduced to 1000. So what is the effect of this change in tax rate? So because tax rate reduced, as a result of which as a result of which DTL reduces from 1200 to 1000. Now you have to mark ABC. Deferred tax liability will reduce by 2,200 pounds. So answer is C. Okay, so friends, with this we have covered this chapter. So in totality I was having 26 questions, and I strongly recommend that for this chapter, I understand this chapter is difficult, but we should not study this from reference book, and our hand notes would be more than sufficient. For this I'm not giving you any class notes as well. Okay, so you have to read this chapter very thoroughly from your class notes and practice 26 questions very well before proceeding to the next part. Okay, so yeah, so I understand this chapter is difficult, but yes, with practice you can easily solve all these 26 questions. Hello friends, today we are going to start with the reading Understanding Income Statements. So in this chapter we will learn how to prepare an income statement of a company. An income statement is a statement which shows the profit earned or losses incurred by the company during a period. Okay, so this is going to be what we are going to learn in this chapter. Okay, and on this note I'm going to start with my first LOS. So now my first LOS is meaning of income statement and its format. Now it is a statement which shows profit earned or losses incurred during a period. Okay, now what is going to be the format? We are going to start with sales or revenue. So sales or net revenue. So what is the meaning of net revenue? That means post deducting any sort of sales return. Okay, then minus cost of goods sold. This is going to be the gross profit, minus other operating expenses. So this is my EBITDA. EBITDA stands for earning before interest, tax, depreciation and amortization, minus depreciation and amortization, EBIT, EBIT also known as operating income, minus interest, now I'm introducing a new word. Okay, so now the new word is earnings before share of profit from associate company and taxation. Now I'm going to add. If it is a gain, if it is a profit, I'm going to add. If it is a loss, I'm going to subtract. Now add share of profit from associate company. My resultant figure is EBT minus taxation. Now again a new word, earning after tax, but before adjustment for discontinued operations. So earning after tax before adjustment for discontinued operations. Again, if it is a profit, I'm going to add, then add profits from discontinued operations this is net of tax, important word. Finally, I will get EAT within this EAT. Now class, post EAT, I'm going to write other comprehensive income. So this other comprehensive income is not a part of income statement. Okay, it is an extension. So now typically our income statements ends here. Okay, now I'm adding other comprehensive income. So in totality there are going to be 4 components. Number 1, unrealized gain and losses from available for sale security. Component number 1. Then unrealized gain and losses from cash flow hedging derivative. Then third component is foreign currency translation gain and losses, and last component is pension obligation. So 4 component. Now the resultant figure is known as total comprehensive income. This total comprehensive income now will be divided into 2 parts. One belonging to parent company and second component belongs to minority interest. Another name for minority interest is non-controlling interest. And here our finally income statement ends. Okay, so now class, we just prepare a comprehensive format for income statement. Okay, now I have introduced some new words such as minority interest, parent company, first one. Then what is the meaning of associate company? Then we have our profits from discontinued operations net of tax. Okay, so before I proceed further, so what is the meaning of income statement? It is a statement which shows the profit earned or losses incurred by the company during a particular period. Okay, now let us assume that there is a company by the name Geo. So there is a company Geo, and now in Geo there are 3 investors hypothetically, and those 3 investors are Reliance, Airtel and Vodafone. So there are 3 investors, whereas the ownership of Reliance is 60%, ownership of Airtel is 30%, and ownership of Vodafone is 10%. So let us assume that Jio in totality needs 100 rupees. That 100, 60 contributed by Reliance, 30 contributed by Airtel and 10 contributed by Vodafone. That means there are 3 investors, Reliance, Airtel and Vodafone. Okay. Now whenever you're going to invest your money, I'm going to divide this investments into 3 parts. Okay. Now those 3 parts are, number 1. So whatever the amount that you are investing, I'm talking about equity investments. That will have 3 components. Number 1, subsidiary company. Second is associate company. And third one is other investments. So now if in any company your ownership is more than 50%, your ownership is more than 50%, then this is going to be your subsidiary company. If your ownership is 20 to 50%, then it is going to be your associate. And if your ownership is less than 20%, then it is going to be termed as other investments. Now I'm going to divide other investments into 2 parts. Now one component is available for sale securities, available for sale AFS, and second one is trading investments or trading securities. Okay. So now my first point is, in the given case, there was a company Jio, and in that Jio, Reliance is having a ownership of 60%. So can I say that from Reliance Industries point of view, Jio is nothing but a subsidiary company? Since I'm having a ownership of more than 50%, the answer is yes. Okay. Now my point is how a company functions. Okay. So now who is the real owner of the company? The real owner of the companies are shareholders. They are going to appoint the management or directors, and these directors in return are going to run the company. Okay. So that means company belongs to shareholders but is managed by directors. Now who is going to appoint these directors? So these directors are appointed by shareholder by ordinary resolution. This we have already covered in corporate governance. Now ordinary resolution means if any director gets more than 50% vote, then he is going to be appointed as director. Okay. Now my point is, suppose there are 3 directors, director A, B and C, and Reliance says yes, A should be the director. So as per Reliance, answer is yes. As per Airtel, no. As per Vodafone, no. So my question is A going to be the director of Jio? Since he is getting more than 50% vote, answer is yes. For B, Reliance says yes, Airtel says no, Vodafone says no. Yes, B is going to be appointed. And for C, Reliance says no, Airtel says yes, Vodafone says yes. No, now since C has not got 50% vote, he is not going to be appointed. Now my question is very simple. That means whatever is happening in the Jio, this is as per the discretion of Reliance. Now Reliance, you are the parent company. Now from Reliance point of view, now Reliance has to prepare 2 sets of financial statements. So now since Reliance, you are the parent of Jio, you have to prepare 2 sets of financial statements. The first set of financial statement is known as standalone. Standalone means your alone profit and loss statement. Standalone, representing your individual profits and gains. And second is going to be the consolidated. Now consolidated means including the results of your subsidiary. So let us assume that Reliance standalone sales is 100 and standalone profits is 10. On the contrary, Jio standalone sales is 50 and standalone profit is 5. Now Reliance, you have to prepare 2 sets of financial statement. One standalone, okay, and second one is going to be consolidated, where consolidated means including the results of your subsidiary. Okay. Now my question is, in this Jio, my ownership is 60%. And when I'm going to consolidate, I'm going to give you two options. Now, when I'm going to prepare a consolidated financial statements, then what should be the revenue that should be reported by Reliance? Option number 1, 150. Option number 2, 100 plus 50 plus 60% of 50. That is, this is going to be 30, 130. And same wise, you have to show a profit of 15 or 10 plus 60% of 5, which is going to be 30. Now my question is, when consolidating, I should report a sales of 150, 130. I should report a profit of 15 or 30. Now, most of you would be thinking that since my ownership is 60%, then ideally the consolidated sales should be 130. Ideally, the consolidated profits should be 30. But the answer is incorrect. Okay, so these answers are incorrect. Now, point to be noted. Once your ownership is more than 50%, you are going to prepare two sets of financial statements, standalone consolidations. Consolidated financial statements would always be prepared on cent percent basis. Irrespective of your ownership, it is going to be prepared on cent percent basis. That means now Reliance will report a sales of 150, will report a profit of 15. But now my question is, am I inflating the profits of Reliance? Answer is yes. Why inflating? Because this 5 has 3 components. 60% belongs to Reliance, which is 3 rupees. 30% belongs to Airtel, which is I think 1.5. And 10% belongs to Vodafone, which is 0.5. But now I'm showing a profit of 15. Now my question is very simple, by how much I'm inflating the profits? So ideally the profit should be 30, but you're inflating by 2 rupees. Now I'm going to divide this 15 into 2 parts. The 2 parts are, one belonging to parent company. Parent company means Reliance. Now what are the profits that belongs to Reliance? 30. What is the profits that belongs to Airtel Vodafone? That is 2. Now this 2 is known as minority or non-controlling interest. So now important. Reliance, you are having a ownership of more than 50%. You have to prepare two sets of financial statements, standalone consolidated. Consolidation would always be on 10% basis, and whatever the profit that does not belongs to Reliance, this would be termed as minority interest. Now in my case, what is going to be minority interest? That is 2. Now this 2 is nothing but the profits which belongs to Airtel and Vodafone. So this was the accounting treatment from the point of view of Reliance. Now class, important. Now I have introduced, within my income statement, I have introduced 2 words. Whatever the profits are, now you have to divide into 2 parts. Parent company and minority interest. So now if I open up, let's learn practically as well. So now if I open up the annual report of C8. So within this annual report, now you will find that company has reported 2 financial statements, standalone and then consolidated. Okay. And if I move to my consolidated financial statements, now within these financial statements, okay, so now within these financial statements, whatever the total profit company has earned, total comprehensive income, this comprehensive income divided into 2 parts, non-controlling minority, and second one is going to be the parent company. So now this was my consolidated P&L account. Okay. Now we have to learn accounting from the point of view of Airtel. So now from the point of view of Airtel, Jio is nothing but a associate company. So now in case of Airtel, there's going to be a single line item, and that single line item is going to be share of profits from associate company. So now what was my share of profit from Jio? My share of profit from Jio was 1.5. That means in case of Airtel, the accounting is very simple. There's going to be a single line item. Now go through my income statement format. So in the P&L, there's going to be a single line item, and that single line item is share of profits from associate company. Now in case of C8, we do have subsidiary companies, we do have associate companies. Now if I look at there into consolidated P&L account, now you will find one word, share of profits from associate company. Associate company is also known as a joint venture. So in case of associate company, if your ownership is 20 to 50%, then there's going to be a single line item into your P&L. Now I'm moving to the Vodafone case. Now in case of Vodafone, now investment will divide it into two parts. Either it is going to be available for sale or trading security. Now management, now these types of investors are nothing but they're basically investing for the purpose of capital appreciation. Okay, so my objective is only capital appreciation. That means today I'm investing 100 rupees, tomorrow the share turned into 120, and by selling in the market I'm going to earn 20%. So these types of shareholder, now you, me, all of us are having a share of Reliance. So we are falling into this category. Now why we have purchased the share of Reliance? We have purchased only for the purpose of capital appreciation. Now my point is very simple. Management, what is your intention? For how much period you are going to hold this investment? Now if you are going to liquidate, if you are going to sell this investment within 12 months, then it will be termed as trading securities. And if your holding period is greater than 12 months, then it will be available for sale. So now, for example, today I purchase one share of Tata Steel, and I purchase a share for 1000 rupee. Okay. And now the management intention is that we are holding this for capital appreciation purpose, and we are going to sell this share within next 12 months. Okay. And suppose we purchase a share on 1st of September. Our financial year ends on 31st March. And our intention is that we are going to sell this within 12 months. Okay. And as on 31st March, the share price is 1200. Now my point is, what exactly the profit for this period is? I purchased the share for 1000, and as on 31st March, I'm still holding the share, but now the value is 1200. Now what is going to be the profits? Now the profit is 200 rupees. Now whether it is available for sale or trading securities, you will show the investment at their fair value. That means in balance sheet, available for sale and trading security will be reported at fair value. Fair value, fair value. Now that means I invested 1000, now I want to report at 1200. And now the only way is you are going to report the gains to your income statement. If it is a trading security, then unrealized gain and losses will be routed through P&L account. Now we will report one non-operating income, but this is going to be reported through P&L account. Now for example, if I go to C8 annual report, now could be possible they have reported this under other income, or they have reported this under exceptional income items, but it is again going to be reported through income statement. But now my point is, however, in case of available for sale, this 200 unrealized gain and losses will not be routed through P&L. This unrealized gain and losses will be routed through OCI. Now OCI stands for other comprehensive income. Post EAT there could be only 4 items, and one of those 4 items is unrealized gain and losses from available for sale security. Now my focus is here. So if Vodafone, you're going to hold the investments within 12 months, you're going to liquidate this within 12 months, then whatever the unrealized gain and losses, this will be routed through P&L. But if you're going to hold for more than 12 months, then it will be routed through OCI. It is going to be treated as available for sale security. Okay. And now let us assume that during this particular period, company has also paid dividend. Now dividend have already been received. So whether it is available for sale or it is trading security, dividend received by the company, dividend received in both the cases will be transferred to income statement. So now if I want to conclude finally, now let us assume that there is a company Jio. In Jio there are three investors: Reliance, Airtel, Vodafone. Reliance holding 60%, Airtel holding 30%, Vodafone holding 10%. Now from Reliance point of view, Jio is a subsidiary company. From Airtel point of view, Jio is an associate company, and from the point of view of Vodafone, these are treated as other investments. That means my purpose is only to earn dividend and capital appreciation. So now Reliance, since you're indirectly holding this company, you're going to prepare two sets of financial statements: standalone, consolidation. Consolidation would always be on 10% basis, and whatever the profit that does not belongs to me, this is termed as minority interest. Okay, perfect. Now in case of Airtel, from your point of view, it is going to be an associate company. There's going to be a single line item, and that single line item is going to be whatever your share of profit is. In case of Airtel, this is 1.5. Now Vodafone, you need not to report anything with respect to 0.5. Okay. Now what Vodafone is going to report? First, clarify your intentions, management. You are going to liquidate within 12 months, more than 12 months. If more than 12, it is available for sale. Within 12 months, it is trading security. Now you are going to report this at fair value. But now whatever is going to be unrealized gain and losses, in case of trading, it will be routed through P&L. In case of available for sale, it is going to be routed through OCI. But now whatever the dividend that you have already received, that dividend received is going to be the part of P&L in both the cases. So class, this was with respect to investments. And I'm still on LOS 1. And now within LOS 1, so before I proceed further, now let's go through the notes once. So the income statement shows company's revenue, expense, gain, losses during the period. Revenues are the amount from the sale of goods, service in the normal course of business. Expenses are the amount incurred to generate the revenues. Okay. And then this is the important part. If a firm has a controlling interest in a subsidiary, the pro rata shares of the subsidiary income not owned by Reliance, not owned by parent, is reported in the Reliance income statement as non-controlling interest. Non-controlling is also known as minority or minority owner's interest. The non-controlling interest is deducted in arriving at net income because parent is reporting all of the subsidiaries revenue and expenses. That means consolidations would always be on 10% basis. Okay. Now within this LOS, they have discussed one more component. Now within my income statement, I'm going to club the expenses, double stop point. I'm going to club the expenses as per nature or as per function. Now, for example of nature. So let us assume that I have some plant and machinery, furniture, building, okay, electrical equipments. Instead of electrical equipments, let us assume I'm having air conditioner. So these are the fixed assets that I'm having. Now point is, over these fixed assets you're going to charge. Over these fixed assets you're going to charge depreciation. So now I'm going to charge depreciation on my plant and machinery, depreciation on my furniture, depreciation on building, depreciation on air conditioner. So now I'm going to club all this, and this will be transferred to my income statement as a single line item. Now, for example, there is a single line item by the name depreciation, and I have clubbed all the depreciation within this particular figure of 27,000. Now you have clubbed the expenses. So here you have clubbed the expenses as per nature. Now why I have used the word nature? Because whatever the amount is, whatever this 20,000 is, this 20,000 that C8 reported is nothing but depreciation. Depreciation on plant, depreciation on furniture, depreciation on building, depreciation on air conditioner. This is example of nothing but the nature. Same wise, now please help me. I reported one item by the name finance cost. This finance cost is nothing but interest cost. Okay. Now you can pay interest on loan from banks. You can pay interest on loan from NBFCs, that is non-banking financial institutions. You can pay interest on bonds. You can pay interest on financial lease. You can pay interest on public deposits. So these are the different interest that you can pay. And now I have clubbed together and reported a single figure of 15,093 into my financial statements. You have clubbed the expenses as per. All of them are nothing but the interest. Interest on bank, interest on NBFC, interest on loan from interest on bonds, interest on financial lease, interest on public deposit. You have clubbed all the expenses. Now you have clubbed as per nature. If the expense is of similar type, then this is nothing but you have clubbed as per nature. Okay. Now what could be the formula? What could be the example for function? Now my point is, this we have learned under inventory. So under inventory, now within income statement there is one component by the name COGS. And COGS is nothing but a direct expense. So what all expenses are clubbed under COGS? Now expense on raw material, labor, power, freight inward, these all have been clubbed in case of COGS. Now my point is, you have clubbed together and reported a single figure by the name of COGS. Now you have clubbed the expenses as per function. They all expenses, these all different type of expenses have similar function, and that similar function is to manufacture the product. Now either you can club the expenses as per nature, or you can club the expenses as per function. Functions means expenses of different type clubbed together, so incurred with an objective of performing a similar function. Now you have clubbed RM, labor, power, freight inward. These are expenses of different type. But why you have clubbed? Because they have a similar function to manufacture the product. Now you can club, and you're going to club and report as COGS. This is an example of clubbing the expense as per function. Then depreciation of plant, depreciation of machinery, depreciation on furniture, club, reported as single figure, example of nature. Then interest, different types of interest you have clubbed. This is going to be an example of nature. Now class important. That means we can club expense as per nature and as per function. So now what is example of nature? Example of nature is depreciation. Example of nature is interest cost. Example of nature is taxation. So why taxation? Just give me 2 minutes. And what is the example of function? So example of function is going to be COGS. So double star. So it is the only example. And this you have to put a double star. Now why taxation as per nature? So now what happened in case of US, whatever the profits that the company has earned, now the company has the obligation to pay 2 types of taxes. One tax belongs to the central and one tax belongs to state. So I'm not aware of the figure, so I'm just taking a hypothetical number. Let us assume that central tax is 20% and state tax is 5%, and the company's EBT is 100. Now company has the obligation to pay 20 rupees to the central government, 5 rupees to the state government. Now in totality you have paid taxes of 25. I club together and report a taxation of 25. So now this taxation of 25 has 2 components. One belongs to the central, one belongs to the state. You have clubbed and reported. Now taxation paid to the central government, taxation paid to the state government, clubbed together. These are the expenses of same type. Clubbing together, it is an example of nature. So now again, let's go through the notes. Expenses are grouped together by their nature or function. presenting all depreciation expense from manufacturing administration together in a one line item on the income statement. It is going to be an example of, this is going to be an example of nature. Same wise, clubbing all manufacturing cost, raw material, labor, etc. It is going to be an example of clubbing by function. So clubbing by function, example is COGS. Clubbing by nature, example is a depreciation, interest cost and taxation. Then proceeding further, the income statement also includes gain and losses which result in gains or which results in increase or decrease of economic benefits. Gains and losses may not be from ordinary business activity. Now, for example, that means within income statement, the gains can be of two types. One, operating, and second is non-operating. Non-operating means not out of your main operations. Now, for example, my main business is teaching. Okay, and I have one car, and now I decided that I'm going to sell off this car. I'm going to buy a new one. In my books, the car value is 3 lakh, and I sell this, and the proceeds are going to be 3,30,000. So now, am I going to sell this car on a profit? Answer is yes. Is it my operating, non-operating? It is non-operating because my main business is not selling of car. And this 30,000 again will be reported in the income statement under the head exceptional incomes. So now, if I go to C8 income statement, you will find some items by the name exceptional. But point to be noted, all the exceptional items will be reported before profit from tax. Now, for example, whatever my profits are, this profits is going to be 30,000 and my obligation is to pay 10% to the government. So net profit is 27,000. So you're going to report this before tax, and whatever the tax you're going to pay, this will be clubbed here, and eventually you will get the net figures. So what's my point? Could be possible that you are having some sort of non-operating income as well, exceptional items as well. All these items will be reported on pre-tax basis before taxation, and whatever their tax liability is, this is going to be clubbed into my tax expenses. Okay, so this was my class LOS A, LOS 1, where we discuss about the format of income statement. Okay, so point to be remember before we conclude this LOS 1, you have to remember what are the different types of investment. There are 3 types of investments. Second, you have to remember that how we can club the expenses. Now, expenses can be clubbed as per nature and as per function. So this much is sufficient for LOS 1. Now, I'm proceeding further. Now, my next LOS is LOS 6. Now, LOS 6 distinguish between operating and non-operating components of the income statement. So operating income is generated from firm's normal operations. For a non-financial firm, that means for a manufacturing entity, income that results from investing or financing transaction is classified as non-operating income. Now, for example, for my case, I'm getting income from sale of my car, from sale of my land. This will be termed as non-operating income. And these non-operating income will be shown in the P&L on before tax basis, and while it is operating income for a firm. Okay, so this is my LOS 6, where they talk about operating and non-operating. Point to be noted, non-operating income would always be shown on pre-tax basis. Now friends, I'm proceeding further to LOS 5. So in LOS 5, now I'm going to talk about discontinued operations. Now, what is the meaning of discontinued operations? So now, for example, there is a company by the name Escorts Limited, and this company is present into 3 divisions or 3 business segments. So their first business is tractors. So they are the second largest player in the country, and the brand name is Farm Track. Okay, so in the tractor business, the market leader is Mahindra, followed by Escorts Limited. Then the second division is railway equipments. And the third division is auto components. Okay, where from the tractor division they are having a sales of 100, railway 50, and auto components 25. Profit is 10, 5, and 2.5. So I'm just taking some arbitrary figures. Now my point is, what management decides. Management decides that now we are going to, there is only the discussion. That could be possible that we are not going to continue with this particular divisions. So point to be noted, we have not liquidated yet. There is only a discussion, and management has planned that going forward could be possible that we are going to liquidate this particular division. Okay, so now this division will be termed as a discontinued. So now whenever you are going to prepare the financial statements, now I will not report sales of 175, profit of 17.5. So this will not be the case. Now since this division is discontinued, could be possible that tomorrow company may liquidate this, and this is going to be a non-recurring. Okay, so keeping that in mind, now I will report the sales at 150. I will report my profit as 15, and before and after this 15, there's going to be line item profits from discontinued operations, and this is going to be 2.5, and eventually company will report a profit of 17.5. Now point to be noted, discontinued operations, profits from discontinued operations will be shown on after tax basis. So this is the only line item which will be shown on after tax. So now if I go to my format, within this format there is only one line item which is reported net of tax, and this is going to be profits from discontinued operations. So if there's a profit, you're going to add it up, and if there's a loss, then you're going to deduct it. And point to be noted, it is the only line item which is going to be reported on net of tax basis. Now class, my point is, suppose that there is a non-operating income. Non-operating income on sale of property, on sale of land, on sale of plant and machinery, on sale of car, furniture, XYZ. Now point is, this will be reported on pre-tax basis within your income statement. But if you have a discontinued operations, now profit and losses from discontinued operations will be reported on net of tax basis. And then within this LOS they discuss about, let us assume that earlier we were charging depreciation using SLM, and now we want to charge depreciation using DDB method. There's a change in accounting principle. If there's a change in accounting principle, then there's going to be a retrospective amendment. However, if you want to change the estimates, for example, I want to change the salvage value from 100 to 200, I want to change the life from 3 to 4 years. Now if you want to change the assumptions, then this is going to be a prospective amendment. Now for example, now how it happens in the practical life. Now let us assume that I have one machinery purchased in 2011 for 10,000 beginning of the year, and life is 4 years. So I'm going to charge a depreciation of 25, 25, 25, 25 as per SLM method. And now in 2013, company decided that instead of SLM, we are going to charge depreciation using DDB, and figures works out to be 4,000, 3,000, 7, then 2,000 and 1,000. Let us assume that these are going to be the figure. Now how the retrospective amendment will work. So this happened in 2013. Now in 2013 we are going to show the depreciation as 2,000, point number 1, and whenever I am going to prepare a balance sheet and a P&L, for comparison purpose you have to show 2012 or you have to show previous year figures as well for the purpose of comparison. So this is the requirement of accounting standard number 1. So this you will learn in the chapter number 1. Okay. Now my point is, now I'm going to change 2012 figures as well. And now these financial statements are known as restated. So what is the meaning of restated? Restated means that either we have changed the classification or we have changed from one accounting method to another. So whenever there's going to be change in accounting principle, it has to be a retrospective amendment. Retrospective amendment means now I'm going to show depreciation of 2000 in my books, plus you have to change previous year figure as well. Now the previous year figure is going to be 3000 instead of 2500, and now you are going to write restated. Restated means that you have changed the reclassification or you have moved from one principle to the another. So now if I move to my LOS 5, results of discontinued operations are reported below income from continuing operation, net of tax, double star point. From the date the decision to dispose of operations is made. So from the time you have decided that we are going to liquidate this is going to be shown as, this is going to be considered as discontinued operations. The results are segregated because they are non-recurring and do not affect future net income. Unusual or infrequent items are reported before tax and above income from continuing operations. Then changes in accounting standards, accounting method applied, and correction of accounting errors requires retrospective restatement of all prior period financial statements included in the current statement. Now in the current statement there is going to be two figures only. Now if I go to CA P&L, so one is going to be the current year, second is going to be the previous year. Now you are going to compute depreciation as per the new method as 2000, and you are going to change this restated figures as well for the previous year. And for the previous year, now the depreciation is going to be 3000, not 2500, and now you will write a restated over your income statement. Okay, proceeding further. A change in the accounting estimates, however, is applied prospectively to the subsequent periods with no restatement of prior period results. So if I go to if I go to Capital IQ, now class, if I look into the income statement of Reliance Industry, now in 2016 you will find restated. Then in 2017 you will find reclassified. Now what is the meaning of that? That could be possible that Reliance have changed from one method to another or have changed the classification of the items. In that case, what will happen? The figure for 2013 will be in accordance with the new method, but a retrospective one. Retrospective means assuming that the day machinery was purchased and we have used the DDB, then what should be the answer for 2013? And same wise, you have to change the previous year figures, and this will be termed as restated. So class, with this I have covered 3 LOS. LOS 1, LOS 5, LOS 1, LOS 5 and LOS 6. Now a quick revision. Now my first point is, first my focus is over investments. Investments can be of 3 types: subsidiary company, associate company, other investments. If your ownership is more than 50% in a company, it will be termed as your subsidiary. If your ownership is 20 to 50%, it will be termed as associate. And if your ownership is less than 20%, it will be termed as other investment. Now what is going to be the accounting for a subsidiary company? Now parent company, you are going to prepare 2 sets of financial statement, standalone, consolidated. Consolidations would always be on 100% basis, and whatever the profit that does not belong to the parent company, that is going to be termed as non-controlling interest. For associate company, there is going to be a single line item into your P&L that represents your share of profits. Then in case of other investments, you are basically acting as an investor. Your objective is to earn capital appreciation or dividend. Now if you have received the dividends, this dividend will be transferred to your income statement under both the cases. And now I want to classify my investments into 2 parts: available for sale, trading. If you want to liquidate this within 12 months, it will be termed as trading. Else it is going to be termed as available for sale. Now unrealized, both the cases investment will be shown at fair value. Unrealized gain and losses in case of trading will be transferred with the help of P&L, and unrealized gain and losses in case of AFS will be transferred with the help of OCI. Then expenses can be clubbed as per nature, as per function. So the example of nature is income tax, depreciation. These all are examples of nature. But what is the example as per the function? This is going to be COGS, and there is only one example, that is the COGS one. Then proceeding further. Now all the unusual items, non-operating incomes, will be shown in the P&L. Non-operating expenses, non-operating income will be shown in the P&L before tax. but there's only one item which is going to be shown on after tax basis. This is going to be the profit and losses from discontinued operations. Discontinued operations means those divisions which company is planning that they may liquidate in the future because they are non-recurring in the nature. This is the only logic. Then if you want to change from one method to another, it has to be retrospective. Retrospective means what should be the revised answer if that revised method has been adopted on the first day. So in my case, this is going to be 2000. Now you have to change previous year figures as well, and over that you are going to write restated financial statements. But if you want to change the estimates, live method or live salvage value, then it is going to be a prospective amendment. So class, LOS 1, LOS 5 and LOS 6. Now I'm moving to my LOS 2. Now my LOS 2 deals with 2 and 3 deals with when you are allowed to book the revenue, when I'm allowed to book the sales. So now class, before you give me any sort of answers, you have to keep in mind these 4 principles: matching, accrual, prudence and consistent. Now my point is, let us assume that this is my financial year and my new batch is about to start on 2nd of April 2019 and my financial year ends on 31st March 19, and here for this upcoming batch on 30th March I have received some advance from my students, and that advance value is 100 rupees. Now my point is, I have received 100 rupees from a student, okay, as on 30th March. Now I'm going to book this as sales for this financial year, that is financial year 19, or it is a sales for financial year 20. You have received the money. Now my point is, I'm least bothered with whether you have received the money, yes or no. My question is very simple. Have you fulfilled your obligation? Has Vikas Vohra delivered the service? Has Vikas rendered the service? Has Vikas Vohra delivered the goods? The answer is, on this particular date, irrespective whether you have received the money, yes or no, services has not been rendered, goods has not been delivered. If this is the case, then you are not allowed to book the revenue. Now you have received the money. So what will happen in the balance sheet? You will receive the cash, 100 rupees. And since the obligation has not been fulfilled, this is going to be your liabilities. Now what is going to be my liability? That liability is advance from customer, going to be 100 rupees, or it is have one more name. This is unearned revenue, and the value is 100. Now I'm going to render the service in next financial year. So now what will happen in the next financial year? I'm going to book the sales as 100. Correspondingly, this liability will be removed from my financial statements, and eventually in the form of profits, this will turn into equity. So now you will be having a equity of 100 and a cash of 100. So when you are going to book the sales, when the services has been rendered and the product has been delivered, your obligation is over, you are allowed to book the sales. Same wise, let us assume that during this particular period, I have rendered the services. But for one or the X reasons, I didn't charge the amount during this period because parents' business hampered because of COVID. And student says me that, sir, I'm going to pay you the money in FY21. Again, my question is, in which period I'm going to book the sales? Now, you're going to book the sales in the period in which services has been rendered. In my case, FY20. Now, what will happen? I will book the sales of 100. And since I have not received the money, then correspondingly, I'm going to book a asset by the name debtors, 100 rupees. And when tomorrow this student will pay me, debtor will be removed from my books, and correspondingly, I will be having a cash of 100 rupees. So class, very clear. We are least bothered with whether you have received the money, yes or no. The point of concern is, have you delivered or have you fulfilled your obligations? If you have, then you're allowed to book the revenue. This is based upon which principle? This is based upon accrual. So now let's go through that. LOS 2 and 3. Now under the accrual method of accounting, revenue is recognized when earned. Earned means obligation has been fulfilled, and expenses are recognized when incurred. The important point to remember is that accrual does not necessarily coincide with the receipt or the payment of cash. If the firm received the cash before revenue recognition is complete, it is going to report unearned revenue into your balance sheet as liability. Now my next point is, if I talk about a company like Sadbhav or L&T or Reliance Infra. So what this company does, these are basically into the construction business, and they're going to construct the capital assets. Now for example, there's a company by the name Sadbhav. It's a infrastructure construction company, and recently they got one contract from the government to construct a road. Okay, and for this construction of road, company anticipates that total time required is 3 years. The cost that they're going to incur is going to be 1,000 crore, and the revenue which they will get from government, this is going to be 1,200 crore. So they got one contract from the government where the revenue is going to be 1,200 crores. Cost they are planning to incur is 1,000 crore, and time required is 3 years. Now the point is, what company anticipates? Company anticipates that in year 1, I'm going to complete 50% of the project. In year 2, I'm going to complete 30% additional of the project. And in year 3, additional, there's going to be 20% project completion. And thus, by the end of third year, my project is complete. Okay. Now my point is, that means cost incurred. So what is the cost that you're planning to incur? In totality, my cost is 1,000 crore. So you're saying that in year 1, you're going to incur 500, 300 and 200. Okay. And your total revenue is 1,200 crore. Now you're going to divide this 1,200 crore in this particular ratio. So this is going to be 600 crore. Then this will be 360 crore, and this is going to be 240 crore. So my profits for the period is 100, 60 and 40. Now class, if I go by the first logic, that until my obligation is not fulfilled, I'm not allowed to book the revenue. Then a company like Sadbhav, where they need substantial time for the construction or for the completion of the project or for the construction of the asset, then I cannot book any revenue by the end of year 3 because my obligation has not been fulfilled. Now what accounting standards IFRS and US GAAP says? For those companies which are involved in construction of capital assets, we are going to provide them a 5-step process through which they can book their revenue. So point to be noted, this is an only exception for those companies. This is an only exception for those companies which are involved in construction of capital assets, where the time need to complete the asset is substantial. For example, if you are a construction company. Now this is going to be a 5-way process. First step is, you have to identify a contract with the customer. Now what is my contract with the government? My contract is that I have to complete the road. Okay, this is the construction of the road. This is my contract with the government. Second is, what is your performance obligation? Now my obligation is to construct the road in 3 years. This is my obligation. Okay. What is the transaction price? How much revenue you will get from the government? I'm going to get 1,200 crore from the government. Okay. Now allocate the transaction price to the performance obligation. So class, again I repeat, what was my step number 1? Identify the contract with the customer. So my contract is to construct the road. What is your obligation? to complete the road in 3 years. Step number 3, what is the price they are going to get? I'm going to get 1200. Now step number 4. Now step number 4 is your performance obligation is to construct the road in 3 years. Company, how much you anticipate that by the end of year 1, how much percent your work is going to complete? 50% obligation will be over, additional 30% will be over, and additional 20% obligation will be over. Now you are going to bifurcate the revenue in this ratio. You are going to bifurcate your total cost in this ratio, and accordingly you are allowed to book the profits over the period. Now go through step number 4. Allocate the transaction price to the performance obligation. Now you have to divide this 1200 into this particular ratio. And step number 5, recognize or book the revenue as and when your obligation is satisfied. At the moment you are going to complete this much percent of the work, you are allowed to book the revenue. But this is only in case of those companies which are involved in construction of capital assets where substantial time is required. So class, if I sum up LOS 2 and LOS 3, what they are basically trying to say, you are not allowed to book the revenue until and unless your obligation has been fulfilled. Until and unless you have fulfilled your obligations, you are not allowed, irrespective whether you have received the money or you have not received the money. And for those companies which are involved in capital substantial projects, in the construction of capital assets, for those companies there is going to be a 5-step process, and this 5-step process is also known as percentage completion method. Okay, percentage completion method. Now I have completed 50% of the project, I am allowed to book the revenue and I am allowed to book the cost. But this method is only allowed. Now this is known as aggressive accounting because you are booking revenue in year 1. So, but this method would only be allowed if management, you are certain that you will receive the revenue from your customer, and it is certain that you are going to complete everything by the end of year 3. So if there is a certainty that you are going to receive the revenue, then this percentage completion method is allowed, where you are allowed to book the revenue at the end of year 1, at the end of year 2, and at the end of year 3. But this accounting is aggressive accounting. Why aggressive? Because your obligation is not over, but you are allowed to book the revenues. This aggressive accounting is allowed only if there is a certainty that revenue will be received, and certainty that project will be completed on time. Then yes, you are allowed to pre-book the revenues as well. Now within this there is one more concept of gross reporting and net reporting. Okay. So now there is a company by the name Make My Trip. So what does Make My Trip does? So what is the business of this company? So basically they are acting as an aggregator, and now suppose I want to buy a flight ticket from Delhi to Mumbai. So now there are number of airlines available over the website MMT. So let us assume there is Indigo, SpiceJet, Jet Airways. Okay. And now my point is I purchase the ticket from MMT and the cost is 10,000. And now what company will does, MMT will does, company will pass on this amount to Indigo, post deducting their commission, and let us assume that Indigo has a commission of 1,000. Oh, MMT has a commission of 1,000 rupees. That means in this example, MMT Make My Trip is nothing but acting as a sales agent. Now my point is, tomorrow when I'm going to board the flight, so I'm going to have a web check-in. So this web check-in will happen over the website of MMT or over a website of Indigo. So this will happen over the website of Indigo. Now suppose I'm having any issues with the flight, then I'm going to contact. If I have any issues with the flight, then I'm going to contact Indigo. Now suppose I want additional baggage, I am going to contact the Indigo. Now my point is, that means in this example, MMT is doing nothing but only acting as a sales agent. Now what should be the correct accounting? Okay, now very important. Now what should be the correct accounting? Now, Indigo, you will book a revenue of 10,000. And in your books, you are going to show a commission of 1,000 rupees to MMT, and these are going to be your net revenue. That means who has the main obligation here? So now main obligation is of the Indigo. So Indigo, you are going to book the revenue at 10,000, and 1,000 will be transferred to your income statement as commission paid to MMT. And MMT, since you are acting only as a selling agent, you will book only a revenue of 1,000 rupees. So only a commission income of 1,000. You are not allowed to book a revenue of 10,000 rupees. Now I want to give one more example. There is a website by the name Amazon. Now what is the business model of Amazon? Now number of sellers are going to list their product over Amazon, and through this platform buyers are going to buy the goods. That means Amazon is doing nothing but providing a platform where buyers and sellers are meeting. Now my point is, suppose today I order one air conditioner, and the brand is, let us assume the brand is Ojournal, and let us assume that this I have purchased directly from manufacturer over the platform of Amazon. So now what Amazon will earn? Amazon will earn only the commission income. Now my point is, Amazon will earn only the commission income. So now Amazon, you are since acting only as a selling agent, you are allowed to book only the commission income. Whereas Ojournal, you are allowed to book the sales. Let us assume the total air conditioner price is 10,000 or 20,000 and commission is 500. Ojournal, you are going to book the revenue of 20,000, commission income paid to Amazon 500, and your net revenue is going to be 19,500. So point to be noted, if you are acting only as a sales agent, you are not allowed to book the total revenue. You are allowed to book only that portion of revenue which belongs to you. This is going to be your net revenues. Okay. Now class, with this we have covered LOS 1, LOS 2, LOS 3, LOS 5, LOS 6. Now I am moving to my questions part. Okay. Now question number 1. Expenses on the income statement can be grouped by, they can be grouped either by function or nature. So answer is C. Second, an example of expense classification by function. So by function, answer is, this is going to be COGS. Perfect. Question number 3. For this manufacturing company, you have to find out gross profit. Okay. Your revenue is 4 million. Your COGS is 3 million. Now revenue minus COGS is gross profit. So what is my gross profit? This is going to be 1 million. Then question number 5. The following information relates to the sale of its product during 2009, which was the first year of business. Your revenue is 1 million, okay, or 10 lakh. Returns of goods sold, that means sales return. Now my sales return is 1 lakh. Under accrual basis of accounting, how much net revenue should be reported by the company? So now my total revenue was 10 lakh. There is a sales return of 1 lakh. Then how much revenue I'm going to book? I'm going to book a revenue of 9 lakh. Now it is given that you have received a cash of 8 lakh. Now ideally I should receive 9. I have received only 8. Now what is going to be the balancing portion? That balancing portion is nothing but the debtors. I'm going to report a debtor of 1 lakh. Based upon which accounting? Based upon accrual accounting. Now question number 6 important. Question number 6 important. Apex consignment sells item over the internet for the individuals on consignment basis. The company receives the item from the owner. That means you are not the correct owner. Okay, receives the item from the owner, lists them for sale on the internet, and receives 25% commission on any item sold. The company collects the full amount from the buyer, pays the net amount after commission to the owner, Unsold items are returned to the owner after 90 days. That means you are not taking any sort of risk. If customer is going to return the goods, that goods will be returned to the original seller. You are not taking any sort of risk. During 2009, the company has a sales of 22 million and commission received is 5 lakh. Now, how much revenue this selling agent should report in its financial statements? So now, since you are acting only as the selling agent, you're going to report the profits, you're going to report the revenue as 5 lakh. So gross reporting is not allowed, only net reporting is allowed. So answer is A. Then question number 15. A company chooses to change an accounting policy, retrospective. This change requires that, if practical, the company restates its financial statement for. The company will restate its financial statements for prior period shown in the report. Now, ideally in a report, how many years will be shown? So one is going to be the current year, second is going to be previous year. And over previous year, you're going to write restated what? So now in practical life, how many prior years we are going to change? We are going to change the prior periods which are going to be shown in the report, and practically they're shown only 2 years. One is current, second is going to be previous, and this is the requirement of your IAS accounting standard number 1. So answer is C. Plus next question is question number 30. Now net revenue most likely refers to, this is going to be your gross revenue minus any sort of sales return. So minus volume discounts and estimated return. So now what is the meaning of question number 30? Now let us assume that the product that I have sold that has a price of 30,000 and I given a discount of 3,000. So how much revenue I'm going to book? 27,000. Plus I anticipate that there's going to be a 2,000 rupee of sales return. So now my net revenue is going to be gross revenue minus any sort of discounts and minus any sort of sales return. So answer is C. Then next 33. A company with a tax rate of 40% sold a capital asset with a net book value of 5 lakh for 5,70,000. So now class, from my point of view, I have sold my car having a book value of 5 lakh for 5,70,000. So this is going to be a gain of 70,000. Now which of the following amounts related to the asset sale will most likely be reported as a line item on its income statement? So now my first question. Is it my regular income? Answer is no. This is not my operating income. This is my non-operating. And non-operating income will always be shown in the income statement before taxes. So now question number 33. What is going to be the profits before tax? Now profit before tax is equal to 70,000. So answer is C. Then 35. A company sells a non-refundable 2-year service contract for 420 rupees. Based upon historical pattern, the company expects to incur 25% of the service cost in the first year and the remainder in the second year. The amount that you should book in the first year. So now what will happen? So in totality, your contract is for 2 years. And in first year, you're going to incur 25% of the cost. What is your total contract value? 420. So in the first year, how much I'm going to book? This is going to be 420 multiplied by 25%. Answer is 105. So question number 35, answer is A. Then question number 36. An artist cooperative sell its artwork on a consignment basis through a local art gallery. Okay, that means I have a tie-up with an art gallery. I sell my artwork through this particular local art gallery. The cooperative should most likely recognize the revenue when the art gallery have sell the goods to the art workers. So now the moment my painting has been sold by the art gallery, I'm allowed to book the revenue. Now point to be noted, the moment, now there are four more options. Now moment I have delivered the goods to the art gallery, I'm not allowed to book the revenue. So since the risk is there and it has not been sold to the ultimate customer, I'm allowed to book the revenue only when art gallery has sold the goods to the ultimate customer. Okay, so point number C is incorrect. Revenue will not be booked the moment this art gallery has received the good. I'm allowed to book the revenue, Mr. X is allowed to book the revenue only when this art gallery has further sold the goods to the ultimate customer. First point. Second, I'm least bothered with when you are receiving the payment. So B is incorrect, C is incorrect. The correct answer is when your obligation has been over. When this goods has actually been sold to the ultimate customer, then only you are allowed to book the revenue. So answer is A. Then next 38. Unless it is impractical to do so, changes in accounting principles are to be reported. Changes in accounting principle are to be reported retrospectively. Answer is B. Next, 45th. A company A owns 60% of company B. That means from company A point of view, company B is a subsidiary. Company A consolidated income statement most likely includes 100% of company's A revenue and expense and what portion of company's B. So consolidations would always be on 100% basis. Answer is B. Next, 56. Now, 56. Under US GAAP, which of the following would most likely to be reported as operating item on a manufacturing company's income statement? So it is going to be an operating one. Operating means main business. A gain on sale of non-strategic investments. So now let us assume I have a business of teaching. I have some investments in the lines. Okay, and I have liquidated those shares and earned some profit. It is operating? No. Then you have earned, then there's going to be an impairment loss on obsolete inventory. So I purchased some goods and that goods has, and now I am going to charge the impairment over those goods because these goods have become obsolete. Is it going to be an operating loss? Is it going to be the loss of your business? Answer is yes. So B is one of those operating item. Then C is talking about interest expenses. Now important, this has nothing to deal with cash flows. Now important, my main operation is, let us assume, teaching. So any gain, any loss related to with this business, this is going to be operating. Rest all the things are going to be non-operating. Now let us assume recently I purchased one laptop and now the technology has changed. Now I'm going to charge the impairment over my fixed asset. Is it operating? Answer is yes. So now interest expense is going to be financing expense. A gain on sale of non-strategic investment, this is going to be your non-surplus income. Now which is going to be my operating one? This is going to be impairment loss on obsolete inventory. Next, 59. Non-operating items reported on the income statement. So we have just covered. Non-operating items reported on the income statement include, so they basically include interest expense and interest revenue for a non-financial service firm. So now what is meaning of non-financial service firm? For example, if we talk about with respect to HDFC Bank. So now for HDFC Bank, receiving interest cost, these are operating in nature. But for a manufacturing entity, for example, for a ITC Limited. Now ITC Limited received some interest. ITC Limited paid some interest. These are going to be your financing activity. So this is your financing expense. It will be reported as non-operating. So these are non-operating, and from bank point of view, these are going to be operating. So non-operating items include interest expense, interest revenue for a non-financial service firm. Class, as of now, I'm ignoring the cash flow points. This we are going to cover in the chapter cash flow statements. Okay. The next is 74. Analyze gain and losses on securities categorized as available for sale will be routed through. Now they're going to be routed through, they're going to affect the equity, they're going to be routed through OCI. So now EAT, within that EAT they're going to be 4 OCI. This is my total comprehensive income, and this comprehensive income will eventually be transferred to equity in the form of reserves and surplus. So it does affect the equity through OCI. So answer is C. So class, with this we have covered LOS 1, LOS 2, 3, 5, 6. Okay, in totality 6 LOS, and problem number 1, 2, 3, 5, 6, 15, 30, 33, 35, 36, 38, 45, 56, 59 and 74. So this is in totality going to be 15 questions. Now class, before proceeding to the next part, you have to thoroughly revise the LOS that we have covered from the class notes, and again you have to solve the questions which we have covered in the video. So a revision is required before proceeding to the next part. Okay, thank you. Now friends, I'm moving to LOS 4. Describe general principle of expense recognition, specific expense recognition application and implication of expense recognition, choices for financial analysis. Okay. Now first we are going to learn about matching principle. So now one application of matching principle is that is with respect to direct cost. Now whatever the direct cost that you are incurring to manufacture the product, okay, now this will be transferred to income statement based upon matching. Now for example, this we have already covered. Now for example, in totality in this financial year I manufacture 10 bikes, whereas cost to manufacture one bike is 9 rupee per unit. And during this particular year I have sold only 7 units. So now the cost with respect to the 7 units will only be transferred to the P&L account in the form of COGS, and remaining 3 units are going to be shown in the balance sheet as inventory. Now this is based upon which principle? This is based upon matching principle. Now how to compute inventory? In totality there are going to be 3 methods. One is FIFO, second is average, and last one is LIFO. Point to be noted, under US GAAP all the 3 methods are allowed, whereas in case of IFRS, FIFO and weighted average is allowed. On the other hand, LIFO method is strictly prohibited. Okay, this we have to remember. Then how fixed asset will be transferred to income statement? Now fixed asset will be transferred to income statement in the form of depreciation. Now in totality there are going to be how many methods? Class, so this we have already covered. So one is SLM, second is DDP, and last one is unit of production method. Then there is one more method by the name component depreciation, which is applicable in case of IFRS. So depreciation we have already covered, inventory we have covered. Then intangible assets with the limited life should be amortized using the method that affects the flow over time of their economic benefits. Intangible assets with infinite life, example goodwill, are not going to be amortized. However, they are going to be tested for impairment. So these are the methods through which expenses are going to be reported into your income statement. So class, LOS 4 we have already covered. Okay. Now I'm proceeding further. Now in LOS 7 and 8, we are going to learn about calculation of basic EPS and dilutive EPS. So again, there is a requirement by accounting standards that on the face of P&L, you have to report, company has to report basic and dilutive EPS. Now, for example, again we have the annual report of CA, and if I go to the income statement, then on the face of income statement, there is a requirement that company has to report basic and dilutive EPS. Now, what is the meaning of basic EPS? Now, for example, in this entire year, our company has earned a net income of 40 lakh. And in totality, the number of shares outstanding for a company, so number of outstanding shares is equal to 20 lakh, let us assume. So in totality, company has earned 40 lakh rupees and number of outstanding shares is 20 lakh. Now you have to display on the face of P&L, you have to show on the face of P&L what is the earning per shareholder. So now earning per shareholder is going to be 2 rupees. Okay, now how I have computed this? So what is the formula? Now the formula to compute basic EPS is net income. These are the profits which belongs to preference shareholder and equity holder minus preference dividend divided by weighted number of outstanding shares during the period. So before I proceed with this formula, now in a business there are going to be two types of equity holders, or there are going to be two types of shareholder. One is equity and second is preference. So in a business there are going to be two types of shareholder. One is equity, second is preference. Now what is the difference between equity and preference? Now equity holders has a residual claim in the company. So now what is the meaning of residual claim? Whatever is left, this belongs to the equity holder. Now if there's profits, surplus profits, the surplus profits belongs to equity, and if the company is incurring losses, then these losses belongs to equity. Okay, then what is the meaning of preference? Now preference shareholder, as their name suggests, preference, they have two preferences over equity. Number one, they will get a fixed rate of dividend. Okay, second, tomorrow if company liquidates, now let us assume that equity holder has contributed 10,000, preference holders has contributed 20,000 rupee. So in totality, the capital is 30,000. And tomorrow our company didn't perform well and finally it is turning out to be, so finally the company is bankrupt and now we are going to liquidate the company. So we start selling off the assets. And let us assume that in totality we received only 16,000 rupees. So this 16,000 in totality belongs to preference shareholder. We received 22,000. So 20,000 belongs to preference and 2,000 belongs to equity. So now my second preference is, in case of liquidation, they will be given preferences over equity. So now They have two preferences. First, they are going to get the dividend at the fixed rate. Dividend will be paid first to the preference shareholder and then to the equity. And in case of liquidation, they will be given preferences over equity. But now, preference shareholder have no voting power. So they have no voting rights. That means in a company, what is being happening, this is because of equity. Preference shareholder does not have any sort of voting power. That means it is nothing but similar to debt. Okay. Now my point is, we earn a profit of, let us assume we earn a profit of 10,000, and now we have 10% preference share 1 lakh rupee, or 10% preference share 7 lakh rupee. So now what is the dividend that we should pay to the preference shareholder? Now my preference dividend is 70,000, make it 1 lakh, and now I'm left with 30,000 rupees. Now this 30,000 belongs to equity shareholder. Now company may decide that we want to reinvest this 30,000 or we want to distribute this in the form of dividend. Now minus equity dividend. Let us assume company has declared a dividend of 3,000. This 27,000 will be transferred to balance sheet as reserves and surplus. Okay. So now equity holder in totality has earned 30,000. Company decided that 3,000 to be distributed as dividend, and now this 27,000 will be transferred to balance sheet as reserves and surplus. That means this is the additional money which has been contributed by equity holder. Okay. Now my point is, let us assume that in my company there is 10,000 equity shares outstanding. There are 10,000 parts. There are 10,000 shares of my company. Now what is the EPS? What is the earning per shareholder? In totality, they have an earning of 30,000. My company has 10,000 shares outstanding. Now what is going to be the EPS? EPS is going to be 3. Okay, so it was a very simple formula. So my formula was net income minus preference dividend divided by number of outstanding shares. But now look carefully. Here the word is weighted number of shares outstanding during the year. So now the word is weighted. Now what is the meaning of this weight? Now let's understand the meaning of weight. So suppose my financial year starts from 1st April 2021, and at that time I was having 15,000 shares outstanding. Okay, so this is a running company, and at the starting of the year I have 15,000 shares outstanding. Now on 1st October 2021, company decided that we want to buy back 4,000 shares. Buyback. Now what is the meaning of buyback? The meaning of buyback is we are returning the capital of shareholders. So earlier we were having 15,000 shares, but now on 1st October 2021, company decided that we want to return the capital to the equity shareholders. Now you have to find out what is the weighted number of shares outstanding during the period. Okay, now very carefully. There are going to be two alternatives to this. Alternative number 1. At the starting of the year, I was having 15,000 outstanding. Now 15,000 were outstanding for how much period? So April, May, June, July, August, September. So it's going for 6 months. Multiply by 6. Divide by 12. So this is going to be 7,500. Okay, this is the weighted number of shares. And then the moment company has buyback 4,000, now I'm left with 11,000 shares. And these 11,000 shares were outstanding for how many periods? October, November, December, January, February, March. So 6 by 12 equal to 5500. Now my question is, what is the weighted number of shares outstanding during the period? So 7500 plus 5500. This is going to be 13,000. So this is alternative number 1, not recommended in examination. Now we are going to find out the same answer using alternative 2. Now alternative 2 is, assume this 15,000 is outstanding for entire period. Assume this 15,000 is outstanding for entire period. Okay. Now 15 into 12 divide by 12. Now I know that my answer should be less than 15,000 and because there's a buyback. So effective answer should be less than 15,000. Now buyback. Buyback means negative. So I put up a minus sign. You buy back how many shares? 4,000. And what is the period? 6 upon 12. So which period I'm talking about? So I should deduct this particular portion. So 4,000, and this 4,000 belongs to how many periods? 6 divided by 12. Now find out your revised answer. So 15,000 minus 2,000. Again you will get 13,000. So I always recommend alternative 2 in your examination. It's a pretty simple one. So what I have done, first assume this 15,000 is outstanding for entire year and then deduct this particular portion. You will get exactly the same answer. Now I want to build some more difficulties in this. So let us assume that now on 1st April 2021, 15,000 shares outstanding. On 1st October 2021, company says I'm going to buy back 4,000 shares. And on 1st July 2021, company has issued, hypothetically assume, company has issued 12,000 additional shares. Now again you have to find out what is going to be the weighted number of shares outstanding during the period. Now first we are going to solve using alternative 1 and then using alternative 2. So now my first alternative. So for this much period, how many shares outstanding? 15,000. Then for this much period, how many shares outstanding? 15 plus 12, this is going to be 27. And for this much, how many shares outstanding? 27 minus 4, this is going to be 23,000. Now, this 15 is for how many periods? April, May, June. So multiply by 3, divide by 12. Then this 27,000 is outstanding for how many periods? July, August, September. So again going to be 3, divide by 12. And this 23,000 outstanding for how many periods? This is going to be 6 by 12. So what is the final answer I'm getting? 15,000 multiplied by 3, 45,000. 27,000 multiplied by 3 is 81. Stored at 2, 45,000 stored at 1, and 23,000 multiplied by 6 plus recall 1 plus recall 2 divide by 12. So you'll get the final answer as 22,000. Now alternative 2. Assume this is for the entire period. Okay. So now 15 into 12 divide by 12. Then you have issued additional shares. How many additional shares? 12,000. And these 12,000 are outstanding for how many period? Now plus 12,000 multiply by 9 divide by 12. Then you buy back 4,000. Buyback means negative. How much period? 6 months. So this was my buyback. Minus 4 into 6 divided by 12. Now again I find out my final answer. So this is going to be 15,000 multiplied by 12, 1,80,000. 12,000 multiplied by 9, minus 24,000 plus equal 1 divided by 12. Again, you will get the answer as 22,000. Now class, it's up to you. Whichever method you want to follow, you can, but strongly recommended what they have discussed in the books. This is going to be alternative 2. Okay. Now I have to explain one more concept, which is with respect to stock splits and bonus shares. So there are two words. One word is stock split and second word is bonus shares. Okay. Now my question is, in a country there are two cars. One car is, let us assume, Alto, Maruti Suzuki Alto, and second car is BMW 7 Series. So in volume terms, which car do you think have more sales in terms of numbers? So Alto is going to have more sales or it's BMW 7 Series? Now, majority of you will answer that, sir, in terms of number if I have to talk about, then definitely Maruti Suzuki Alto is going to have more sales in comparison to BMW 7 Series. Now my question is, why Alto is having more sales in comparison to 7 Series? Now sir, Alto is a car somewhere in the range to 3 to 4 lakh, whereas BMW 7 Series is a car in the range of 1.5 CR. Since Alto is cheap or inexpensive in comparison to BMW 7 Series, because of which Alto is having more volume. Can I say this? The answer is yes. Now same concept applies to share market as well. So I just give you two options. Now there are two shares in the market. One share in the market is Reliance Industries. So if I put here Reliance, so Reliance, one share is 2100 rupees, 2183. It is reselling in the market, and in a single day there's how many volume? This is going to be 65 lakh. Now what is the meaning of volume? The meaning of volume is how many trade had happened in a single day, how many shares has been bought and sold in a single day. So the volume is 65 lakh and price is 2100. So if I multiply both the figures, so 2183 multiply by 65 lakh. Now in a single day, if I compute in terms of crore, in a single day there's a trading of around 1400 crore on a share like Reliance. Perfect. Now there's one more share. Okay, and before I proceed to this, just give me a second. Okay, now there's one more company by the name MRF. Now MRF one share is for 82,000, whereas Reliance is for 2100. MRF is having 82,000. But look at the volume. Now the volume is 20,000 only. So if I multiply both the figures, 20,000 multiplied by 82,000, and if I want to compute in terms of crore, so my answer is going to be 164 crore. Now share price is 82,000, and in a single day the volume is only 20,000. Only 20,000. Now my question is, because MRF is expensive, so one of the reasons for MRF having low volume is because of its prices. Okay. Now same wise, if I, in the same tire domain, if I search for one more share, that is C8. Now C8 is having a share price of 1300 and volume is 1,27,000. So can I say that the shares which are cheaper in the market, they are going to have more volume? The answer is yes. And anyways, the share price signifies nothing. Now whether the company is large or small, this is going to be in comparison to market cap. Now what is the meaning of market cap? Number of shares outstanding multiplied by that price. Now if I look at the market cap of MRF, so market cap of MRF is 35,000 crore. Okay. And same wise, if I go for market cap of Reliance, Now Reliance has a market cap of 14 lakh crore. Now these prices signify nothing. Okay. Now whether the company is small or large, this is in comparison to market cap, and yes, Reliance is way bigger than MRF. Okay. Now my question is, now what companies does in order to promote the volume? Now currently a company like Reliance, what they will do, let us assume that the share price will keep on increasing and one day it reaches 10,000 rupees. And assume that I'm holding one share. So what is my net worth? Now my net worth is 10,000. Now what company will does to promote the liquidity? Now company says that I'm coming with stock split. I'm going to split one share into two parts. Now my point is, if company comes up with 2-for-1 split, that means one share divided into two parts. Now in totality I'm going to have how many shares? Now I'm going to have 2 shares. But now one share price will reduce to 5,000. Now my question is very simple. What is my net worth? So now my net worth remains unchanged. Then what is the purpose of this split? The purpose of the split is only to promote the liquidity. Now the moment share will become cheap, there's going to be larger volume, or there's going to be more liquidity into the stocks, because of which companies comes up with a concept of stock split. Similar to that, there is one more concept, exactly same. This is going to be bonus share. Now for example, I'm having one share of Reliance, and in the market the Reliance price increases to 10,000. Now company says I'm coming up with 100% bonus share. 100% bonus share means a person who's having one share will be provided free of cost by the company. Now how many shares I'm having? I'm having 2 shares. But again, the share price which earlier was 10,000, it will reduce to 5. And again, my net worth remains unchanged. Now my question is very simple. Stock split, bonus share. Is it going to impact the wealth of the investor? The answer is no. They are basically done to promote the liquidity of the stock. Now I'm going to introduce stock splits and bonus share. So plus important. Now let us assume that on 1st April 2021, I'm having 15,000 shares outstanding, and here company will say that on 1st June 2021 we are coming up with 10% bonus share. That means a person who is having one share, now 0.1 share will be provided free of cost. Okay. Now my question is very simple. We are coming up with 10% bonus share. So earlier company was having 15,000 outstanding share. Now how many? 1,500 has been issued more. So how many outstanding shares now? So this is going to be 1,500 additional. And in totality this is going to be 16,500. Now my question is very simple. Shall I again prorata this? Now prorata means 15,000 for this much period and 16,500 for this much period. Do you think that this is going to be logical? The answer is no. The number of shares outstanding is exactly the same. Now definitely means the shareholders is exactly the same. Now with the help of this bonus, what has happened? The bonus was primarily done to promote the liquidity. Now it will be logically incorrect if I find out the weighted number of outstanding shares in the following manner. 15,000 multiplied by 2 by 12 plus 16,500 multiplied by 10 by 12. Now this is going to be logically incorrect. Now point to be noted. Whenever in the question bonus or stock split is given, so this will apply to all the shares prior to that. But point to be noted, the date does not have any sort of significance. Now important. Now how to compute weighted number of outstanding shares in this particular case? Now I'm not going to read this as 15,000. I'm going to read this as 1,500 additional. So I'm going to read this as 16,500. And weighted number of outstanding share is going to be 16,500 multiplied by 12 divided by 12 equal to 16,500. Okay. So now the bonus, the stock splits and the bonus is not going to have any impact over the wealth, and hence the date is anyways irrelevant. Simply you have to add 10% here and apply to the entire period. So now let's go through the commentary first. You have to compute basic EPS. Now, weighted number of shares is the number of outstanding shares during the period, weighted by the portion of the year they were outstanding. Okay. So now here the outstanding portion will be incorrect. Okay. Then next, a stock split or a stock dividend is applied to all the outstanding shares prior to the split or dividend and to the beginning of period weighted average shares. A stock split or a stock dividend adjustment is not applied to any shares issued or repurchased after the split or the dividend date. Now, what is the meaning of this particular line? So now let's try with one more example. On 1st April 2021, I'm having 15,000 shares outstanding. Now, company on 1st July 2021 decided that we want to issue 12,000 additional shares, and on 1st September company decided that we are going to give a bonus of 20% shares. Now again you have to compute, okay, and this is 20% bonus share, and on 1st January 2022 company decide that we want to buy back 9,000 shares. Now again you have to find out weighted number of shares outstanding during the period. Now 20% bonus. So this 20% bonus will apply to all the shares outstanding prior to that. So now I'm going to multiply here by 1.20. I'm going to multiply here 1.20. Now this figure does not have any significance. So how many shares? 15,000 multiplied by 1.2. This is going to be 18,000 shares outstanding. Then additional, how much you have issued? 14,400, and 9,000 is going to be buyback. So bonus happened here itself. Okay, so it will apply to all the prior outstanding, not after that. Okay, so now again read this line. A stock split or a stock dividend is applied to all outstanding prior to the split. So what important is prior to the split or dividend, and to the beginning of period weighted average shares. It will not be applied to any shares issued or repurchased after the split or the dividend date. So we are not going to apply this to this particular shares. Now you have to find out weighted number of outstanding shares. 18,000 multiplied by 12 divided by 12 plus 14,400 multiplied by 9 divided by 12 minus 9,000 into 3 divided by 12. So now my final answer is this is going to be 26,550. Now these are the shares outstanding for the, and these are the shares that we are going to use for the calculation of EPS. So class, now I want to conclude finally. So if in between you have issued the shares, additional shares, then you have to take that additional period. Same wise, if you have buyback, then that buyback period for which the company has not used this proceeds, you have to deduct that. Then in the question they may provide you with buyback, or they may provide you with stock dividends or stock splits. It is going to apply to all the shares prior to that. Important point to be noted that this date does not have any other significance. Just the purpose is that it will apply to all the prior period. Now I'm going to multiply here 1.2, and I'm going to calculate the answer in the similar fashion. So these are going to be the way we are going to compute basic EPS. So now class, what is my final formula now to compute basic EPS? equal to net income minus preference dividend divided by weighted outstanding shares during the period. Now friends, I am proceeding further to the calculation of dilutive EPS. Now what is the meaning of dilutive EPS? Now could be possible that in your current capital structure you are having dilutive securities. Now what is the meaning of dilutive securities? That if they get converted into equity, then the current equity holders EPS may reduce. So this is the meaning of dilutive. Now for example, in our syllabus there are going to be 3 potential dilutive securities. Number 1 is convertible preference share. What is the meaning of convertible preference share? That means for the first, let us assume that for the first 3 years, the company is going to pay fixed rate of dividend, and after 3 years, this preference share will convert it into equity. Then convertible debt. What is the meaning of this? Let us assume that this convertible debt has a life of 3 years. Now for the first 3 years, company is going to pay the interest, and post that this debt will convert into equity. And last one is going to be share warrants. Now in totality there are going to be 3 potential dilutive security. Now first I am going to start with convertible preference share. Now let us assume that we are having a 50 lakh of convertible preference share capital with a dividend of 10%, and post 3 years these are convertible into equity. Now what is the meaning of this? The meaning is for first 3 years company will pay fixed rate of dividend, which is going to be 5 lakh, 5 lakh and 5 lakh, and at the end of 3rd year it will get converted into equity. And now you have to check if it will get converted into equity, the current EPS is going to increase or reduce. If current EPS will reduce, then this will be termed as a dilutive security. If current EPS will increase, it will be termed as anti-dilutive. Now point to be noted, based upon the principle of prudence, dilutive EPS is going to be reported on the face of P&L. So now let's understand with the help of an example. Now example number 1. You have to compute, now this is EPS with convertible preferred stock. During 2021, a company reported net income of 43,50,000 and had 20 lakh shares common stock. Common stock means equity, of equity outstanding for the entire year. Okay. ABC 7%, 50 lakh preferred stock is convertible into equity at a conversion rate of 1.1 share for every $10 of par value. You have to compute basic and dilutive EPS. Okay. So now what is there in my current capital structure? In the current capital structure, we are having 20 lakh of equity shares outstanding, and in totality, now rupees is given. So in totality we have 50 lakh of preference share capital, where one share value is $10. So how many shares we are having? We are having 5 lakh preference share outstanding. And how much dividend you have to pay? You have to pay a dividend of 7%. Now first is that we have to compute basic EPS. So step number 1. basic EPS is equal to net income minus preference dividend divided by weighted average outstanding equity shares equal to, now your net income is 43,50,000, but now you have to pay dividend. How much dividend? 50 lakh, 7%. Now 50 lakh 7% is equal to 3,50,000. And how many shares outstanding? This is going to be 20 lakh. So what is my basic EPS? My basic EPS is $2 per share. That means currently one equity shareholder has earned $2. So what is the earning per shareholder? The company has an earning of $2 per share. Okay. Now step number 2. Now my question is, if tomorrow this preference share will convert into equity, so then company is going to pay preference dividend to the shareholder? The answer is no. Then what is going to be the savings to the company? So now if convertible preference shares will convert into equity, then what is going to be the savings to the company? Then firm will not pay any preference dividend. As a result, total earnings will increase by, so how much dividend you have paid? 3,50,000. Now you're not going to pay that dividend. So total earnings will increase by $3,50,000. Okay. But this is the one part. But correspondingly, you have to pay them equity shares as well. Now how many preference shares you are having? So right now I'm having 5 lakh preference shares outstanding. Okay. And after 3 years, it will get converted into. Now, however, at the time of conversion, firm has to issue new equity shares kitna? Equal to 5 lakh preference shares multiply by, now what is the conversion rate? Multiply by 1.1. So how many new equity shares you have to issue? This is going to be 5,50,000. Now you are going to compute one ratio. So what that ratio is signifying? That ratio is basically signifying addition in earnings divided by addition in equity share capital. So now your earnings will increase by 3,50,000, but correspondingly shares will increase by 5,50,000. So if I compute this ratio, my answer is $0.636 per share. Now class important. If answer in step number 2 is less than answer in step number 1, then potential security is dilutive. Then the potential security is dilutive, and you have to proceed to step number 3. So if answer in step number 2 is less than answer in step number 1, potential security is dilutive and you have to proceed to step number 3. Else, if answer in step number 1, else answer in step number 2 is greater than answer in step number 1, potential security is anti-dilutive and hence we will conclude that dilutive EPS is equal to basic EPS. That means maximum value of dilutive EPS is equal to basic EPS. Okay, and either it is going to be less than basic EPS or maximum it is going to be equal to basic EPS. Now class, in my case, answer in step number 2, is it less than answer in step number 1? So my answer in step number 1 was $2. My answer in step number 2 is $0.636. Is it less than answer in step number 2? Is it less than answer in step number 1? Yes. That means the potential security is dilutive. And now I'm proceeding to step number 3. Now step number 3. Calculation of dilutive EPS. So dilutive EPS is equal to, now class, my question is very simple. Earlier, what was your numerator? So earlier, my earnings was 40 lakh and this earning of 40 lakh belongs to 20 lakh shareholders. But now my earnings will increase by, 3,50,000. Now you have to tell me what is the total earnings of these shareholder. So if tomorrow preference will convert into equity, then what is going to be the total earnings? Now my total earnings is going to be, so earlier it was 40 lakh and now it will increase by 3,50,000 divided by, earlier there were how many shareholders? There were 20 lakh shares outstanding, but now company will issue how much additional? That is going to be 5,50,000. Now what is going to be my basic EPS? Now my basic EPS is 25,50,000. Now this is going to be $1.70 per share. Now what you are going to report on the face of P&L? On the face of P&L you are going to report basic EPS equal to $2, dilutive EPS equal to $1.70 per share. Now point to be noted, dilutive EPS will maximum be equal to basic EPS or it is going to be less than basic EPS. It cannot be greater than. And how we are going to check this? The moment answer in step number 2, is less than answer in step number 1, then always the answer in step number 3 is going to be less than answer in step number 1. So this check you have to perform. Always you have to perform step number 2. If you're not going to perform step number 2, you will get an incorrect answer. Now I want to make some changes here. Now let us assume that whatever the dividend that I'm going to pay, that dividend was 10 lakh. Hypothetically 10 lakh dividend. And how many shares I have to issue? This is, so let us assume that I have to pay a dividend of 15 lakh. And how many shares I have to issue? This is 5,50,000. So now what is going to be the answer in step number 2? So answer in step number 2 will be $2.72. Now if I proceed to step number 3, so answer in step number 3 is going to be greater than step number 1. So I want to verify the answer. Now your earnings was 40 lakh. Now earnings will increase by 15 divided by 20 plus 5.5. Now the revised answer is coming out to be 2.15. 2.15. Now my question is very simple. Can dilutive EPS be greater than basic? No. So meaning of dilutive is, what is the meaning of dilutive? We are giving a signal to the shareholders, though company right now is reporting a earnings of 2 rupees, but tomorrow could be possible if earnings remain constant, then your EPS may decline to 1.70. So this is keeping in mind the prudence principle. But now you're showing that basic EPS is 2, dilutive EPS is 2.15. Now it is against the principle of prudence. So we are not going to proceed to step number 3. And in this case, we will conclude that dilutive EPS is equal to basic EPS is equal to $2. Okay. So now class, a quick revision here. So step number 1. Step number 1 is that you have to compute basic EPS, where the formula is earnings which belongs to the equity shareholder divided by number of equity shares outstanding. So in my case, the earnings which belongs to the equity shareholder, that was 40 lakh divided by 20 lakh, answer was $2 per share. Now tomorrow, if preference will convert into equity, now I have no obligation to pay preference dividend, my earnings will increase by 3,50,000. Perfect. Like on the contrary, now I'm going to issue 5,50,000 more shares. Now, if I compute a ratio, addition in shares and addition in income and divided by addition in shares, this is going to be 0.636. It is less than answer in step number 1. Yes. So potential security is dilutive. Then you're going to step number 3. In step number 3, what will be my final earnings belonging to all the shareholders? This is going to be 40 lakh plus 3,50,000 divided by 20 lakh plus 5,50,000. Now my dilutive EPS is going to be 1.70 per share. Now I'm moving to my second potential dilutive security. Now my second potential dilutive security is convertible debt. So again, what is going to be step number 1? Step number 1 is basic EPS equal to, now my next example. During 2021, company had earnings available to the shareholder of 25 lakh and had 10 lakh shares outstanding for the entire year, resulting into basic EPS of 2.50. So now 2 lakh, now 25 lakh is the earning, 10 lakh shares outstanding. So basic EPS is $2.5 per share. Step number 2. Now during 2020, company has issued 2,000 bonds, where one bond has a value of $1,000 and company is paying an interest of 5% on that. So now how many bonds I am having? So in totality you have raised 20 lakh. Over this 20 lakh you are paying an interest of 5%. Okay. And how many bonds you are having? One bond has a value of $1,000. So in totality I am having 2,000 bonds. Okay. Now each of this bond is convertible to 120 equity shares. Tax rate is 30%. You have to compute dilutive EPS. Okay. Now how step number 2 changes in case of convertible debt. Okay. So now class, my point is, let us assume that my EBT is 100. Sorry, my EBIT is 100. Interest is 10. EBT is 90. And tax rate in my country is 20%. So I have to pay 18 rupees to the government. And 72 is the EAT which belongs to equity shareholder. Okay. Now my point is, currently I am having debt in my capital structure, because of which I have to pay an interest of 10 rupee. Now let us assume that tomorrow, if I don't have this debt, then what is going to be my revised profits? So your EBIT is going to be 100, interest 0, EBT 100. Now you have to pay tax of 20 rupees to the government. and you're left with 80. Now my question is, my expenses are reducing by 10. On the contrary, my profits are increasing by 8 only. Why? Now because interest expenses are tax deductible. Because of which when you're not going to incur anything, your profits will increase by 8 only. Now important. Now you, that means the firm, and the government is having a partnership firm sort of, where government is having 20% share and firm is having 80% share. Now whatever the expenses, now the moment you say that I'm not going to pay any sort of interest, so in totality expense will reduce by 10. Now this 10 has two parts. 8 rupees expense of firm has reduced, 2 rupees expense of government has reduced. As a result, total profitability will increase by 10. 8 profitability of firm will increase and 2 profitability of government will increase. Now my question is very simple. Though in my statement it is appearing as 10, but effectively it is costing me how much? It is costing you 8. Now how to find out 8? Now 8 is going to be interest 1 minus tax rate. This is going to be 10, 1 minus 20%, and my answer is going to be $8. Now compare this with preference dividend. Now you're having a EAT of 100. You pay preference dividend of 10, and now this 90 belongs to equity shareholder. Now tomorrow if I'm not going to pay any sort of dividend, preference dividend, then my earnings will increase by 10. So in case of preference dividend, my formula for step number 2 was preference dividend divided by additional shares to be issued. But when I'm going to compute for debt, so by how much my profits will increase? This is going to be the interest 1 minus tax rate divided by additional shares to be issued. Now class, I'm proceeding to my example now. So I have already computed my basic EPS to be 2.5. Now my next point is, tomorrow if debt converts to equity, then firm will not pay any dividend. Firm will not pay any interest. However, firm has to issue new equity share capital. Okay. Now you have borrowed how much? 20 lakh. On this 20 lakh, how much interest you are paying? 5%, which is equal to 1 lakh rupees. And in your country, tax rate is 30%. So my interest is 1 lakh. Tax rate is 30%. So how much belongs to the government? 30,000 belongs to the government. And how much belongs to the firm? This is going to be 70,000. Now if debt converts to equity, then firm will not pay any interest. So equity profits will increase by interest 1 minus tax rate divided by additional equity shares to be issued. 1 lakh multiplied by 1 minus 0.3, and how many shares you have to issue? For one bond you have to issue 120 shares. Now how many bonds I'm having? 2000. 2000 multiplied by 120. So now my answer for step number 2 is 70,000 divided by 2000 and 120. So my answer is going to be $0.29167. Is it less than answer in step number 1? Answer is yes. So now answer in step number 2 is less than answer in step number 1. That means potential security is dilutive in nature. Proceed to step number 3. Now step number 3, dilutive EPS is equal to, so what was your earning? My earning was 25 lakh. Now this earning will increase by 70,000 divided by how many shares were earlier outstanding? 10 lakh. And how much you have to issue more? So 200,000 multiplied by 120. So I have to issue more. 2,40,000. Now what is my revised answer? My revised answer is $2.07 per share. So what was my basic EPS? My basic EPS was $2.5 and my dilutive EPS is $2.07. Now what this dilutive EPS is trying to convey? That tomorrow if the earnings remains constant, then could be possible, though the company is reporting that currently shareholders are earning 2.5, this earning may reduce to 2.07. Based upon which principle? Based upon prudence principle. So class, with this we have covered 2 potential dilutive security. 1 convertible debt, 2nd convertible preference share. Now point to be noted. Step number 1 is to compute basic EPS. Step number 2 is to compute your savings. If preference will convert into equity, then my savings is going to be dividend divided by number of additional shares to be issued. However, in case of convertible debt, my savings is going to be interest net of tax, because this interest belongs to 2 persons. So interest net of tax divided by number of equity shares to be issued. If answer in step number 2 is less than answer in step number 1, then you are proceeding to step number 3 and you are going to find out dilutive EPS. If answer in step number 2 is greater than, then it is anti-dilutive. Then you are going to conclude dilutive EPS is equal to basic EPS is equal to whatever the figures you are getting. So you will not proceed to step number 3 if answer in step number 2 is greater than answer in step number 1. Now with this, I am proceeding to my last potential dilutive security. This is EPS with stock options. Okay. Now my point is, what is the meaning of stock options or stock warrants? So if I talk about any company, let us assume Google. So now who is the CEO of Google? That is Sundar Pichai, and his maximum remuneration is in the form of stock option. Now what is the meaning of stock option? Company is giving the right to CEO to buy the shares from the company at a lower price. Okay. Now my point is, let us assume that Sundar Pichai has the right to purchase Google share at an exercise price of $1,000, whereas in the market share price of Google is $1,500. So now let us assume that the company has issued options to the CEO, where the CEO has the right to purchase the share at an exercise price of $1,000, whereas in the market share is trading at $1,500. Now, do you think that Sundar Pichai will offer this offer? So the answer is yes. So if exercise price is less than average market price of share, then employee will exercise the right. Okay, and if he exercises, then definitely you are going to issue him the shares. Your earnings will not increase by anything, and you have to issue new shares. So now again you are going to compute dilutive EPS. So now let's understand with the help of an example. Now during 2006, company reported earnings available to common shareholders of 12 lakh and had 5 lakh shares outstanding for the entire year in such a way that your basic EPS is 2.40. So now my example. Step number 1. Basic EPS is equal to 12 lakh divided by 5 lakh is equal to $2.4 per share. Okay, now company has 1 lakh stock options outstanding for the entire year. So now 1 lakh stock options are outstanding for the entire year. Each option allow his holder to purchase 1 share at 15 rupees per share. So what is my exercise price? How much you are demanding from your employee? That is 15 rupee. Whereas the average market price of the share is 20 rupees. So now company had 1 lakh options outstanding, where the employee has the right to purchase the share at $15, whereas average market price of share is $20. Now will employee will exercise? Now you have to pay less. Will employee will exercise? Yes. If your answer is yes, I'm going to exercise. It is known as in the option. Sorry, it is known as in the money option. And if you're not going to exercise, this is known as out the money. So in this case, yes, employee will exercise because he has to pay less. It is going to be in the money option. Okay. Now what will happen? Now important. So now you're going to exercise this option. And how much eventually you will pay to the company? Now you're going to pay 1 lakh multiplied by 15 equal to 15 lakh rupees to the company. Okay. And now company has the obligation. To issue 1 lakh shares. Okay. Now my question is, share is available in the market at what price? 20. Now company will go into the share market and purchase the share at a price of 20. So with the help of this 15 lakh, company will purchase the share from the market at a price 20 rupees per share. Now how many shares I'm going to purchase from the market? So with the help of this 15 lakh collected from employee, firm will purchase the shares from open market at a rate of 20 rupees per share, or at a rupees, make it dollar, at $20 per share. So how many shares I'm going to purchase? 15 lakh divided by 20. Now you're going to purchase 75,000 shares. This you are going to purchase. But your obligation is to issue how much? 1 lakh. Now to fulfill your obligation, how much additional issue you are going to make? Now to fulfill the obligation of 1 lakh shares, firm has to make 25,000 additional share issue. Now my point is very simple. So in step number 1, you have computed your basic EPS, which is 2.4. Now step number 2. Will your income will increase by anything? When you issue this ESOPs, will your earning will increase by anything? No. But how much you have to issue additional? 25,000. Now 0 divided by anything. This is 0. Is it less than answer in step number 1? Is it less than answer in step number 1? Yes. Now I'm proceeding to step number 3. What is my dilutive EPS? My dilutive EPS is earlier earnings, which was 12 lakh, plus 0 divided by 5 lakh plus 25,000. So now my dilutive EPS is this is going to be $2.28. So my basic was 2.4 and my dilutive EPS is 2.28. So now class, let's conclude everything. In totality, how many potential dilutive securities? So potential dilutive securities are, okay, I skip one point. Okay, so how much additional issue company has to make? This is going to be 25,000. Okay, now this 25,000 I can compute by one more method, a simpler one, using a formula, and that method is known as treasury stock method. Now my question is very simple. Your exercise price is $15 and average market price, point to be noted, again and again I'm using a word average, not closing, and average market price is $20. So you're getting a share having a value of 20 at 15. So how much discount your company is giving? So your company is giving a discount of 5 over a value of 20. So how much discount company is giving you? A company is giving you a discount of 25%. Now point is very simple. Firm obligation is to give 1 lakh options, but with the help of your own money, how much shares I'm going to purchase from the market? I'm giving you a discount of 25%. So 75 I'm going to purchase from the open market. Now how much additional issue I have to make? This is going to be 25,000. So now what is the formula? Very simple formula. 1 minus EP upon AMP into N. Now carefully, 15 I charge from you. In totality price is 20. So 15 divided by 20, this is going to be 0.75. Now how much discount I'm going to give you? So the discount that I'm going to give you is 1 minus 0.75, that is 25% is the discount, into 1 lakh. Now how much shares you have to issue? This is going to be 25,000. Now my point is, if in the given case exercise price is 25, now will employee exercise the option? Will you be willing to buy a share having a market value of 20 at 25? Answer is no. So then in step number 2, you need not to issue anything, and you will finally conclude that dilutive EPS is equal to basic EPS is equal to 2.4. Okay, and now in totality there are going to be how many dilutive securities? 3. So first one is convertible convertible preference share, second is convertible debt, and third is stock options. So while computing step number 2 for convertible preference share, dividend paid to preference shareholder divided by additional equity issuance. Now in case of convertible debt, additional equity issuance, this is going to be your denominator, additional equity issuance. So your denominator is same in all the three cases, but what is going to be the numerator in case of convertible debt? Interest net of tax, and in case of stock option your numerator is going to be 0. And then in step number 3, what you have to do, you have to increase your earning by this particular amount, you have to increase your denominator by this amount, and this is going to be your dilutive EPS. Now let's go through the notes. Now the important word is, remember, each potential dilutive security must be examined separately to determine if it is actually dilutive. Now what is the meaning of this red line? Now let us assume that in the question they provide you with convertible debt, convertible preference share. Now you are going to perform step number 2 for this security and step number 2 for this security separately. And let us assume my answer in step number 1 is 2.5. Here you are getting 2.4 and here you are getting 3. Then I will conclude that convertible debt is dilutive, convertible preference share is anti-dilutive. So when you are going to compute the dilutive EPS in step number 3, then we are going to consider convertible debt only and we are going to ignore convertible preference share. So class, this line is very important. Again, go through that. Remember, each potential dilutive security must be examined separately. That means you have to compute answer in step number 2 separately for convertible debt and convertible preference share to determine if it is actually dilutive. Now, I want answer in step number 2 to be less than answer in step number 1. If this is the case with convertible debt, then convertible debt is dilutive and convertible preference share is anti-dilutive. While computing the answer as per step number 3, you are going to consider this and you are going to ignore this. So class, this was with respect to calculation of basic EPS and dilutive EPS. Now I am proceeding further. Now my next is, you have to convert income statements to common size income statement. Now what is the meaning of common size income statements? Now my point is, in maths there was a test and in one test I scored 9 and in another test I scored 100. So this is my test number 1 and test number 2, and in which test I performed better. So in one test my marks are 9 and in the second test my marks are 100. In which test I performed better? Now you may think that I performed better in test number 2. Okay, and you are comparing absolute numbers. So now I'm going to add one more figure. So this test number 1 in totality is out of 9 marks, and test number 2 is out of 10,000 marks. Now where I perform better? Now you perform better in case of test number 1. So now here I am getting 100% and here I am getting 1%. So class, can I say this, that absolute numbers are not comparable, and to find out whether our performance have improvised or deteriorated, then we have to find out some sort of ratios. Now one of those statement is common size statement. Now what is the meaning of common size? Now let us assume that in 2019 my sales is 100, my COGS is 70 and my gross margin is 30. Now you want to convert this income statement to common size. Now divide each and every item of your income statement by total sales. So this is going to be 100%. You have to divide everything by 100, 70%, and my margin is 30%. Now 2020, my sales is 120. My cost is 80, and my gross profit is 40. Now again you are going to divide each and every item by 120. So 100%, then 80 divided by 120, this is 66.67%. 40 divided by 120, this is going to be 33%. Now class, my question is, last year my margins were 30%, this year my margins has increased to 33. So over the period my performance has improvised. Now what is the purpose of common size statement? The purpose of common size statement is to compare your profitability. So it is important for time series analysis. Meaning of time series is the comparison of a firm with itself over the period of time. So now in 19 HUL margins were 30%, in 20 HUL margin is 33. So I'm comparing HUL performance with HUL over the period of time. Plus it is also used for cross-sectional performance. Now what is the meaning of cross-sectional? Here I'm comparing HUL margins with competitor. Now for example, one of the competitor is Nestle. Now HUL margin in 2020 is 33.33%, whereas Nestle margin in 2020 is 30% or 17%. So now I conclude that yes, HUL performed better with respect to their peers in 2020. So this is known as cross-sectional. Cross-sectional means where I am performing the performance of 2020 of HUL with its competitor. Time series means I'm comparing my performance with myself over the period of time. So this is the purpose of common size statement. Now two important ratios which you have to keep in mind while comparing the performance. One is known as gross profit margin. Gross profit margin is equal to gross profit divided by sales, and next is net profit margin, where the formula is net profit divided by sales. So class, this was my LOS 9 and again LOS 10, the ratios that you have to cover. So two important ratios were gross profit margin and net profit margin. Higher this ratio signifies you are having a better profitability. So this was my LOS 9 and 10. Now 11 and 12. You have to describe, calculate, interpret comprehensive income, describe other comprehensive income, and identify major types of items included in it. Perfect. Now my income statement ends at EAT. Okay. Now post that I'm going to add other comprehensive income. In totality there are going to be 4 other comprehensive income. Number 1, unrealized gain and losses from available for sale security. Second, unrealized gain and losses from cash flow hedging derivatives. Third is going to be foreign currency translation gain and losses. Then fourth one is pension obligation, and summation of all these, summation of EAT with all these 4 OCI is known as total comprehensive income. And now this comprehensive income will be transferred to one more statement, that is statement of changes in equity. Okay. Now first, let's understand the meaning of 4 OCI. So pension obligation we have already covered in the chapter non-current liability, where it is on account of change in actuarial assumptions. So change in defined benefit obligation on account of change in actuarial assumptions, this is going to be the part of OCI. We have already covered unrealized gain and losses from AFS. Now I am left with 2 items. Number 1 item is unrealized gain and losses from cash flow hedging derivatives. So now class, what is the meaning of cash flow hedging derivatives? This we will learn in the unit derivatives. So as of now, I am not in a position to comment anything, but this you have to remember that unrealized gain and losses from cash flow hedging derivative, it is going to be part of OCI. What is the meaning? This we are going to cover in the chapter derivatives. And last one is foreign currency translation gain and losses. So now again, what is the meaning of this? We are going to learn in level 2, but still I want to give you a brief explanation. So now my point is, if I talk about a company like Google, Facebook, Microsoft, so Amazon, so now my point is, all these companies are earning revenue only from America, or though these companies have global offices as well. Now Google is earning money from Europe, from Canada, from America, from India. Same wise, Amazon, Microsoft, all these companies are MNCs. They are earning globally. So now, for example, if I see from Google point of view, so now their main company, their main headquarter is in America, and they have one office in India as well, Google India, then Google Pakistan, Google Europe, and so on. Now my point is, when they are doing operations in India, so here in India, their P&L balance sheet will be prepared in accordance with, so this is prepared in accordance with rupee. In Pakistan, it is going to be prepared in accordance with Pakistani rupee, and in Europe, it is in accordance with euros. Now my point is, right now you just covered that parent company, so all these are my subsidiaries. Now Google US is 100% parent of Google India, Google Pakistan, and Google Europe. And you have just covered that if I'm having a share of more than 50%, now Google US is supposed to consolidate these financials as well. So the financials of these subsidiaries. Now my subsidiary has prepared financials in a different currency, that is rupee, and I want to consolidate this into a currency of USD. Now any changes, while at the time of translation, if there's going to be any gain and loss, then this gain and loss is not going to be the part of income statement. This is going to be the part of OCI. So now how this gain we are going to compute, this we are going to learn in level 2, but just keep in mind that this is on account of translation. So now I want to convert rupee figures into dollars. So definitely there's going to be some foreign currency translation gain and loss. This is not a part of income statement. This is going to be the part of OCI. Okay. So now in totality there are going to be how many components? 4. 1. Unrealized gain and losses from available for sale, unrealized gain and losses from cash flow hedging derivatives, foreign currency translation gain and loss, and last one is pension obligation. Now my point is, very important point, that nowhere here I have mentioned the dividend paid. Now point to be noted, whatever the dividend that I have paid or whatever the shares that I have buy back, this is not going to be the part of income statement. Now important. Okay. Now till now I was saying that collectively 3 statements are known as financial statement, or 4 statements. Number 1, income statement. Number 2, balance sheet. Number 3, cash flow. Number 4, notes to accounts. And now I am adding one more statement. This is going to be statement of changes in equity. Now, any transaction with the equity shareholders, this is not going to be the part of income statement. Now, for example, I have paid a dividend. Now, this dividend will not be reflected in income statement. It will be reflected in statement of changes in equity. Now, let us assume my total comprehensive income is $500. So now this total comprehensive income will flow to statement of changes in equity. So what is the earnings? Earnings is 500 crore. What was your earlier capital? My earlier capital was, let us assume that 1000 crore, and we decided that we are going to give a 200 crore as dividend. So now what is going to be my final equity? My final equity is going to be 1300 crore. Now what is testable from the point of view of examination? Dividend paid by the company, shares buyback by the company, is it a part of income statement or statement of changes in equity? So no transactions with the shareholders by the company will be reported in income statement. That will be reported in statement of changes in equity. So now if I move to financial statements of C8, now here you will find one statement by the name statement of changes in equity, and whatever the dividend that company has paid during the period. So this dividend is going to be shown in statement of changes in equity. This is not a part of income statement. This is going to be the part of statement of changes in equity. Okay. So now class, with this I have covered all the concepts. Now friends, I am moving to the questions based upon the concepts we have covered. Okay, so now my first question is question number 8. During 2009, the company which began business in October last year purchased 10,000 units of a toy at a cost £10 per unit. Okay. The toy sold well in October. In anticipation of heavy December sales, the company purchased 5,000 additional units in November at a cost of 11. During 2009, company in totality have sold 12,000 units. Using the method FIFO, you have to find out what is my COGS for 2009. So now what is given in question number 8? So you first purchase the lot 10,000 units at a price of 10. Then again you purchase 5,000 additional units at a rate 11. In totality you have sold, during the period you have sold 12,000 units, and you have to find out your COGS using FIFO method. Okay, so now I have sold 12,000. Now from the first lot there's going to be 10,000 units at the rate 10 rupee, and from the second lot I'm going to get 2,000 at a rate 11. Now this is going to be my COGS. So 10,000 multiplied by 10, this is going to be 1 lakh. Then 2,000 multiplied by 11, this is going to be 22,000. So now my total COGS is going to be 1,22,000. This is going to be my COGS. And what is going to be the inventory? My inventory is 3,000 units at the rate 11. This is going to be 33,000. Now in totality, how much you have spent? 1,55,000. Now I divided 1,55,000 into two parts. 1,22,000 is my COGS and 33,000 is my inventory. So answer to question number 8 is B. Now question number 9. Using the same information as in 8, what is going to be the COGS using the weighted average cost method? Okay. Now in totality I have spent 1,55,000 and I have purchased 15,000 unit. Now what is going to be the cost per unit? 1,55,000 divided by 15,000. This is going to be the per unit rate. How much you have sold? 12,000. Now this is going to be my COGS. 12 divided by 15 multiplied by 1,55,000. Now this is 1,24,000. So answer to question number 9 is C. Then which inventory method is least likely to be used under IFRS? Now under IFRS you are allowed to use FIFO method and weighted average. But which method is prohibited? This is the LIFO one. Answer is B. Then 11th. At the beginning of the year, the company purchased a new machine for its assembly line at a cost of $6 lakh. The machine has a life of 10 years with an estimated residual value of 50,000. Using SLM method, you have to find a depreciation. Now what is going to be my depreciation? This is 6 lakh minus 50,000, 5,50,000 divided by 10. So my answer is 55,000. Answer is A. Using the same information in question number 11, you have to find out the depreciation using double declining balance method. So now question number 12. So for DDP, our formula is 2 upon life, which is 10, multiplied by original cost. This is going to be 6 lakh. 60,000 2. So my answer is 1,20,000. So what is going to be the depreciation using DDB? This is C. Then next, which combination of depreciation method and useful life is most conservative? So what is the meaning of conservative? That means you are showing more expenditure into your P&L. Okay. So which one is the more conservative? So now there are two methods. One SLM, DDB. Where the amount of depreciation will be higher? This is in case of DDB. Okay. So now either the answer is B or C. Now B, you have a longer life. Now if you have a longer life, then your denominator is going to be higher. You're going to charge lower expenditure. On the other hand, if you're assuming a short useful life, that means your denominator is shorter, you're going to charge more expenditure. Now which is going to be more conservative? More conservative means more expenditure into your P&L. So now in case of option number C, there's going to be higher depreciation which is transferred to your P&L account. Answer is C. Then 14th. Under IFRS, a loss from destruction of a property in a fire, okay, most likely be classified as, now within OCI there are going to be only 4 items. So now none of the item is destruction of property in a fire. So C cannot be an answer. Discontinued means those divisions which are you planning to sell off. Is it my division? Answer is no. So it is neither B nor C. Now the correct answer is it is going to be classified as continuing operations. Now what is the meaning of continuing operations? That means it is going to be shown in the P&L before tax basis. Had it mean it is a discontinued, then after tax basis, and if it is an OCI item, then it will be shown post EAT. So now we are going to classify this as continuing. Continuing means we are going to show this, whatever the loss we are having, on pre-tax basis into my income statement. Answer is A. Then 16th. For 2009, okay, and class, I just want to clarify one more thing here. So by default, if they are writing for 2009, that means it's a calendar year. The company is using calendar year, where the first day, the first day of the period is for which the company is preparing the P&L. This is going to be 1st January, and the ending date is 31st December. Okay, so by default, we are going to follow the calendar year. So now for 2009, the company had net income of 1 million. At 1st January 2009, there were 1 million shares outstanding. Perfect. On 1st July 2009, the company issued 1 lakh new shares. The company paid 2 lakh in dividend to common shareholders. What is going to be the basic EPS for 2009? So question number 16. Basic EPS is equal to net income minus preference dividend divided by weighted outstanding shares. Now what is my net income? My net income is 10 lakh. This is going to be my net income minus. Now preference. Do you have any sort of preference share capital? Answer is no. So now preference dividend is going to be 0 divided by. Now class, very important. the company had paid 2 lakh in dividends to the equity shareholders, not to the preference shareholders. So we don't have any sort of preference shareholder in this question. So minus 0. And now you have to find out weighted number of outstanding shares. So 1st January 2009, it's going to end on 31st December 2009. And at the starting of the year, my company was having 10 lakh shares. Okay. Then on 1st July, company has issued 1 lakh new shares. Now you have to find out weighted number of shares. So now my weighted number is 10 lakh multiply by 12 divide by 12 plus 1 lakh multiply by 6 divide by 12. So this is going to be 50,000 and 10 lakh. So my answer is 10 lakh 50,000 divided by 10 lakh 50,000. So your basic EPS is 10 divided by 10.5. Answer is 0.95. So 16th answer is C. The next 17th. For its fiscal year ended, the company reported net income of 12 million, weighted average of 2 million common shares outstanding. The company has paid 8 lakh in preference dividend and had 1 lakh options outstanding with the average exercise price of 20. Market price over the year average $25 per share. You have to compute dilutive EPS. Now for dilutive EPS in totality there are going to be 3 steps. Step number 1, you have to find out basic EPS. So basic EPS is going to be net income. Now my net income is 12 million minus. Then the company has paid 8 lakh in preference dividend. 8 lakh is nothing but 0.8 million divided by. Now how many shares outstanding? This is going to be 2 million. So what is my EPS? 12 minus 0.8 divided by 2. Now this is going to be 5.6 dollar per share. Now step number 2. Now you have options. Okay, 1 lakh options outstanding with the exercise price 20 and average market price 25. Now you have the right to pay 20 and get an asset which has a life of 25. In the money, out the money. You have to pay less. If you have to pay less, this is going to be in the money. And if it is in the money, then definitely the employee will exercise this option. Now how many additional shares the company is going to issue? Using the treasury stock method. 1 minus 20 upon 25 multiplied by 1 lakh. So my answer is this is going to be 20,000. Now step number 2. This is step number 1. Step number 2, 0 upon 20,000. This is equal to 0. Now I'm proceeding to step number 3. Now in step number 3, this is going to be 11.2 million divided by 2 million plus 20,000. Now what is going to be your dilutive EPS? 11.2 million divided by 2 million plus 20,000 equal to. So this is going to be 5.54. My answer is B. The next 18th. A company with no debt or convertible securities. So there is no dilutive security. A company with no debt or convertible securities issued publicly traded common stocks 3 times during the period. That means in totality the company has come up with new share issue in totality 3 times during the period under both IFRS US GAAP. Now what will happen? You don't have any dilutive security. So in this particular case, my basic EPS is going to be equal to dilutive EPS. So if you don't have any sort of if you don't have any sort of convertible securities, then in that particular scenario, basic EPS is equal to dilutive EPS. So if I go to the annual report of C8, now C8 does not have any sort of convertible securities, any security convertible into equity, they don't have. Okay, if you go through this annual report. Now if I go to their income statement, now here you will find that basic EPS and dilutive EPS is exactly equal because they don't have any sort of convertible securities. Proceeding further, 19th, the company reported the following financial data for the year end 31st December. Share outstanding at the beginning of the year, then common stock issued as dividend. Now this is issued as dividend on 1st June. This date is irrelevant, but it's going to be added to all the prior periods. Okay. Now warrants outstanding on 1st January is 5 lakh. Net income is 3.35 million. Preferred stock dividend paid is 4.30 and common stock dividend paid is 2.4. Now which statement is most correct? Now first is basic EPS is 1.12. Now class, okay, anyways, I'm even without calculation I can find out the answer. Okay, so the correct answer is going to be B. Why B? Now dilutive EPS is equal to or less than basic EPS. Now this is a factual statement, so answer is going to be B. Anyways, I'm going to compute the basic EPS and the weighted number of outstanding shares as well. Okay, so now what is going to be my basic EPS? Question number 19. Now your basic EPS is going to be net income. This is 33,50,000 minus preference dividend, which is 4,30,000, divided by weighted number of outstanding shares. So now total weighted number of outstanding shares is 20,20,000 plus 3,80,000. Now if I find out, so my answer is going to be 1.2167. So A is incorrect. Then weighted number of outstanding shares. Now what is going to be the denominator? So now my denominator is 24 lakh instead of 22 lakh 10,000. So A is incorrect, C is incorrect. What is going to be the correct statement? This is going to be B. Proceeding further, 20th. The company had 1 million average shares outstanding during 2009. During 2009, the company has 10,000 options outstanding with the exercise price of 10. Where the stock price is 15, you have to pay only 10 in the money. For the purpose of computing diluted earnings per share, what is going to be the denominator? So now it is in the money, and if it is in the money, then I'm going to find out additional issues using treasury stock method. 1 minus EP. My EP is 10. My average stock price is 15. And in totality, how many shares options outstanding? 10,000. So 10 divided by 15 minus 1. 10 divided by 15 multiply by 10,000. So this is going to be 3333. And how many shares were earlier outstanding? This is going to be 1 million. Now add 1 million. This is going to be the denominator. So 1,003,333. Now this is going to be the denominator. So answer is A. Next, 21. For its year ended, the company reported net income of 200 million and a weighted average of 50 million shares outstanding. There are 2 million convertible preference share that will pay an annual dividend of 5. Each preference share is convertible into 2 common stock. You have to compute dilutive EPS. Now again, there are going to be 3 steps. Question number 21. Basic EPS is equal to 200 million minus how much dividend you have to pay to the preference holder. So you have 2 million preference share where you're paying a dividend of 5. So in totality 10 million of dividend divided by how many shares outstanding? This is 50 million. 190 divided by 50. Answer is 3.8. Now when this preference share will convert into equity, now you need not to pay dividend, which is 10 million. But how many additional shares you are going to issue? So now in totality there are 2 million preference shares, and to every preference share you are going to issue 2 shares of equity. So this is going to be 4 million additional. 10 divided by 4. Answer is 2.5. Is it less than answer is step number 1? Answer is yes, it is going to be dilutive in nature. So now 200 divided by 54. So my dilutive EPS is 3.70. Answer is C. When calculating dilutive EPS, which of the following securities in the capital structure increases the weighted average number of outstanding shares without affecting the net income? Now this is only in case of stock options. In case of stock option, if it is in the money, now what you are going to calculate in step 2, that is 0 upon the additional issues. So answer is A. Then 23, which statement is most correct? A common size income statement. Now A is incorrect. Now could be possible that you are going to mark A as answer, but why A is incorrect? It is written restates. It does not restate, it converts. So restating means changing the classification. So what is going to be the correct word instead of restates? Restates means changing the classification. So instead of using a word restates, we should use a word here, states. So now states each line item of the income statement as a percentage of sale. So A is incorrect because of the word re. Then it allows an analyst to conduct cross-sectional analysis by removing the effect of company size. Is it correct? Yes. Now what is the purpose of common size statement? To perform time series and cross-sectional analysis. So answer is going to be B. Then 24. Selected year-end financial data for the company. You have to find out comprehensive income for the year. Okay. So now 24 EAT plus 4 OCI. This is going to be my total comprehensive income. Now what is your EAT? My EAT is 15. Okay. Then unrealized gain and losses on available for sale. Is it a part of OCI? Yes. Now add 5 here. Then unrealized loss on derivative accounted as hedge. Is it a part of OCI? Yes. Minus 3. Then foreign currency translation gain on consolidation. Is it the part of OCI? Yes. 2. Then dividend paid. It is a part of OCI? Answer is no. So now what is going to be our total comprehensive income? 15 plus 5, 20, 22, 22 minus 3. This is going to be 19. So now option number A. Total comprehensive income for the year is 18. Incorrect. Is increased by the derivative accounted for as hedge. It will reduce by. I'm not going to add 3. I'm going to deduct 3. And last one is include 4 as other comprehensive income. So now what is your other comprehensive income? This is going to be 7 minus 3 equal to 4. So yes, 4 is going to be other comprehensive income. Now 25th. When preparing an income statement, which of the following item would most likely be classified as OCI? So now my answer is A. Foreign currency translation adjustment. B is incorrect because it's an unrealized gain on securities held for trading. It should be available for sale. And in C, instead of realized, there should be an unrealized gain on derivative contract not accounted for as hedge. So what is the answer to 25th? Answer is A. So friends, with this we have covered this chapter, okay, and have solved fair amount of questions from the question bank. Okay, so now what I'm going to do in the next part? In the next part, I'm going to solve the remaining questions of your question bank. Okay, so before proceeding to the next part, it's very important that you're going to revise this chapter thoroughly. You're going to practice the questions that we've already covered. Okay, so this is going to be your agenda before proceeding to the next part. Thank you. Now friends, in this part, I'm going to solve the remaining questions of our question bank. Okay, So now starting with question number 26. At the start of the year, a company acquired new equipment at a cost of 50,000, estimated to have a 3-year life, residual value of 5,000. The company depreciates the asset using DDB method. You have to find out the depreciation expense for the 3rd year. So now this I'm going to solve with the help of the calculator. Now you're going to press second depreciation, that is second 4. Now I want DB should be displayed over your calculator. Okay, if it is not, then you have to keep on pressing second enter. So DB should display now DB equal to 200. That means double declining balance. Now you have to press down arrow. Life is going to be 3. Enter down arrow. Then depreciation will start from the 1st year. Then CST. CST means what is the cost of the equipment? 50,000. Enter down arrow. Salvage value 5,000. Enter down value. And now you're going to press year. So for which year we want to compute the depreciation? This is 3. So press 3. Enter down arrow. And now my depreciation is going to be 555. So answer is B. Next, 27. Our equity analyst is forecasting next year. So forecasting next year net profit margin for a heavy equipment manufacturing firm by using the average net profit margins for the last 3 years. In making his profit projections, he identifies the following 3 items. The company reported loss from discontinued operation in each of past 3 years. Okay. The most recent years tax rate was only half of the prior 2 years as a result of financial stimulus. And the company reported gain on sale of investment in each of past 3 years. Okay, so now what is given in the question? So the company is engaged in, it's a heavy equipment manufacturing firm. And now you want to forecast the profits for the next year. So what you have observed, number 1, there is discontinued operations. Second, the tax rate in this year has reduced on account of financial stimulus. Now, for example, in our country, now because of COVID, the business has been hampered badly. Now, government has come up with a stimulus. So earlier, the tax rate in our country was somewhere close to 34%, and now the government has reduced this rate to 25%. So this is on account of stimulus. Okay. And third one is the company reported gain on sale of investment. Which of the following statements about the preparation of the forecast is most accurate? Now, the analyst would use the most recent tax rate because it is the best predictor of future tax rates. Now my point is, in our country, earlier tax rate was 34%, which corporate has to pay. That means if your profit is 100, you have to pay 34 rupees to the government. But now, because your business has been hampered badly, now government has come up with a stimulus and now you have to pay 25% as taxes. Now my point is very simple. Do you think that this is going to be continued forever? So the answer is no. Now, use the most recent tax rate because it is the best predictor of future tax rate. Answer is no. This is on account of financial stimulus, because fiscal stimulus, because currently economy is going through a very difficult phase. This may or may not be continued in the future, and high probability is that it is not going to be continued in the future. In our country, again, tax rates are going to increase. So A is incorrect. Second, B, exclude the gain on sale of investment because the company is manufacturing firm. So now whenever we make the forecast for operating profits. So is it correct that I should exclude the gain on sale of investments? The answer is yes. Now this is not going to be my main business. So this is the statement is correct that we are going to exclude. Now third is include the losses from discontinued operations because they appear to be ongoing feature for this company. So C is incorrect. A is incorrect. So what is going to be the correct answer? The correct answer is B. Now you should exclude the gain on sale of investments because it is non-operating income and we are talking about a manufacturing entity. So correct answer is B. Proceeding further, 28. Now you have to compute dilutive EPS. So in totality there are going to be 3 steps. Step number 1, you have to compute basic EPS. So basic EPS is equal to net income, which is 10 lakh, minus preference dividend. So now convertible preferred shares outstanding is 2000 and company is paying a dividend of 10 rupees. So what is the dividend that company is paying? 20,000 divided by weighted average of common shares outstanding. This is going to be 1 lakh. So now what is my basic EPS? 10 lakh minus 20,000 divided by 1 lakh. So this is 9.8. Okay. Now you are having two convertible securities. So one is convertible preference share and second is convertible bond. Now you are going to perform step number 2 for both the securities separately. Now my question is, if tomorrow preference shares will turn into equity, then what is going to be the savings? Now you need not to pay any sort of dividend. So 20,000 is going to be the savings. Okay. And now in return, company is going to issue how many new equity shares? Each preferred share is convertible into 5 shares of common stock. Now currently you are having 2000. Each shareholder will be given 5 new equity. So what is going to be the new issue? This is going to be 10,000. Answer is 2. Is it less than 2? Is it less than 9.8? Answer is yes. So we concluded that yes, preference stock is a dilutive security. Okay. Next one is convertible bond, where the convertible bond value is 80,000 rupee and you are paying a coupon of 8%. So what is the interest that you are paying? 80,000 multiplied by 8%. So figure is 6,400. Now this 6,400 has two parts. One belongs to the government and one belongs to the equity. 40% is the tax rate. So how much belongs to the firm? Multiply by 0.6. This is going to be 3840. Now tomorrow if debt will convert into equity, we need not to pay any sort of interest, which is going to be 6,400 multiplied by 1 minus 0.4, which is nothing but equivalent to 3840. But now how many new equity shares you have to issue? So I have to issue 25 shares for each bond. Now one bond has a face value of 100. You are having in totality bond of 80,000. So how many bonds you are having? How many bonds you have issued? 800. Now one bond holder will be allotted 25 common shares. Now 3840 divided by 800 multiplied by 25. This is 20,000. So my answer is 0.192. Is it dilutive in nature? Answer is yes, since it is less than step number 1. So even debt is dilutive. Now I'm proceeding to step number 3. So what was my earlier numerator? My earlier numerator was 9,80,000. Okay. But now you need not to pay any sort of preference dividend. So add 20,000 plus, now you need not to pay any sort of interest, 3840. But now what is going to be my revised denominator? 1 lakh plus 10,000 plus 20,000. So now my answer is 9,80,000 plus 20,000 plus 3840. So this is going to be 1 lakh plus, I've just made a mistake, 9,80,000 plus 20,000 plus 3840 divided by 1,30,000. So answer is 7.72. So answer for step number 3 is A. Then 29. Under comprehensive income is least likely to include gain and losses on. It is least likely to include gain and losses on sale or disposal of discontinued operations. So now it is going to be shown below. It is going to be shown after net of tax, but it is not a part of OCI. What is going to be the part of OCI? Derivative contract and foreign currency. These are definitely the part of OCI. So answer is A, least likely. Then 31, you have to find out the total comprehensive income for the company. Okay, so my revenue was 12,500. My expenses are 10,000. So now what is going to be my EAT? My EAT is Question number 31. So EAT is 2500. Now within this I'm going to add 4 OCI. Now gain from available for sale security, it is a part of OCI, ES, add plus 1475. Then loss on foreign currency translation adjustment of a foreign subsidiary, loss, so deduct 325. And dividend paid, it is a part of income statement comprehensive income, answer is no. It is a part of statement of changes in equity. Now what is going to be my total comprehensive income? 2500 plus 1475 minus 325. So my answer is 3650. Answer is C. Now 32. Information about the company's historical performance for the last 2 years and the additional information are summarized in the following table. So now sales, COGS, operating expenses, then gain on sale of short-term investment, tax expenses, income or loss from discontinued operation net of tax, and finally this is net income. Now what is given? You have to forecast income for the next year. So you have been provided with prior 2 periods, 2012, 2013, and now you have to forecast the income for next year. Okay. Now first line is industry sales are expected to increase by 5% and company expects to maintain its current market share and gross profit margin. Okay. So now question number 32. So in 2013, company has a sales of 5500, COGS 2200. So what was the gross profit? Gross profit is 3300 and gross profit margin is 3300 divided by 5500 equal to 60%. Now you have to forecast for 2014. Now first point is sales will increase by 5%. So 5500 multiplied by 1.05. Now my forecasted sales for next year is 5775 and it is given that the company's gross profit the company is going to maintain the gross profit. So the company expects to maintain its current market share and gross profit margin. So now what is my gross profit? My gross profit is going to be 60% of my sales. So now my sales is 5775 multiplied by 0.6. So now 3465 is going to be gross profit and COGS is going to be 2310. Okay, so till gross profit we have done. Next, operating expenses are not expected to change with increase in sales. That means they are fixed in nature, they are going to remain constant. Okay. Now what is my operating expense? My operating expense is 2350. So this was my gross profit minus operating expense 2350. Okay. Next, the company sold off its portfolio of marketable securities in 2012. So now there was a gain on sale of short-term investment. So that gain has already been booked in 2012. Okay. And use the funds to purchase the operating assets. In 2012, the company announced its intention to sell off a division and that sale was completed in 2013. Okay. So now earlier I was planning that I'm going to sell one of my divisions and that sale has already been completed in 2013. Now class, earlier I was having one investment, that investment has already been liquidated and I was having one discontinued operation. This discontinued operation has already been liquidated. Now do you think that this is going to be, so I'm going to get anything from these two items in 2014? Answer is no. Now the results from the divisions and the gain or loss incurred on the sale are classified as discontinued operations. And this has already been happened. Now this is not going to repeat in the future. Now look at into my income statement very carefully. Now I'm left with only one expense. This is going to be tax expenses. Now point is very simple. How much tax you have paid in prior periods? So this is going to be my EBT. My EBT is 3465 minus 2350 115 minus tax. This is going to be your EAT. Now, what was your tax in 2013? So very carefully. Now in 2013, just give me a second. In 2013, your sales was 5500, COGS was 22, and your operating expense was 2350. So what was your EBT? My EBT was 5500 minus 2200 minus 2350. So my EBT was 950, and on that 950 you have paid a tax of 237.5 to the government. So what is the tax rate in your country? 237.5 divided by 950. So what is the tax rate in the country? 25%. Now in the absence of any other information, I'm going to assume that this tax rate will remain constant. I'm going to pay 25% taxes to the government. This is 278.75. And now what is going to be my income? This is 836.75. So now answer is B. So class, a quick revision. Now why I have not considered any gain on sale of short-term investment? Because this investment you have already liquidated in 2012. I have not considered any income loss from discontinued operation because it has already been liquidated and you have already sold this division in 2013. Now I have already forecasted my sales, COGS, operating expense, and I was left with tax expense. Now since I am not being provided with any other further information, I am going to assume that whatever the tax rate historically been, it is going to remain same in the future as well. So based upon that assumption, my net profits are going to be 836. 33 we have already done. Now 34. So class, in 34 you have been provided with two datas. One is authorized, second is issued and outstanding. Now let's understand what is the meaning of authorized. Authorized means during the lifetime of the company, how much share the company can actually issue. So what is your power? In totality power, the number of shares that you can issue. So now authorized, for the purpose of calculation, authorized is of no use. It is only for the purpose of confusion. Now company has an authorized capital of 5 lakh. Now company can issue maximum 5 lakh shares, out of which company has issued only 2,50,000. So now authorized is only for the purpose of confusion. So ignore this particular, so you have to ignore the second column. Now you have to compute dilutive EPS. Again there are going to be 3 steps. So question number 34. Step number 1, you have to compute basic EPS. So my profits were 10 lakh. Now you have to deduct preference dividend. Now in this there are 2 series of preference stock. Series A, Series B, where Series A is non-convertible. Okay. Now company pays a dividend of 4 rupee per share. In totality you are having 12,000 shares. So what is the dividend that company is going to pay them? This is 48,000 minus Series B. Now point to be noted, Series B is convertible one. So A is not convertible, B is convertible only. Company is paying a dividend of 7.5 per share. So 30,000 multiplied by 7.5. So what is the dividend? This is 2,25,000 divided by how many shares I am having? 2,50,000. So 10 lakh minus 48,000 minus 2,25,000 divided by 2,50,000. So now my answer is 2.908. Now step number 2. Now tomorrow if Series B gets converted into equity, then what is going to be total savings? Now my total savings is going to be 2,25,000. But now you have to issue more shares. Now how many shares I'm going to issue? For each share you're going to issue 2.5 common shares. In totality I'm having 30,000 shares. So new issue is going to be 30,000 multiplied by 2.5. So 30,000 multiplied by 2.5 is 75,000. Now 2,25,000 divided by 75. Answer is 3. Now my next point. Answer in step number 2. Answer in step number 2. Is it less than answer in step number 1? Now I'm getting in step number 2 answer as 3, and in 1 I'm getting answer as 2.98. So this is not the case. That means the security is anti-dilutive in nature. And if it is anti-dilutive, then we are not going to proceed to step 3, and we are going to conclude dilutive EPS is equal to basic EPS is equal to 2.908. So now my answer is C. So 34, answer is C. Why, class, I'm not proceeding to step number 3? Because this is not dilutive, it is anti-dilutive in nature. That means if I include this, then eventually the EPS will increase, and it is against the principle of prudence that you show increased EPS. Okay, so I'm not going to proceed to step number 3. So answer is C. Next, 36 we have, 35 we have done, 36 we have done. Now 37. Under general principle of expense recognition, a company should apply uniform treatment for administrative and depreciation cost. Incorrect. Now we have not learned anything uniform treatment for administrative and depreciation. Then second is, you should recognize the expense in the period that it consumes the associate economic benefit. Now class, have you done this sort of concept? Now this concept is based upon which principle? Now it is based upon matching. Now my point is, irrespective you have manufactured how many quantities, we are least bothered with that. We are concerned with how many units you have sold. Now based upon whatever you have sold, you have to match your expenses. Now recognize your expense in the period that it consumes the associate economic benefit. Now if sales has happened in year 2010, then expenses will be booked accordingly. So you have to book the expenses in accordance with your sales. Based upon which principle? Based upon matching. So 37, answer is B. The next 38 we have done. 39. Now net difference between reported basic EPS and dilutive EPS. Okay, so 39. Step number 1, you have to compute basic EPS, which is 100 million net income. Now you are going to deduct preference dividend. So now you are having 10 million shares, and where preference dividend is $1 per share, minus 10 million divided by number of outstanding shares, which is 25 million. So 90 divided by 25. So answer is $3.6 per share. Now step number 2. Now tomorrow, if this preference shares converts into equity, what is going to be a savings? Now you need not to pay 10 million as dividend, but now new equity shares. Now how many new equity shares you are going to issue? So for each share is convertible into 0.5 shares of common stock. So now you are having 10 million. For each you are going to offer 0.5. So how many new shares you are going to issue? This is going to be 5 million. Answer is 2. Is it less than 3.6? Answer is yes. Now I'm proceeding to step number 3. Now what is, earlier my numerator was 90, and now since it is dilutive, I need not to pay any sort of dividend. Now what is going to be my total earnings? 100 million. How many total shares? This is going to be 30 million. Now 100 divided by 30, this is 3.33. So now my basic EPS was 3.6, my dilutive EPS is 3.33. So what is the difference between the two? The difference between the two is of 0.2666. So answer is B. Next, 40. A Australian company reports under IFRS purchase a plane with the expected useful life of 20 years. All costs are reported in Australian dollar. The total cost is 10 million. So question number 40. So total cost is 10 million of a plane with a life of 20 years. Now this they have divided into 3 parts. Number 1, plane's gallery, which is going to be changed at the end of every 4 years, and cost is 1 million. So 1 million cost allocated to interior, where interior will have a life of 4 years. Second, 4 million is allocated to the turbines, which are replaced every 8 years. So now 4 millions for turbines, which has a life of 8 years. Now in totality you are spending 10, 1 for the interior, 4 for the turbines. So I'm left with 5 million. This is other parts, and these other parts will have a life of 20 years. Now class, you have been provided with respective components each. Now you're going to find out the depreciation using SLM. That means you have to follow the component depreciation method because you have been provided with specified components. Now my point is very simple. In totality, life is 20 years, okay, of the plane, and you're going to change the interior at the end of 4th year. So in totality, what is the requirement? 5 years, but 5 times, but one interior is already fitted into the plane when you have purchased it. So how many times you are going to replace it? So I'm going to replace it. So replacement is going to be 4 times. Then replacement for turbines, 20 divided by 8, 2.5 in totality. But when you have purchased, at that time turbines were already fitted. So now how many times you need the replacement? 1.5 times. And this is nil. Now point is, what is going to be your total cost that you are going to incur during the entire life? Now 1 million into 4, this is 4 million. Then 4 million multiplied by 1.5, this is going to be 6 million. Then 5 million, so instead of 5 I just ignore this. And at the starting you have already incurred 10 million. So what is the total cost that I'm going to incur? In totality you are going to incur 20 million you're going to incur 20 millions over the period of 20 years. Now what is the salvage value? Salvage value is 0, and now you have to compute depreciation. In totality your expenses is 20 million. This 20 million belongs to 20 years. Now what is going to be the amount of depreciation for the first year? 20 million divided by 20 years. So answer is 1 million. 1 million is nothing but $1,000. So answer is A. So class, how I find out the answer? This is in accordance with component depreciation. Now another way to find out the answer is, so now in totality you have incurred 10. Now 10, 1 belongs to the interior, 4 belongs to the turbine. Now total replacement, this is going to be 5, this is going to be 2.5, and this is going to be 5 million. So this you have to incur only once. So 5, then 4 multiplied by 2.5, this is going to be 10, and 1 multiplied by 5. So in totality you are going to incur 20. 20 will have a life of 20 years. So what is going to be the depreciation for every year? This is going to be 1,000. So answer is A. Next, 41. An income statement in a single step format presents a subtotal for. Now there are 2 methods to prepare the income statement. One is multi-step that we have already covered. Sales minus COGS, gross profit minus other operating expenses, EBITDA. This is known as multi-step. Then there is one more type which is going to be single step. Now single step is not allowed for the companies. Okay. So what will happen in case of single step? You're going to report the sales. Then there's going to be the expenses. All the expenses clubbed together, depreciation, rent, COGS, all the expenses will be clubbed together, and directly you will jump to EBIT. So this is the format for single step. Whereas for multi-steps, format was sales minus COGS, gross profit minus other operating expenses, EBITDA, and so on. So this was multi-step and this was single step. Now let's go through question number 41. An income statement in a single step format presents a subtotal for. Now here you will get subtotal for sales, expenses and EBIT. So a subtotal for A is incorrect. You will get a subtotal for operating income. B is correct. C is incorrect. Then 42. Now in 42 you have to compute on net income basis. That means on EAT basis you have to compute PE multiple. Now what is the meaning of PE multiple? This we are going to learn in ratios. But now let us assume that now in the share market there is a company by the name Hindustan Unilever, and this company has a share price of 2000. So this is the share price, current market price, and this company has a EPS of earning per share of 100 rupees. So what is the multiple that the shareholders are paying or investor is paying? Now investor is paying a multiple of 20 PE. Now what is the meaning of this? Against earning of 1 rupee, investors are paying a multiple of 20. Investors are paying a price of 20. Now you have to compute PE multiple. Okay. So now you already have stock price per share, which is 60.75. So PE, where P stands for price, E stands for earning per share. Now 60.75 divided by. Now you have to compute EPS, basic EPS they are talking about. Now on net income basis, that means on EAT basis, your total comprehensive income is 193. Your other comprehensive income is 87.6. Now my question is, what is going to be your EAT? So EAT plus OCI, this is your total comprehensive income. Now total comprehensive income is 193. Other comprehensive income is 87.6. So what is your EAT? This is 105.4. Now this belongs to all the shareholders. Now how many shares outstanding? 46.5. Now what is the EPS? Now EPS is net income minus preference dividend, number of shares. Now net income is 105.4, preference dividend is 0, and shares are 46.5. So 105.4 divided by 46.5, this is 2.267. Now you have to compute your multiple. So my multiple is going to be 26.80. So answer is C. Now class, what is the meaning of these multiples? This we are going to learn in the chapter equity valuation in detail. So as of now, the meaning of P multiple is for 1 rupee of earnings, what is the price investor is paying in the market currently. So this is the meaning of P. And why I have taken net income? Because it is specifically given on net income basis. Okay. Now I'm proceeding further to question number 43rd. Now the following income statement and the tax rates are available on the company. So this is my current year and this is my prior periods. The profitability ratio that has the largest absolute increase in value in the current year is, now there are 3 profitability margins: operating profit, that is EBIT, net profit margin, and gross profit margins. So question number 43. Current year, prior period, and this is going to be the difference. So what was your gross margin prior period? So my gross margin was 60.5%. And what is your gross margin in the current year? Now 100 is revenue and COGS is 38.6. So what is going to be your gross profit? 100 minus 38.6. So now my gross profit is 61.4%. Now second is operating profit margin. Now operating profit margin for previous year is 23.3%. And what is going to be the operating profit margin for current year? Meaning of operating is EBIT upon sales. Now I'm going to deduct COGS. Class, am I going to deduct interest? Answer is no. But am I going to deduct research, journal and selling and journal expenses? Answer is yes. But I'm not going to deduct interest. Why? Because operating profit means EBIT. So 100 minus 38.6, this is my COGS, minus 4.4, this is my research, minus 32.9, this is going to be 24.1. Now what is my operating profit margin? This is 24.1%. Now last one is net profit margin. So net profit margin previous year was 15.8 and this year is, now I'm going to deduct interest as well. So already you have completed 21.4 minus 3.1%. So I'm left with 21. So EBT is 21. Now over this EBT you have to pay 22% taxes to the government. So if I pay 22% taxes to the government, I'm left with 78%. Now what is my EAT? 21 multiplied by 0.78. This is 16.38. Now what is my earning? My earning is 16.38 over sales of 100. So net profit margin is 16.38. Now you have to compute the difference. 61.4 minus 60.5, 0.9. 24.1 minus 23.3, this is 0.8. 16.38 minus 15.8, this is 0.58. Now the profitability ratio that has the largest absolute increase. So where there is going to be largest absolute increase, this is going to be in case of gross profit margin, and increase is 0.9. So answer is C. Then question number 44. The following information for the current year is available for the company that prepared in accordance with US GAAP. So class, this point we have skipped. Okay. So now let's go through this question. So revenue, COGS, other operating expenses, and now one more is restructuring cost. So now what is the meaning of restructuring? So now let us assume that you have taken a debt from a bank and currently your business has been hampered very badly. For example, you have one of the hotels, so COVID times are going on and your business is not performing well. You're unable to repay the debt. You're unable to repay the debt as per the agreed terms. Now you will call for restructuring. Restructuring means now you're going to amend the terms and conditions with the banker. But in this case, banker will charge some extra amount. This extra amount which you are going to pay to the financiers, which you are going to pay to the banker, is known as restructuring cost. Now under US GAAP, restructuring cost is considered as normal routine expenses, whereas under IFRS, restructuring is considered as non-operating expense. Okay, so now write one note, question number 44. Under US GAAP, restructuring is considered as operating expense, whereas US GAAP whereas IFRS, restructuring is considered as non-operating. Now class, go through the question carefully. You have to find out operating profits as per US GAAP or IFRS. Now US GAAP. So I'm going to consider restructuring expense as, I'm going to consider this as operating expense. So now you have to find out EBIT. So revenue is 7,000, COGS is 42. So 7,000 minus 4,200 minus 500 minus 250. Now what is going to be my EPT? This is 2050. So if it is US GAAP, answer is A. And if it is IFRS, then answer is going to be B. So here, since I'm considering restructuring expense as operating, my answer is A. 45th we have already covered. Now 46th. Which of the following statement is most appropriate? Better margin performance will be reported by. Now you have to comment upon gross profits and operating profits. So let's first find out for company X. 46. Company X. Now for company X, what is my gross profit? So 11.2 is the sales in million terms, $1 million, and 5.7 is COGS. So what is my gross profit? My gross profit is 5.5 over a sales of 11.2. So what is my margin? 49.10%. Next is operating margin level, operating profit margin. This is nothing but EBIT upon sales. Now 11.2 minus 5.7 minus 1.9 minus 1.5. So I'm not going to deduct interest. Now I will get 2.1. 2.1 divided by 11.2. So this is 18.75%. Company Y. 14.5 minus 7.7 divided by 14.5. So this is 46.89%. And then you have to find out EBIT margin. 14.5 minus 7.7 minus 2.2 minus 1.7 divided by 14.5. So this is 20%. Now company Y is having better operating profit margins and company X is having better gross profit margins. So what is going to be the answer? Where the performance is better? Company X has a better gross profit and company Y has a better operating profit margin. Answer is C. Next, 47th. Under a common size analysis, the value of research and development expense is closest to. Now your research and development is 12 million. This you have to divide it by revenue. The revenue is 282. So 12 divided by 282. This is going to be 4.25%. Answer is A. Next, now question number 48. A company sells a product with a 3-year warranty included in the price. According to IFRS, which of the following is most appropriate accounting treatment for the warranty? So now what will happen? So this we have covered in the chapter of income taxes as well. Okay, so now you're allowed to book the revenues. But correspondingly now you're going to, based upon the matching principle, you're going to make the provision for warranty expenses. Okay, now based upon your historical behavior, based upon your experience, you know the company will book the provision for warranty expenses. Okay, so now what is going to be the correct answer? A, full recognizing the revenue at the time of sale allowed, but waiting until the actual warranty costs are incurred to recognize the expense. Incorrect. You have to create the provisioning. Then fully recognize the revenue and estimated warranty expense at the time of sale, and updating the expense as indicated by the experience over the life of warranty. So correct answer is B. You are allowed to book the revenues, but correspondingly you are going to book the expenses by the name warranty provision for warranty. Proceeding further, 49. Now to calculate earning per share for 2012, you have to compute weighted average number of shares outstanding. Okay, so now 49th. On 1st January, 1,80,000 shares outstanding. Then 1st June, company has issued 60,000 more shares. So 1st June, 60,000 additional. Sorry class. Then on 1st August, there is 2-for-1 split. So 1st August, 2-for-1 split. Then in totality on 31st December 4,80,000 shares outstanding. You have to compute weighted average number of shares outstanding during the period. Okay, so now this date is irrelevant. Now where is my card? Okay, so now 2:1. So now one share divided into two parts. So in totality I'm going to have 1,20,000 shares and here 3,60,000 shares. So if I sum up, at the end there were 4,80,000 shares outstanding. Now this 3,60,000 is outstanding for the entire year. 3,60,000 multiply by 12 divide by 12 plus 1,20,000 multiply by, now 6, 7, 8, 9, 10, 11, 12. So this is going to be 7 months. Multiply by 7 divide by 12. So 1,20,000 multiply by 7, this is 8,40,000. Then 3,60,000 multiply by 12 plus 8,40,000, this is going to be 51,60,000 divide by 12. So now my answer is 4,30,000. So answer is C. The next 50, you have to compute dilutive EPS. So in totality there are going to be 3 steps. Step number 1, first you have to compute basic EPS. So basic EPS is net income, which is 32 million minus preference dividend. Now 15 million 12% convertible bond. Okay, 2,000 options with the exercise price of this. So I don't have any sort of preference dividend, so this is 0, divided by number of shares outstanding 4.5. So my EPS is 7.11. Now step number 2. Now in totality you are having 2 potential dilutive. First is option, second is convertible debt. Now 15 million, you are paying the interest of 12% and these are convertible into 50,000. So how much interest you are paying? Your bond value is 15 million multiplied by 12%. So this is going to be 1.8 million and tax rate in the country is 30%. So what is effective cost for the company? Multiplied by 0.7. So 1.26 million. And now how many shares? And these are convertible into 50,000 shares. So divided by 50,000. So now my answer is 12,60,000 divided by 50,000. This is going to be 25.2. So convertible debt, is it dilutive in nature? Answer is no, they are not dilutive in nature. Why? Because answer in step number 2 is greater than answer in step number 1. Okay, next one is you are having 2 lakh options with the exercise price of 50, whereas in the market share price is 80. Now employee can pay 50 rupees against a share which has a value of 80. In the money, out the money, you have to pay less in the money. Now using treasury stock method, how many new shares company is going to issue? 1 minus EP. My EP is 50 upon 80 multiply by 2 lakh. So 50 divided by 80. Now this is going to be, now how many additional issues they're going to be? 75,000. Now answer in step number 3, 32 million divided by 4.5 million plus additional 75,000. So now my dilutive EPS is my dilutive EPS is 6.99. So now your basic EPS was 7.11 and your dilutive EPS is 6.99. Answer is A. Then 51. In applying the principles of expense recognition, company should, number 1, record any estimate of uncollectible amounts as a direct deduction of revenue. Now incorrect. Now what option A is trying to say? Now let us assume that I make a sales of 100 Okay, and the goods have been sold on credit, and now I think that my customers are not going to pay me back. So now you're going to deduct this 100 from here and you're going to report sales as 0. Incorrect. Now if this is a scenario, then you're going to book into your income statement provision for bad debt. Okay, this is going to be 100 and then you're going to show as 0. So now what we are going to deduct from sales? So from sales you are allowed to deduct the discounts, you are allowed to deduct the sales return. But again, provisioning cannot be deducted directly from sales. It has to be shown separately into your income statement. So A is incorrect. Second, B, exclude cost of intangibles with infinite life. Is it correct? Now yes, if you are having an infinite life, then I'm not going to charge any sort of amortization. So B is correct. Now C, recognize credit losses on customer receivables when default occurs. The answer is incorrect. Now if there is an expectation that your customer is not going to pay you, still the default has not occurred, but you have an expectation based upon the news in the market that the customer may not be in a position to repay, then you're going to book the losses, okay, based upon prudence principle. So I'm not going to wait for the default to occur. The moment there's an indication, there's a hint, I'm going to book the expenses based upon prudence principle. So answer is B. Next, 52. Now the company will most likely report other comprehensive income closest to. So 52. Now my first question is, by how much my retained earnings is increasing? So at the starting of the year my retained earnings was 5,80,000 and it has increased to 8,21,000. Now my point is, how much profits, additional profits you have retained during the period. So this is 8,21,000 minus 5,80,000. So now 2,41,000 is the additional retained earning. That means these are the profits, additional profits during the period that has been retained. Okay. So now total profit has two components. One in the form of retained earnings and second which is distributed in the form of dividend, which is 60. Now what is my total EAT? My total EAT is 3,01,000, and that is given that comprehensive income is 2,46,000. So comprehensive income is 2,46,000. EAT add OCI. Now what should be the OCI figure? This is going to be negative 55,000. So my answer is A. So class, whatever the now EAT, whatever the profits that you have earned, that EAT has two components, one retained and one distributed as dividend. Now dividend is 60k and retained is 2,41,000. Now what is going to be your total EAT for the period? That is 3,01,000, given that comprehensive income is 2,46,000. Now the difference between the two, this is going to be a loss of 55,000. Answer is A. Then 53rd, compared with 2021 common size income statement most likely indicates a lower tax rate. Okay, so now 53rd, based upon common size income statement. So this is my 2020 and 2021. So what was the income tax as a percentage to sales? So in 2020 it was 120 divided by 2325. Answer is 5.16%. Then 155 divided by 2611. This is 5.9%. So lower tax rate. Incorrect answer. Then second option is cost cutting in selling journal and admin expense. Okay, so earlier sales journal admin as a percentage of sales was 260 divided by 2325. This is going to be 11.18%, and in 2021 it is going to be 11.29%. Now, cost cutting. If there's a cost cutting, then this percentage should have reduced, but this percentage have increased in 2021. So neither A is answer nor B. Now third, sale of new differentiated products. Now if this is the case, then ideally your gross profit margins should increase. If you're selling a differentiated product, a new product, then ideally your gross profit margin should increase. Now what was my gross profit margin in 2020? 775 divided by 2325, so 33%. And in 2021 margins have increased to 930 divided by 2611, this is 35.86%. so now what is the correct answer? Correct answer is option C. The next 54, a company incurred the following unrealized holding gains in the current year: 1 lakh on account of securities held for trading, and 5 lakh on account of foreign currency translation adjustment of a self-sustaining non-domestic subsidiary. Other comprehensive income for the period is, now held for trading is not a part of OCI. Now what is going to be the part of OCI? This is 5 lakh. Answer is C. Answer is C. Then 55. To calculate the earning per share for 2013, you have to compute weighted average number of outstanding shares. Okay. So 55. Now on 1st January, 2 lakh shares outstanding. Okay. On 1st June, 50,000 additional issued. Then on 1st August, there is going to be 2:1 split. You have to find out weighted number of outstanding shares. So now 1 share divided into 2 parts, this is going to be 1 lakh, this is going to be 4 lakh. Now at the end you are having 5 lakh outstanding shares. So now what is going to be the weighted average? 4 lakh multiplied by 12 divided by 12 plus 1 lakh multiply by divide by 12. Now multiply by 6, 7, 8, 9, 10, 11, 12. This is going to be 7. So 7 lakh plus 48 divided by 12. So this is going to be 4.58. My answer is C. 56 we have already covered. 57. For which of the examples given would common size statement generally provides the greatest insights? Now first one is liquidity analysis. Now liquidity analysis means whether the company would be in a position to repay the debt, yes or would be in a position to repay the short-term obligations, yes or no. So this we analyze with the help of balance sheet, not with the help of income statement. So A is incorrect. The next word is time series analysis. So with the help of common size statement, are you able to perform time series analysis? A comparison of company's performance with itself over the period of time? Answer is yes. So B is correct answer. Then a comparison of similarly sized companies. Now both of them are having the same revenue but in different industries. So one is an auto component, second is into the steel, and third one is into the let us assume that into e-commerce, fourth one is into the e-learning. So no. So comparison always going to be apple to apple. C is incorrect, A is incorrect. Correct answer is B. Then 58. Common size statements for the 3 companies are shown for the 3 companies in the same industry. Which of the one is most likely to have technically superior product? So where the gross profit margins is higher. So now in case of company X, your COGS is 65, so your margin is 35. In case of company Y, your margin is 50, and in case of company Z, your margin is 70. Now which company do you think will have a technically superior product? The one having the highest gross margin. Now this is going to be in case of company Z. Further, this data is also supported by research and development expense. Now the company Z is having the maximum research and development. That means they're basically researching for new products, and hence they're able to maintain a higher margin. So answer is company number Z. Then 59 we have covered. 60. Which statement about OA 3-year financial performance is most accurate? Okay, so now you have been provided with common size income statement and industry relevant data. Okay, so now I want to start with C. Profit margin indicates superior performance with respect to industry average. So now these are industry average, and these are the margins for the company. Now company's margin in 2013 was 40.5, whereas industry has 40.7. In 2014, company's margin is 37.5, where industry is 13.9.1. In 15, the margin is 35.7, whereas the industry has 38.4. So gross profit margin indicates superior performance to industry average. Incorrect. Okay. Now second is revenue per dollar of sales. Revenue per dollar of sales cost are falling over the period. So now what B is trying to say? Question number 60. Revenue divided by per dollar of sales cost divided by cost of sales. So now what was this figure in 2013? So your revenue was 100, your cost was 59.5. So 100 divided by 59.5, this is going to be 1.68. Then in 1400 divided by 62.5, this is 1.6, and then 100 divided by 64.3, this is going to be 1.55. Now revenue per dollar of cost are falling over the period. In 2013 it was 1.68, in 2015 it has reduced to 1.55. So is it falling over the period? The answer is yes. D is correct answer. Now A. So B is correct. Effective tax rate has been holding steady at approximate 2%. Now what is the meaning of effective tax rate? The meaning of effective tax rate is this is going to be your taxation expense upon EBT. Now this is the meaning of effective tax rate. Now I understand here they have given taxes as 2%, 2%. Now what is the meaning of this 2%? That means taxes upon sales is definitely 2%, constant at 2%. But effective tax rate has not been 2%. How to compute effective tax rate? This is going to be your taxations divided by EBT. Now if I have to compute, okay, so now you have been provided with EBT. So my EBT is 9.1, 9.9, 9.2, 8.1. So now if I want to compute effective tax rate, this is going to be the taxes, that is 1.9 divided by 8.1. So answer is 23% for 2013. Then for 2014, 2 divided by 9.2. Answer is 21%. And for 2015, answer is 2 divided by 9.9. So answer is 20.2%. So no, the effective tax rate has not been constant. Profit margins is not increasing. Yes, definitely revenue per dollar cost of sales are falling over the period. So correct answer is D. Next, 61. Which of the following is least consistent with conservative accounting? Now conservative accounting means you have to report more expenses. So if you're reporting less expensive or you're reporting more revenue, then yes. If you're reporting less expenses or you're reporting more revenue, then you're being aggressive. Which of the following is least consistent with conservative? That means you're doing aggressive accounting. Now recording expenses later rather than earlier. So is it one of the example of aggressive accounting? Yes. Now B, reflecting lower warranty expense due to improved product quality. Now, do you have any rationale that why you are assuming lower warranty expense? Now you're saying that yes, my product quality has improved. Is it one of the valid reason? Answer is yes. So B is incorrect answer. Then estimating lower uncollectible amounts. That means you will be unable to recover the estimating lower amounts, lower bad debts because of stricter credit policy. Now let us assume that you are not offering any sort of credit to your customers, because of which you are estimating lower uncollectible amounts. So is it one of the fair reasons? Answer is yes. Now which is against the principle of prudence? So against the principle of prudence is option number A, where you are recording expenses later rather than earlier. You should, the moment you have incurred the expense, it should be recorded into your P&L. You are recognizing them late. So this is one of the examples of aggressive accounting. Answer is A. Now 62. Which of the following best describe a component of income statement? Amounts that a company owes to its vendor for purchase of goods and services. Is it a part of income statement? Answer is no. They are the part of creditors. So you have purchased the goods on credit. So that amount of credit that is still payable to vendors is termed as creditor. A is incorrect. Outflow or depletion of assets in the course of business activity. Now during the course of business activity, you have used any sort of assets. Is it going to be the part of income statement? Yes. Now for example, I purchase a car. Now I purchase a car for my business purpose. Now am I going to charge any sort of expense into my income statement? Yes, this is going to be depreciation. So outflow or depletion of assets in the course of business activity. B is correct. The last one is obligation from past event that are expected to result in outflow of economic benefits. Now if you have any sort of obligation, so in the past you have already reported the liability. Now what will happen in the future if you have to pay? So the moment you will pay that liability, your liabilities will reduce from one end, and correspondingly your assets will reduce. So there's going to be no impact over your income statement. So now, which of the following best describe a component of income? This is going to be outflow or depletion of assets in the normal course of business activity. Then at year end, a company has non-convertible debt, ordinary shares and ESOPs. Now the moment you are having stock options, now you are having a complex structure. So when we use the word complex, either you are having convertible debt, convertible preference shares or ESOP, then we will use a word, the capital structure is complex. So now it is complex because the options are convertible into equity. Answer is B. Then 64. For a company paying preference dividend, the component needed to compute basic EPS are, now to compute basic EPS, you need net income, you need preference dividend, and the weighted average number of shares outstanding. Now point to be noted, additional shares issued if preference is converted, this is required for the calculation of dilutive EPS. It is not required for the calculation of basic EPS. So correct answer is B. So the components needed to compute basic EPS, this is going to be B. If it is written the components required to compute dilutive EPS, then my answer is going to be C. So 64 B. Then 65. Given the information, you have to compute dilutive EPS. Now first I'm going to compute my basic EPS. So your net income is 2 lakh. Number of share outstanding is 1,25,000. So what is going to be my basic EPS? This is 2 lakh divided by 1,25,000. Answer is 1.6. 2 lakh divided by 1,25,000. 1.6. Now 12%, 60,000 bond. So what is the interest that you are paying? 7,200, and tax rate is 15%. So effectively how much it is costing the company? 85%. So interest is 6,120. If tomorrow this debt converts into equity, so how many equity? This is going to be 3,000. So 6,120 divided by 3,000, this is 2.04. Answer in step number 2, is it less than 1? Answer is no. This is not dilutive in nature. So now what is going to be my dilutive EPS? My dilutive EPS is equal to basic EPS is equal to 1.6. Answer is B. Then 66. A firm with convertible securities initially calculate that its dilutive EPS is greater than basic EPS. So now you calculated that and your dilutive EPS is greater than basic EPS. The firm will, now you are going to conclude this. Now that means your answer in step number 2 is greater than answer in step number 1. Now we are going to conclude that my dilutive EPS is equal to basic EPS. So answer is going to be C. Then 67. When preparing a common size income statement, the appropriate denominator for converting the reported cost of sales is, so in common size statement, everything we are going to divide by sales. Answer is A. Then 68, using a common size income statement to compare a company to its peers, an analyst can determine. Now this is basically for the purpose of cross-sectional performance, that means relative performance, how you're performing with respect to your peers. Answer is A. Then the company with the highest gross profit margin. So you have the cost of sales and sales, and now with the help of this you have to compute gross profit margin. So now in case of company A, my cost of good as a percentage of sales is, this is going to be 52.5%. So what is going to be margin? So for company A, margin is 47.5%. For company B, 90,000 divided by 2 lakh. This is going to be 45%. And for company C, this is 2,10,000 divided by 4,50,000, 46.67%. Now which company is having the highest margin? This is company A. Then 70, under US GAAP, comprehensive income is, now comprehensive income is A is incorrect. It is going to be changes in equity during a period from transactions and events and circumstances from non-owner sources. Now what is the meaning of this? Now for example, today you raise money with the help of debt. Now you're going to pay interest. So this interest, it is the part of income statement? Answer is yes. Now you raised money with the help of equity, you're going to pay dividend. Now is dividend is a part of income statement? Answer is no. So in income statement we are not going to show any transaction with my shareholders. So this is going to be change in equity. Change in equity means whatever the profit belongs to the equity. Change in the equity during a period from transactions and even circumstances from non-owner sources. Now for example, I make up the sales, I incur the costs. So all these are going to be the part of comprehensive income, but no transactions with the shareholders will be reported in income statement. So B is the correct answer. Next, 71. A company notes that company's most recent financial statement shows 65 million in net revenue, okay, 7 million as dividend paid to equity shareholders and 5 million as other net expenses excluded from net income calculation. That means basically they're talking about OCI. What is going to be comprehensive income? So your EAT is 65, your OCI is -5. Now what is going to be comprehensive income? This is 60. Then which company has the lowest P multiple calculated using comprehensive income? Okay, so first you have to compute comprehensive income. So now 72. Company A, company B, company C. So comprehensive income is for company A 150 minus 17, 133, then 565, and last one is 850. This is going to be my comprehensive income. Now how many shares outstanding? 100, 125, 300. So now comprehensive income per share 1.33, then 565 divided by 125, this is 4.52, and 850 divided by 300, this is going to be 2.83. So now I'm having comprehensive income. Now what is the price per share? Price is 27.88.53. Now you have to compute P multiple. 27 divided by 1.33, this is 20.3. 88 divided by 4.52, this is 19.46. 53 divided by 2.83, this is going to be 18. So where you're getting the lowest answer? This is in case of company C. Then 53, which of the following is reported as other OCI under both IFRS US GAAP. Now, cost of the company's defined benefit post-retirement plan that are recognized in the current period. So if it has been recognized in the current period, it is not a part of OCI. What is the part of OCI? Changes in obligation because of change in actuarial assumption. So this is the part of OCI. A is incorrect. Second is foreign currency translation adjustment from consolidation of foreign currency. Is it the part? Yes, B is correct answer. Then certain changes in the value of long-lived assets computed using cost model. So this is an incorrect answer. So what is the correct answer? This is going to be B. 74th class we have already covered. Now friends, by mistake I have skipped two questions. That is question number 4 and 7. So now I'm moving to question number 4. Now under IFRS, income includes increase in economic benefits from. So in the income statement, whatever we are going to report, this is other than transaction related to owner's contribution. So either the answer is A or answer is B. Now my point is, if liability increase, is it going to increase the profits? Answer is no. Now for example, I received advance from my customer. So is it going to be reported in the income statement? Answer is no. So no impact over the income statement, and correspondingly my liability will increase. On one side my liability will increase, and other side cash component will increase. So increase in liability, is it going to increase the profits, increase the income? Answer is no. On the other hand, enhancements of assets, is it going to provide me income? Now for example, earlier I was having one car, I'm a taxi driver, now I'm planning to buy one more car. Now my point is it going to promote my sales? Answer is yes. Now with this sales, my economic benefits, my income will increase. So now under IFRS, income includes increase in economic benefits from enhancement of assets not related to owner's contribution. That means excluding transactions with the equity holder. So answer is B. Then next, question number 7. A company previously expensed the incremental cost of obtaining a contract. Okay, now let us assume that I'm dealing with the government and I have to pay some sort of expenses to the government for obtaining that contract. For example, some sort of commission expense. All else being equal, adopting the May 2014. Now what is the meaning of IASB and FASB? So this we are going to cover in the chapter introduction. So these are the accounting standard boards. Now who has created the IFRS? This is International Accounting Standard Board, and the firm and the authority which has created the US GAAP, this is Financial Accounting Standard Board. Now all else being equal, adopting the May 2014 IASB and FASB converge accounting standard on revenue recognition makes the company's profitability initially appear. Now what they're talking about, they're basically talking about those 5 steps. Now what happened in this case, whatever the expense that you have incurred, you have directly passed on that expense to income statement. And if you have passed on that expense to income statement, then your expenses are going to be higher, and this is going to impact your profitability. Now your profitability is lower. Now what that 5-step process convey? Now as per that 5-step process, whatever the cost that you are going to incur, now this cost is going to be divided over the period. Now let us assume that I'm going to construct the road, and in totality I need 3 years. Now whatever the cost that you have incurred, it should be transferred to income statement over the period of 3 years. You have already transferred the entire amount to income statement, but now if you're using that 5-step process, you will transfer this expense over the period. As a result, initially your profitability will appear lower, higher, or unchanged. Now since you are dividing this expense over the period of 3 years, so initially your profitability is going to be higher. So now class, instead of initially if it is written later, then my answer is going to be lower. Why lower? Because here you have already charged the entire expense in first year, and here you are going to charge the expense over the period. So now let us assume that I have incurred 9 lakh rupees. So 3 lakh 3 lakh, 3 lakh. Whereas what will happen in case of what is discussed, in that you have put everything in the first year. So now in the first year my profitability is going to be higher, but what about the rest of the years? My profitability is going to be lower. So what will happen initially? Initially my profitability is going to increase. Answer is B. So friends, with this we have covered this chapter comprehensively. Now what you have to do? First, you have to revise this chapter from the class notes. Second, you have to solve these 74 questions. And if you think that I need a more explanation, then only I would suggest that go through your Schweitzer books. At least, else I think that your class notes is sufficient enough, and you have to practice these 74 questions. Okay, your target should be, like, whenever you're practicing, your target should be that I'm going to score more than 70%. And if you're able to solve 70% correct, then your preparation is good enough for this particular chapter, and you're allowed to move to the next one. Okay, so before proceeding to the next one, you have to thoroughly revise this chapter. You have to solve the 74 questions, and if required, then only you're going to refer the reference book. Okay, thank you.